Today is a non-business day. Domestic mutual funds will not participate. All the redemptions will happen on Tuesday. So in that context, volumes will be on the lower side. FIs are also not going to participate. It may not be too much of a directional move. But yes, plenty of stocks in focus. You have ICICI, Kotak that report today as well.
Well, as I heard you and Prashant, obviously it was valid market information, but I was still coming to terms that it's a Saturday morning. We're live on television. The markets are going to start. Wow, right, guys?
So, when I was driving to work today, generally you see people like scurrying, school buses and all of that. Today, there were people taking their morning walks and cycling on the road. And I'm driving full speed, getting out.
But it was at least clear, right? And it was a beautiful morning. It's nice and cool here in Mumbai. I put my muffler on. I said, let's put up the style quotient. Let's enjoy it, right? A nice ride to work. 12
Might as well enjoy it while you're at it.
Let's get back to the market action then, because that's what we are here for. So yesterday you had the Nifty. Well, it put on close to 150 points. You'll be happy about that. But the intraday chart of the Nifty Bank, you just put up a split screen on the screen. It'll tell you the picture. Yeah, that's the picture. And let's pull up another chart as well. For the past week, you'll just see that the Nifty ended down only around 1%. Not too bad, yeah? Because HDFC Bank, the star of the market, or the heaviest weight in there, that's taken 11% cut. Just take a look at it. So actually, at the X of HDFC Bank, the markets have done very, very well. But that's a bit of a problem pocket. So you're hoping at around this 52-week low of around 1,460 odd, you see some kind of support coming on HDFC Bank. And I think, the downside could be fairly limited from these price levels, from this 52-week low. Let's see how that goes. FIs, what do? They added shorts yet again. And now the shorts in the system have gone up to close to around 53% approximately. And in terms of their net long positions, you pull up a chart. We started this series with close to around 80,000 contracts were on the long side. And the bar graph will tell you the picture. Now we're net short, close to around 16,000 short contracts in the system. Remember, in the past, we've gone, much higher on the short side. But I like some shorts in the system. Given the kind of selling we've seen from the FIs, at some point of time, those shorts will have to cover up. So maybe we see a few days of short addition. Not today, obviously, because they'll not be existent. What do the options data look like? Well, 21,600, 21,500 put. Both of them did see a fair bit of open interest breakup. So that's why, you just try to pull up the levels then. You have the 20 DMA. We could breach that in today's trading session in all probability. You want it to decisively be conquered. The 50 DMA, well, that's far deeper. And I spoke to a lot of technical guys, not just yesterday, but over the last few days. And no one's talking about live below the 20,800, 20,900 approximately. The near-term support, though, going by the options data, is 21,400, 21,450, because the kind of put writing that we did see. The Nifty Bank, that's pat in the level between the 50 as well as the 100 DMA. So both those two are your goalposts for you. Hopefully, the banking numbers that come out today are not too bad, or maybe have a bit of a positive surprise, because otherwise, this Nifty Bank, from being nearly 49,000 odd, if you just pull up a chart, you'll see that it's come down to close to around this 45,500 odd levels. But that's a crucial level on the downside. We managed to defend it intraday in the last week itself. So let's hopefully, defend that and try to move up. But guys, Saturday morning.
Okay, markets open today as per normal hours in case you've joined in late. And Jan 22nd is going to be a holiday for the markets. So today we trade the entire day. We have lots of stock-specific action to track for you today. We'll get to it in just a bit in our special top 10 segment. We're looking at Reliance, Paytm, Tata Steel and CESC that are on our radar on the back of positive news flow. There's HUL, RBL Bank, Fortis, Suntech Realty, Tejas Networks and Credit Access Grameen. That's on our radar on the back of negative news flow, largely because of earnings reactions that have come through. So plenty of stocks to talk about. But as the Federal Reserve gears up for its next meeting that happens on the 30th and 31st of January, the big question that investors have is, when will the Fed start cutting rates? Let's listen into what the Chicago Fed President Austin Goolsbee has to say on the Fed's rate trajectory going forward.
2023, we're going to look back. You have to say, as far as the Fed's dual mandate goes of maximizing employment and restabilizing prices, we've made a lot of progress on the golden path in 2023. I don't like tying my hands when we still have weeks of data, and the way the Fed Open Market Committee operates is we go meeting by meeting. So let's not pre-commit ourselves on hypotheticals of what we would do in 3 meetings if we saw XYZ in the data. Let's take the long view. If we continue to make surprising progress faster than was forecast on inflation, then we have to take that into account in determining the level of restrictiveness.
Okay, well, that's opinion coming in from Fed officials. We have Ed Yardini, president at Yardini Research, joining us. Ed, great to have you with us here. Thanks very much and congratulations. We got the benchmark S&P at record highs as of yesterday, so it's looking good. And I think, if I remember correctly, you got decent upside levels from here. When we spoke with you at the beginning of the year, end of last year, you just want to sort of run us through that again?
Yeah, I'm looking for the S&P 500 to get up to 5,400 by the end of the year and 6,000 next year. So I think we're in a bull market. I've thought that since October 2022.
We are in the U.S. markets definitely is in a bull market with the way the markets are moving. Even back here in India, actually, Ed, it's been pretty solid. We've had a couple of volatile phases, but now we're heading into big events like the election. There's the budget as well, the vote on account. How do you see the Indian market shape up?
Well, I think in the global competition for global investors, India's been doing extremely well. And I think part of that is because India is a successful economy. It's an economy that has a lot of relatively young workers, and it's an economy that has a lot of upside potential. I mean, there's still a lot of work to be done, for example, with the infrastructure. But compared to China is really what's going on here. A lot of investors are not going back into China, even though China's gotten cheaper and cheaper. And as India's market's gone up, China's market's gone down, which I think signals that investors believe that the property bubble that's burst in China is going to continue to depress that economy, and that their underlying demographics of aging population is another negative. So India is kind of winning the race here in terms of emerging markets in global portfolios.
Well, indeed. Morning, Ed. Good to see you. When one would say we're expensive, but going by the points that you put down so beautifully, well, we're expensive for a reason, because the demographics of the earnings growth as well to look ahead. Ed, the last time we chatted, you gave us your view in terms of rate cuts, and you said you're expecting something only in the second half of the year. So that's one cue, and we've got your view on that. But what about the U.S. presidential elections? It appears, as of now at least, that maybe the Republicans could be in with a good chance. How do you see that panning out and its impact on the stock markets?
Well, you never can tell with politics. You never can tell with whether the Democrats or the Republicans are going to have the White House. Right now, it looks like it's going to be the same old horses in the old race, and that's Trump and Biden. And both of them are very controversial figures. They're very partisan. Half of the people like them, and one candidate, and half dislike the other one. So, it's kind of a 50-50 mix here in terms of partisanship. It's been my observation that the U.S. economy and stock market have been doing remarkably well for the past few years, despite Washington. That's my attitude towards Washington, is that it's really only an obstacle for doing business, but somehow or other, Americans managed to do a good job of keeping the economy moving forward. So I'm pleased about that. With regards to interest rates, I haven't been expecting a big drop in the federal funds rate. I think the economy is going to remain very, very strong.
Ed, I would argue, and I don't know if you agree with that, is that you said that despite politics, right, markets have been doing well, but actually you can sort of argue the other side as well, which is that it doesn't matter Republicans or Democrats, left or right or whatever. One thing everyone has understood is that you've got to keep the markets happy. Markets got to be up. And that's an important kind of a signal, which is important for the real economy, et cetera, et cetera. You'd agree with that, Ed?
Well, I think at the end of the day, politics doesn't matter as much as the fundamentals of the economy. And the fundamentals of the economy are certainly influenced by fiscal and monetary policy, but they are mostly driven by the corporate sector, the business sector, and workers, and that they continue to produce better and better economic growth, record highs in real GDP, economy growing better than expected. And guess what? No recession. No recession in 2022, 2023. I don't think we're going to have one in 2024.
Yep.
Okay, well, that is a strong statement and a very ambitious one at that. No recession in 2024 either, after what we've seen in 2022 and 2023. Hope that plays out, for the benefit of the bulls at least. Let's thank you on that note, Ed. Have a good weekend, and thanks for joining us on a Saturday. Let's slip into a quick break. On the other side, our entire team is also with us to give us a list of top 10 stocks. Stay tuned.
Coating the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage. Way to celebrate our own 25th year with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC-TV18, embarking on a quarter century of excellence.
CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key news makers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every All right, welcome back to Bazaar Morning Call. We have a full session of trade today and we have a full list of stocks to talk about. So let's get straight to it. First up, of course, Reliance will be in focus and you're seeing a lot of the brokerage commentary on your screen. But in the meantime, let me just take you through the key numbers. Now, this time around, there was growth across key operating businesses. The oil to chemicals business was under a bit of pressure, but that's also because of a planned maintenance shutdown. The consumer-facing businesses of Reliance is doing very well this time around. So if you look at the retail business, it was a stellar growth over there. The retail business EBITDA was up 31% year-on-year. Oil and gas posted its highest ever quarterly EBITDA this time. KG-D6 is now contributing to 30%, by the way, of India's gas production. Jio business was quite steady on all parameters. Revenue growth was 2.5% quarter-on-quarter. There was strong subscriber addition and that's what drove the top line growth as well. The EBITDA margins for Jio have been stable for the last 5 quarters at 52.4% and the ARPUs increased 2% year-on-year, almost at 182 rupees because of a better subscriber mix. The subscriber base as well has inched up higher to 470 million. So the consolidated numbers will come up for you on your screen. Largely a stable set of numbers, you'd have to say. The EBITDA margins have improved quarter on quarter. And as I said, the oil to chemical business was impacted because of the planned maintenance shutdown. But standard disclaimer, Reliance Industries is the owner of the channel that you're watching and will be reacting to their numbers today.
Okay, all right. Well, that one has been holding one end up. So let's see how that goes. But Manglam joins in as well. And when, we introduced everyone, Manglam, you were looking the most upset. But Maybe you had a big plan on Saturday, but HUL's numbers were more disappointing, I think.
Well, yeah, I was looking forward to the rest actually, post HUL and Reliance numbers. But tell you what, HUL numbers have been weak. They've been weak for the last 4 quarters. And this time around as well, not much was expected, but the company disappointed on that as well. Revenues shy of that 15,200 crore mark. The street was working with a number closer to 15,400 crore. EBITDA 3540 crores. The street was working again with a number of 3,700 crores. As a result of which the net profit was below expectations as well. Volume growth at 2% was in line with measly expectations of 2 to 3% as well. Gross margins, they improved by 400 basis points, but there was no improvement in the EBITDA margin because the company increased their ad spends by about 260 basis points across all their segments, be it home care, beauty and personal care. Revenues declined by about 1%, whereas we saw a 1% increase in food and refreshments itself. The management said the environment is challenging. They are navigating through this. And the couple of parameters that they'll be watching out for is rural income growth and how winter crop yields come out for them to decide whether there is some recovery in rural India or not. But for now, expect the stock to be in the red. It has been an underperformer, may continue to underperform until macro challenges are away.
All right. Mangalam, thanks very much for that. We'll, of course, play out Mangalam's chat with the HUL management a little later here on the program as well. But let's move on and talk about RBL Bank. Abhishek is here with details on this one. Abhishek, morning.
Morning, Prashant. So RBL Bank numbers on slippages actually disappointed. Slippages were at 666 crore, which is up more than 23% quarter-on-quarter. The annualized slippage ratio has now crossed the 3% level, 3.33 versus 2.84% in the previous quarter. Now, gross NPA and value-wise rose by more than 4%. However, in terms of percentage, gross NPA ratio has remained flat on a sequential basis owing to loan growth. Net interest margin was at 5.52% versus 5.54%. So that's another good point to take away. In terms of the performance versus our poll, the NII was in line with our poll. However, on account of one-off provision that they made with respect to AIF of about rupees 115 crores, the PAT came in below our poll. Back to you.
Okay, thanks a lot, Abhishek, for that. Well, Paytm also came out with its numbers. How did it look this time?
Well, Sonia, EBITDA improvement continued. Loans have declined on a sequential basis, which is a negative surprise. Total income was up 40% YOY and about 12.6% sequentially. The EBITDA, that increased by 7x on a YOY basis due to small base or lower base in last year, same quarter. And sequentially, it improved by 43% on a sequential basis. Contribution profit margin, that declined sharply sequentially to 53.3 versus 56.6% in the previous quarter. Net loss, that continued to narrow down. It is now at 222 crores versus 392 crore on a YY basis and about 292 crore on a sequential basis. The gross merchandise value, that's increased by more than 25% YOY and about 7.7% sequentially. The value of loan disbursed, that declined sequentially by 4.3%. Number of loans also declined sequentially by 12.9%. Back to you.
Okay, all right, Abhishek, and you've got a busy day with the other banking names as well that will be coming out, so we look forward to your analysis later on. But I'm looking at Tata Steel. Well, yesterday they announced, their plans with regard to the UK operations, and it's a step in the right direction, so expect the stock to react positively. Now, they're saying that they'll commence statutory consultation as part of its plan to transform the UK business that they've already announced. Now, they've given a couple of numbers now. Up to 2,800 employees will be affected owing to this. And they propose to commit in excess of 130 million euros as a support package for these affected employees. The UK government, remember, had already committed up to around 500 million pounds to enable the transformation, and they are committing. Tata Steel has already committed around 750. So that's pretty good news. So expecting basically the step in the right direction. So expect the stock to react positively. Yesterday it ended high with a gain of around 2.5%. But let's hop across to Ekta. Ekta, tell us about Fortis.
Well, yes, I expect Fortis to probably show some amount of negative reaction today because Agilus Diagnostics, which is basically their subsidiary in the diagnostic space, has received a notice on Jan 18th from the anti-corruption branch of Delhi. This is in respect to the alleged anomalies in diagnostic tests conducted in the Aam Aadmi Mohalla clinic, and they have sought certain documents and information from Agilus. Agilus has indicated that they've rendered services worth around 20.4 crores as of December 31st, 2023. The services are less than 2% of their consolidated revenue, and as of date, Agilus has only received a sum of around 3.3 crores from the Directorate General of Health Services of the Delhi government. Agilus continue to provide services in interest of the public at large. They sent various notices to the DGHS requesting release of outstanding payment of pending dues, and they have indicated that they just picked up samples, tested, carried out billing and reporting within the agreement. So I expect the reaction to probably be very limited for Fortis, simply because the financial impact is very limited of this.
All right. Thanks a lot for that, Ekta. That's on Fortis Healthcare. But we also have Suntech Realty that you should be watching today. Sonal is here to tell us the latest on that. Sonal, over to you.
Good morning, Sonia. Well, usually for real estate companies, we have to look at the pre-sales and volumes. But surprisingly, this time, they have not given it in the presentation yet. The presentation is not out after their numbers. So we do have the P&L where it looks like their revenues are down 52%. It is an EBITDA loss of 15.6 crore rupees versus an EBITDA of 18 crore rupees. They have a loss this time of 9 crores versus profit of 2 crores. But it is not entirely the way we should be looking at real estate companies. So we'll await investor presentation details where they will be giving the launches, the pipeline and the operation update for the quarter as well.
Okay, all right. Sonal, thanks very much for that. Let's move across and talk about Tejas Networks. Rima is here with details on this one. Rima.
Hi, good morning. So Tejas Networks has reported very strong revenue growth, but EBITDA losses for the company have expanded. So the company's top line growth stands at 41% quarter on quarter, and year on year, it's a growth of more than 100%. If you remember, recently the company had won a very large BSNL deal. So as the company executes on this BSNL deal, they are procuring a lot of components, they're investing in R&D, and that's the reason why the EBITDA for the company this time has come in as a loss of 7.5 crore, and even at the bottom line there is a loss of about 45 crore. The company has said that there is increased inventory that they are sitting on. As I said, it's maybe largely on account of procuring all the equipments which is required to execute the large BSNL order, and the order book for the company is in excess of 9,000 crore rupees. So the inventory this quarter stands at 2,683 crores. Back to you.
Okay, all right. Thanks a lot for that, Rima. Well, let's go back to Sonal. She's here to tell us about CESC. Sonal?
Well, for CESC, the numbers look decent on a sequential basis. There was a revenue growth of 2%. EBITDA grew 5% to come in at 963 crore rupees. However, profits were down 10% because of some level of higher expenses by the company as well. But the generation volumes, they were good. They were up 28% to come in at 1,535 million units. So that worked well for the company. So expect the stock to be in the green.
All right, Sonal, thanks a lot for that. Well, Credit Access Grameen also came out with its numbers yesterday, post-market hours. Let's find out how it looked. Abhishek is here with the fine print. Abhishek, over to you.
Well, Sonia, amongst lenders, microfinance seems to be the painful portfolio in Q3 FY24, with asset quality deteriorating across pan-India, like Tamil Nadu floods impacting the book of some of the lenders. This time, for Credit Access Grameen, the western part of India has actually impacted the asset quality. Gross NPA value-wise has increased more than 32.5% sequentially. The NII growth remained healthy at 48.5% YOY and more than 5% sequentially. Provisions were up 31.7% quarter-on-quarter due to deterioration in asset quality. PAT has increased by 63% YOY and by just 1.2% on a sequential basis. Disbursements remain tepid in terms of YOY performance, growing at just 10% YOY. However, sequential growth in disbursements were strong at about 7.5%. AUM growth remained healthy at 31.5% YOY and about 4% sequentially. So expect a red tick on the stock today on account of the deterioration in asset quality that you have seen. Back to you.
Got it. All right. Thanks a lot for that. Thanks to our entire team, actually, for giving us all of the data this morning. Here's a quick recap of our top stocks. Stocks with positive news flow. There's Reliance, Paytm, Tata Steel and CESC. While stocks with negative news flow, HUL, RBL Bank, Fortis Healthcare, Suntech Realty, Tejas Networks and Credit Access Grameen. Take a quick break. On the other side, Prakash Diwan will be with us to give us some fundamental stock analysis. We have lots to discuss, so don't go anywhere. YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube. A show that is unmatched.
We tell you stocks to watch out for and which sectors are impacted.
Thought-provoking.
In India, the allocation to equity is about 5 to 10%, which is not beating inflation. So investing aggressively can actually look at even beating inflation.
And will give you maximum value for your money.
It is a good time to look at debt funds as a category. There's no better time than this in that sense to lock in rates for the long term.
A masterclass with India's biggest market experts. Smart money at these times. The last hour. Anything can happen between the bells. But what happens during the last hour is what matters the most. The biggest market swings. A close-up look at what's driving them and how the investors are reacting. Watch the most seasoned market mavens guide you through the most important hour of the trading day. NSE Closing Bell. At these times, only on CNBC TV18 and CNBC-TV18.com. From David to Goliath, from the smallest business ventures to multi-million-dollar.
Welcome back. Good morning, and it's a Saturday morning. Hope you're having a good one. Prakash Sivan joins us on the show. Hi, Prakash. Good morning. How do you feel this morning? Good, I'm guessing.
I know what you want to hear, but it's okay. I mean, it's just that we've got to live with that shift in terms of the days that we work. So Monday being off, possibly will probably be a decent enough compensation to the hard work you're doing it today.
Oh. Okay, Prakash, so you've all revved up the engine then. So you're set. Let's get cracking. Reliance Industries, how do the numbers look? Sonia told us it was looking pretty good.
Oh, yes, of course. I think what people need to understand, and I'm sure people will, is that on a scale like this, to continue to grow, and now that, the transition is very evident and absolutely well established, there's no ambiguity around that. The customer-facing businesses have actually marched ahead with such promise that I wouldn't be surprised if retail starts getting discussed with a valuation which is, which is at par with global comparatives in terms of valuation metrics. The scale that they offer, the kind of price points that they straddle, the kind of product range which is covered is just phenomenal. So my sense is this is kind of these numbers actually very clearly tell you there's something which should happen in terms of a value unlocking on the retail side to begin with, and then possibly the digital business.
Okay, absolutely. I mean, the only thing, with Reliance, I was going through some of the brokerage notes. The capex has fallen to an 8-quarter low this time. And this is the slowest investment capex that the company has seen in the last 2 years. So that's just one thing to point out. But of course, consumer-facing businesses are doing extremely well, so no problems about that. Prakash, hi, good morning. Never thought I'd say this to you on a Saturday morning, but we just saw each other less than 12 hours ago talking about Reliance's numbers, and now here we are. We're also going to talk about HUL's numbers, right? Because those were disappointing and there are demand challenges. But as an an investor in HUL, what do you do now?
Good morning, Sonia. So, I do agree. There is definitely something amiss in terms of HUL, and I think that kind of represents the entire FMCG side, except for a Tata Consumer or a Godrej Consumer, which have different reasons to grow and kind of get attractive. I think the core businesses in the FMCG space are finding volume growth to be very difficult. So whatever they did in terms of price increases and grammage reduction and all of that has kind of played out. There's not much left in that war chest. Most of the FMCG players will actually now have to depend on demand resurrection, and that could probably be still painfully away at least 2 quarters post the monsoon if things look different there could be something else. So I would, if I'm an investor in HUL, I would probably move to an ITC because there are certain triggers that are very imminent out there, Sonia. Particularly the hotels business getting demerged out of that, carved out, will probably be a very positive spin-off. So you'll finally see a very clear FMCG-led business and, of course, hospitality business getting separated, and there'll be value accretion in both. So HUL probably doesn't have much of firepower at this point in time. So I would, but it could surprise us if the demand numbers start looking up because the base has been made. It's absolutely at a bottom.
Okay, what about Paytm? This time the numbers are good, the EBITDA has improved, the losses have gone down, and that stock has sort of come back into investors' radar. At this price, is it still a buy?
So it depends on what kind of timeline you attribute to this kind of a thing in terms of unlocking a value. So there were restrictions by the RBI that kind of brought things to a little bit of a slowdown. But I think their metrics have definitely been improving. So what happened to, let's say, Zomato when they realized that path to profitability is something which the onus is on them and not on the market or not on the consumer segment, that's exactly what Paytm is also doing. And remember, Paytm has a lot of other optionalities, Sonia. I mean, it's not just the payment transaction business. It's not just the loan business. They also have the POS business, which I've seen, as I keep pointing out, as a very promising area where they could kind of have some sort of a sway. So there will be all of these which will start adding to it, and then things start looking very different. So if you are willing to hold on for at least a couple of years, because the turnaround could take some time, it's very gradual, very slow, but it's distinctly finitely there. So it depends on that. But even if you don't buy it right now, I'm sure you're not going to miss out on too much of an upside. So let me also add that caveat.
Okay, all right. Prakash, what about the largest weight on the index? HDFC Bank. How do you approach it? At around this 1,470 rupees odd, there are lack of positive triggers, mind you. And the next few quarters, we'll still be waiting for management commentary. But at 1,470, if you give a value of say 230, 250 rupees at least to its subsidiaries, you're having the core business at around 1,250 rupees, very, very roughly. And they're going to do an EPS after being scaled down at around 97 rupees. You're getting one of the largest banks at just, sub 13 times its earnings. Valuations will support, lack of positive triggers, yes. But do you think downside is limited from here?
So Nigel, that's what happened. The market never obliges with a very linear, fair kind of a growth for any of the stocks. I mean, you have extremes of pessimism and this greed, which kind of between which we prevail, right? So what's happened is the expectations were very high when we went into earnings from HDFC, and people were woken up to the reality that it's just been a quarter for the merged entity to have flexed itself. They'd set the very clear expectation in terms of what, waiting for at least 3-4 quarters before the bad loans would kind of get ingested and digested and then kind of moved on. But one thing, the respite for HDFC, in my view, comes from, apart from, of course, the valuation being so soft and benign, comes from the statement that the RBI Governor made in the interview Shireen had with him, in Davos. So where he said there's nothing like a very clear, defined CD ratio that's been, attributed to the sector or been assigned to some, or been expected out of a company or a bank. Now, which means that, all this liquidity-related, CD ratio-related issues that we felt that the deposits aren't growing as much as credit has grown will probably come to rest. And in the meanwhile, the branch expansion that's underway could probably start changing the profile in terms of what they can mop up as deposits as the merged entity. So there's lots that probably time would heal. If you buy at these levels, to be honest, there's absolutely no risk on the downside. How much more it can go, the most of the selling's been done. And if inflows keep coming, which you would expect if things look up for the next couple of months, by March end, HDFC and some of the other banks would look very differently strong. So I'm sure there's more value than what it was at 1,550, 1,600 than as compared to what today. So look at it from that perspective, but give it time. Don't expect just to correct back to 1,700 in a hurry.
All right. Well, let's continue talking about some numbers, and we'll come back to you, Prakash, in a bit. HUL, right, reported a weak set of numbers. The EBITDA was flat despite a 400 basis points gross margin improvement. Mangalam actually quizzed the management of HUL at the Q3 earnings call, began by asking them about when they expect a significant recovery in the volume growth. The commentary was a bit sober as well. Listen into what they had to say.
So if you disaggregate our growth, and as you said, it has been in low single digits in the last couple of quarters. The fact is that we're coming off a inflation-deflation cycle, where clearly the response to the investments and price is taking some time to come on account of a few macro factors, which we have to also accept as a part of the context we operate the FMCG business in. For instance, the slow recovery in rural, although of course urban continues to be resilient. So we operate within a certain context where we are continuing to be competitive. And as Ritesh mentioned, 60% or thereabouts of our business is still winning market shares. And we are coming off on a very, very high base of market shares of the last 2 years. So we remain strong, competitive, even though the top line numbers are what they are optically. As far as volumes are concerned, if you disaggregate our volumes by our three businesses, our home care, beauty and personal care businesses are growing in single digits, in mid-single digits, which is our second quarter in a row. So where we have taken prices down, we already start to see a price response to volume, and volumes are coming back, including, of course, being helped by the slow recovery in rural. On food and refreshment is where we have negative volumes. That brings down the total number. And that is largely because a lot of that, the categories we operate in, food and refreshments, still have faced high levels of inflation. To name an example, coffee, even on HFD. And in tea, we are seeing some downgradation. So it's still coming on the back of high prices, although the increase in prices is beginning to sort of narrow and stop. So we do expect over a period of time this will lap. But as we speak, food and refreshment is where we do see the volume drag, although the heartening fact is that we remain very competitive on value share across all our big categories in food and refreshment. So that is something that gives me quite a lot of confidence that what we're doing fundamentally are absolutely the right things. We are investing behind our brands. Our brand power is strong. Advertising, which had come down over the last several years of high inflation, is back. We are at very competitive levels of investment. Brands have good product quality, and I feel that our distribution and operational grip is tight. So we are going to come out stronger from this inflation-deflation cycle. And all we are doing around building our business for the future, such as investing in beauty care, capability, and all of that is going to basically pay off in good stead. So I feel quite optimistic that all of these investments are in the right places, and we will see, as macros tend to improve, some turn in volumes as well. I would ask Ritesh then now to complete the question on the margin and how exactly the shape of investments that we are currently choosing.
Sure. And Mungib, just to further build on the few more elements. So as Rohit mentioned, the home and personal care and beauty and entire business put together has grown mid-single digit. Remember, this is 3/4 of our business. So already 75% of the business has registered mid-single digit volume growth. And it's the foods and refreshment, which is the quarter of the business, which Rohit explained, given commodity inflation, given a very different commodity cycle, which is where we've seen low single digit volume decline. And also, I want to call out the premium categories. If you look at beauty premium categories, if I look at the plus range within Horlicks, again, the premium part of HFD. If I look at newer formats, mask, serum, if I look at innovations like mayonnaise peanut butter. So these parts of the businesses are already showing double-digit volume momentum. So there are parts of the business which have shown momentum very different. And of course, certain parts of the business are dependent upon the realities of inflation, which is a different cycle compared to the rest of the business.
All right, we already got the view with regard to HUL from Prakash. But Prakash, what's your view on RBL Bank? We'll be chatting with the management later on in the show. But did you have a look at those numbers and how would you view this stock? You know, one point of time it was $100, $120. That was a good entry point, but now it's closer to 300 rupees. So your view. Prakash, I think we need to unmute you. We would love to hear what you have to say.
Yeah, I said, you know, RBL Bank cases that the valuations are such that it actually makes it more vulnerable to some sort of a correction. People are not going to like the fact that slippages are going from more than just one segment. It's not just credit cards, which was a culprit last time. It's, you know, microfinance, which is kind of letting them down. So, and there's not much of a way they can grow at a pace which in a tight interest rate regime, which will be very significantly different. So there will be some sort of a punishment that it will probably get from these numbers. There's nothing which is very encouraging in any of the metrics, Nigel. So I would be cautious and look at where the larger private sector banks are trading. Right? Even if you don't look at the top 4, you go to a step down and look at an IndusInd. There's nothing wrong with that. So you would rather buy something which is much more resilient as compared to something which kind of shakes your confidence every quarter. So I'm a believer. Bigger banks on the private sector are definitely something which you need to look at far more seriously than ever before.
Got it. All right. The other is I'm glad, it was a cue for me to ask you about the bigger banks in the private sector space, because last week the biggest talking point was HDFC Bank, right? It was the biggest weekly fall in 3 years. The stock was down 10% last week. Hand on heart, don't you think this is a great opportunity to buy HDFC Bank despite all of the volatility that we're seeing in numbers?
Oh, absolutely, Tanya. So as I said, where else will you get this kind of a valuation? Now, whether you want to buy HDFC Bank or not, that's the question. There's a lot of debate around why HDFC Bank at this valuation was, at the erstwhile valuation was so sought after as compared to some of the global banks like Bank of America and all of that. But people need to understand India is a very different market where this is one bank that has absolutely the right to win in terms of spreading itself, expanding itself. There have been technology letdowns, related letdowns, which they are plugging, I'm sure. So, there's lots that's happening. So all of that takes time. It's a turnaround of sorts after the merger. Two giants coming together. It's not something very easy. The earth underneath is going to, shudder a bit. And then that's what's happened. So my sense is you buy into HDFC Bank with a slightly higher expectation, give it some rope. Don't expect it to turn around in just a couple of weeks or one quarter. So that's the whole idea. But I don't think things can go worse than where it is in terms of valuation, with all the subsidiary valuation also kind of built in. And they are growing so rapidly, be it asset management, insurance, general life, all of it. So I don't see why that would be such a big issue in terms of growth not going ahead.
Okay, all right. Prakash, request you to stay with us. We'll come back to you. We'll discuss a couple of more stocks. For the time being, slip in a short break. Mitesh as well as Kush, they're waiting for us. They'll give us some technical trades.
Meet the movers and shakers, today's newsmakers, and tomorrow's leaders. Understand what makes markets move, how companies make quantum leaps, and how giant corporations stay ahead. Get the biggest business stories of the day, power-packed into 30 minutes on Business 360 at these times. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits, and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
On the back of the measures that you've already taken, and one involving the AIF, so there are representations being made by that industry, by the AIFs, etc., to the Finance Ministry as well as to the Reserve Bank, saying that perhaps there needs to be a review of that decision, or at least more time given. You've obviously, I would imagine, have heard from them. How do you respond to that?
You see, this decision is the result, is the culmination of more than 1 year of keeping track of the developments in the AIF sector. It's not as if suddenly something came to our notice and we acted. We have been tracking these developments for about more than a year now. Mm-hmm. And initially we saw some signs here and there. So when we see some signs here and there, we try to deal with it on entity-based approach. You know, our supervisors take it up with that particular entity and try to deal with it on a bilateral basis. But when we see something, becoming, showing signs of...
All right, we're getting set for Saturday morning. That's a working day, and the market, of course, is going to open in like less than 10 minutes from now. The pre-opening rate is going to kick in. We have Mitesh Thakkar and Kush Bora joining in. Guys, good morning and welcome to the show. Mitesh, you know, this market has good cues, right? I mean, you have positive global cues. You have Monday that's off. So a long weekend for many. But you tell us, what's your view for today?
Good morning, Sonia. I think, we maintained that bouncing back from 21,300 was a good thing. And we might actually need a good consolidation before we pick up the energy to start getting into an uptrend again. Not breaking below 21,300, I think, for the next few days would be the key. And I think that looks like to be the case at least today with the global cues on the stronger side, not on the favorable side. I think today the levels to watch on the upside for the Nifty, 21,750 is the first level which I'm watching. And then the gap down which happened with the HDFC Bank numbers, which is closer to about levels of 21,950, 22,000. I think that would be a very significant supply point. So my sense is that at higher levels around 21,950, we'll see very strong supply emerge and there's good buying around 21,300. So there could be a situation where in next about 6 to 10 sessions, we might actually be in this range. It will be a choppy one, but broadly, the markets will be slightly directional less and consolidate. Not a bad point, as long as we are holding about 21,300, buy on declines remains the strategy.
Absolutely. Gentlemen, morning. Kush, what are your thoughts this morning?
On the working Saturday or the markets?
Why don't you start with markets and then go on.
Sure. So, Annie, it might sound like to save some effort, Mitesh and I have exchanged notes. I can tell you we've not. Very similar view on the markets. Although I'm slightly bullish, the 20-day moving average might seem like, the first resistance as we saw yesterday. But for me, the stronger supply zone comes in at 21,750 and 21,800 kind of levels, where the Nifty spent a considerable time before sort of breaking up and, giving us a 22,000 move. So for me, 21,750, 800 is the kind of zone that I will watch for. And on the downside, as Mitesh said, I completely agree, 21,300 to in fact 21,200, that kind of zone. If that holds on, I think we should have a goodish kind of a January to end with. So I think for now, play the range. 21,800 is where I would book the profits if I've got a long position, and 21,300 is where I would look to buy again if the market slipped to those levels.
Okay, Kush, hi, good morning. What about individual stocks? What are you looking at? And I also want your thoughts on, Reliance, HUL. There could be some subdued moves here, but what do? Do you buy the dips?
Hi, Sonia. For sure. I mean, see, we've been bullish on Reliance for a while now, and we continue to remain. So there isn't anything on the chart suggesting that, this rally is perhaps coming to a halt. At best, we could see some sort of consolidation, I agree. But I think, from the perspective that Reliance is not typically a trader counter, it's an investor stock. You hold on to this one, whatever dip you get, anywhere, let's say close to 2,600, 2,650 also, if that happens, it's a good idea to buy. HUL is a slightly different setup right now, where the stock's actually not done too much in a while. So I would actually avoid this for now. In fact, just a quick word on HDFC. The stock's actually gone, into oversold territories on technical and derivative setup both. So I wouldn't be surprised to see a rebound on that. So play for a rebound on HDFC and then obviously does on the bank Nifty as well. As far as individual stocks go, two of them has been doing rather well. Why not stay with the leaders? So here we've got a buy view. 32.80, 33.50 are the targets that we're looking at. 31.50 is where I would place my stop loss. JSW Energy is another stock from the cash segment that we have on our radar. The stock's given a very clear breakout yesterday, and a volume-backed one at that. So 515, 530 are the levels that I'm looking at. 490 is where I would place my stop loss.
Mitesh, what are your trades?
So I also have more of buy-side trades today, Prashant. Good morning. The first one is a buy on M&M with a stop at 1630 for targets of 1710. Escorts is also a buy. Keep a stop below 2945. Look for targets of 3075 and a buy on Kings with a stop at 2080 for targets of around 2200. One sell call, that's Dixon. In the short term, the stock looks corrective, so keep a stop above 6170 and look for short positions to be taken with a target of 595.
All right, gentlemen, thank you very much for those trading ideas. But, I want to talk about the big, massive rally in PSUs as well. And Mitesh will do that in just a bit from now. We have to take a quick commercial break here. So let's do that. The pre-open should be with us when we return. And of course, we'll address the PSU rally from yesterday. Stay with us.
We had to act.
How widespread is the problem today?
No, I can't again quantify it, but there was this whole issue of evergreening that was taking place. So therefore, that had to be prevented. All that we have done is that we have also said we have not stopped any lending. We have only said that if you want to continue, you treat it as you treat it in a particular way and you provide for it in your accounts. And so that is what we have said. And some representations have come, they are being examined.
But could there be any kind of review as far as the
decision
is concerned?
No, I can't say. It is being examined. We have got number of representations. They are being examined. And with regard to the decision, it's a well thought out decision to prevent a kind of a new source of stress or a new source of problem for the Indian banking sector. Whether it is the industry or the private sector, or it is the the analysts or the economists or the serious the market players. In the context of India, I don't think anybody is expecting a rate cut now. In most of the advanced economies, the markets and the stakeholders and the market players, their assumptions, it is ahead, they're overrunning their central banks. So far as India is concerned, I think the thinking of the central bank and the thinking of the market participants, they are much better aligned. In inflation, with regard to inflation, I have said elsewhere that our policy has to remain actively disinflationary till we reach the target of 4% on a durable or a sustainable basis. You are right, absolutely right in saying that any premature pivot in our policy, it can be very, very costly for the economy. If you see the last 1 or 2 years, the deposit growth has been around 12 to 13%. Yes. The credit growth has been about 15%.
I just want to quickly welcome back as the pre-open is coming up. But the big rally in public sector stocks is what I want to just spend a minute talking about and just asking Mitesh for his opinion. So, if you can have these stocks up, names like RVNL, IRFC, IRCON, it was a humongous move. I mean, actually, these are pre-open rates now, so they don't show you. I'll read out what the rates were. RVNL ended 20% higher yesterday. IRFC ended 10% higher yesterday. IRCON ended 12% higher in trade yesterday. And I'm going through the railway list first. Railtel ended 6% higher yesterday. You had RITES, which was up 6%. So, it was a very large move. And then the non-railway PSU stocks, non-railway, non-banks. So, HUDCO, 15% move. You had IRDA, which was up 10%. The changes you are seeing right now are the pre-open. So, I'm reading out yesterday's price action. New India Assurance, right? I mean, it was a 10% mover in trade. And then you look at names like NBCC. NBCC was up 8%. REC was up 7%. GIC-RE was 16% higher. So it was a humongous public sector move. We talk about banks and the larger banks, etc. But the PSU space really blew the lights out. Mitesh, just a comment on these and what are you still holding and what way one can take trades and just chartically, how is this pack looking?
So, Prashant, I have IRCTC as a big part of my portfolio, but that's been doing decently well as well, not as good as compared to some of the smaller names. But I think all these stocks, if you look at the chart structure, they are now in an uptrend for about 6 to 8 months. I mean, this last leg of uptrend was started since last 6 to 8 months when we are seeing continuously a situation of prices making higher highs and higher lows. And that still, looks like continuing. While we are kind of now reaching overbought on weekly charts, there's no sign of stoppages yet. So my advice is that, just take the last swing low as your trading stoppers and keep holding these stocks. This clearly, looks like a very euphoric kind of a movement when very exorbitant valuations can also be tested. I think, you have those phases in markets when these kind of things happen. Looks like that happening with the PSU name. And I still believe that some of them will keep on offering trading opportunities. For example, REC, after a 4-week consolidation, when it had multiple highs around this 444, 445 mark, yesterday managed to just sneak above that and close above that. So if somebody wants to buy a fresh, keep a stop at 440. I think there's a good chance that we might see 490, 500 happening in this rally itself. So these will give you trading opportunities. And you need to wait for some consolidations and pullbacks to happen. But as of now, I think it looks like a market which is strongly enjoying a very euphoric uptrend, and typically it can last slightly beyond our imagination.
All right. Thanks a lot for that. Chandan Taparia is joining in. By the way, the currency market is also shut today and on Monday. So just an alert over there. Chandan Taparia of Motilal Oswal is going to give us some F&O cues for the day. Chandan, hi, good morning. Your thoughts on how to approach the markets today and what are the individual stocks you're looking at?
Good morning, Sonia. Thanks for having me. So if I look at the indices, Nifty is slightly positive, but Bank Nifty is slightly negative. So mixed cues in both the indices, given the scenario of selective banking stocks and outperformance in PSU and selective IT name. So as of now for Nifty, we have broader trading range in between 21,400 to 21,850. And for immediate point of view, if it manages to hold 21,500, we can attempt towards 21,750. So we need to play the range, but here we can go with buy on decline stance. But in Bank Nifty, picture is slightly different. We have seen a breakdown. Lower top, lower bottom is clearly visible. So we suggest to sell with the view that decline could be there. So Bank Nifty, we believe that weakness will be there until it holds below 46,250. It can drip down towards 45,000 kind of level. Now, looking at the stock ideas, we are recommending buy on BHEL. We have seen a good movement in most of the CPSE name. Most of the PSU stocks are doing well. We are positive on the power, energy, railway. So first it is buy on BHEL. This stock is up and above. At 12 years breakout level, major trend is positive. It is making higher top, higher bottom. So recommending to buy BHEL with a stop loss of 240 and expecting a run up towards 238 level. Second trading idea, that is buy on REC Limited. We are positive on the Nifty CPSE, and we believe that CPSE index itself can rally by 15 to 25%. So most of the power stocks are likely to do well. REC has seen good moment in last couple of months, and now after a consolidation of last 25 days, it is all set to give the fresh breakout. It managed to give the closing up of 450. Longs are added, so recommend to buy with support of 441 and expecting it to move towards 475. Last trading idea, that is not least, that is buy on Indian Hotel. Entire sector is set for a massive run up given the positive sentiment in the country. Indian Hotel is making higher tops, higher bottom. Previous resistance are turning as a support. We have seen fresh breakout and higher tops, higher bottom the weekly as well. So recommending to buy on Indian Hotel with support of 470, and stock has potential to rally by 5 to 7% towards 510 zone.
All right. Thanks a lot for that. Have a great day. Have a good weekend. By the way, the pre-opening session is kicked in, and one of the numbers to look at will be Reliance Industries. So let's get straight to it. The operating performance has been good across all verticals. There was a maintenance shutdown in the oil to chemicals business, because of which those numbers were slightly lower than estimates. But let's take a look at what brokerages are saying. Morgan Stanley has an overweight on the stock. They have a target price of 28.21. They say the results were decent, but Reliance reported the slowest investment capex in the last 2 years. Gas production is what drove an earnings beat for the company this time, and the debt was on the flattish side, which was good. CLSA has a buy with a target price of 3,060. They say capex falls to an 8-quarter low this time. Macquarie has a neutral with a target price of 2,450. They say the key positives this time was that the retail revenue growth was very strong, margins were very good over there, and it was a solid Jio subscriber addition that they saw. Nomura has a buy with a target price of 3165. They say the most important thing is that the Reliance has seen a sustained performance across their verticals, a healthy growth of the consumer businesses, and the sharp uptick in upstream as well. And finally, Jefferies has a buy with a target price of 3140. I think the moot point is that consumer businesses are doing very well. They talk about how there's a healthy subscriber addition in the Jio business. But Prabal Sen joins in. He's the energy analyst at ICICI Securities. He joins in to give us his view. Prabal, overall, after pouring through the numbers for about 12 hours, what has your take been, and how do you see the stock move?
Well, I think the numbers are again fairly solid. That's not really changed over the last 3 to 4 quarters. I think we have seen that that's the benefit that Reliance gets of having such a diversified business mix, that any one business's weakness, which in this case was the OTC segment, as you mentioned, because of the shutdown of several key units in one of the refineries, that was completely offset by the kind of strength that was shown in the upstream business because of the improvement in production, as well as, continued momentum in the retail as well as the geo businesses. So to that extent, I think the results were pretty solid. One thing that, also stands out, of course, is the fact that, CapEx has reduced quite a bit in this quarter. We'll have to see whether that kind of a slowdown sustains, because remember that the management has mentioned that some of the new energy facilities will start to get commissioned by the latter half of this year. So we'll have to see what the renewed capex run rate is over the rest of FY25. But if this is the beginning of a trend in terms of what the capex run rate is going to be, I think that will be a keenly watched monitorable, because that directly impacts the kind of net debt levels that you're sort of building in for the rest of the year. Those have been persistently high, for a fair while now. And if there's a from a flattish level now, if there's a sustained decline that starts to happen, then you're going to see that improvement coming through in FCF yields, return ratios, and whatnot. And I think that, to me, will probably be the biggest monitorable over the next 12 to 18 months.
Okay, thanks a lot for that, the overall, estimate on the numbers. But I just wanted your view on the stock as well, if you want to give us a target price, because the stock is at a good run. It's now, 5% away from its 52-week high. Do you think, given the steady business movements across the consumer-facing businesses, oil and gas not too bad either, can the stock sort of surpass those 52-week highs?
Honestly, to be honest, we are still reviewing the numbers. We have not released our update yet, so I won't be commenting on what our revised numbers are. At the point, before the results, we sort of had a target price of around 2600 rupees with a neutralish rating on the story. So I think there are two things that can probably drive the stock. One is, of course, the visibility on new energy businesses, I think, will be keenly watched, and that can be a good trigger over the next 12 months for the stock to move forward from these levels. The second, as I said, movements on net debt as well as return ratios and for FCFs, how that plays out. The third factor, I think, would be one of the things that the management did mention with respect to the OTC business, which still does drive cash flows to a certain extent, is that the petrochemical business continues to remain muted, while Reliance still does far better than any of its peers in the global markets because of the integration that it has across its downstream businesses. But overall prospects for the petrochemical businesses continue to be much more muted, and therefore that can offset a little bit of the refining strength that we are seeing over the next 2 years. So these three factors, the story around retail strength, the story around improvements in geo, I think those are something that will continue to be there and are probably built in to consensus estimates to a certain extent. But these three factors...
Since you're talking about positive surprises, there's one more, right? The wireless broadband services will be available across India now in the next 6 months. And the expectation is that there could be a jump in subscriber additions because of that. So there's a surprise waiting perhaps on the telecom business as well, you think? And will you add that to your, target price?
Honestly, our telecom team does build that in to a certain extent. And if I look at the ARPU estimates that we have, not only in terms of subscribers, but more importantly in terms of blended tariffs, since the pricing of some of those services, particularly in the tier 1 cities, is obviously going to be at a premium to normal mobile ARPUs. So once you factor that in, blended ARPUs should continue to improve quite sharply over the next 2 to 3 years. I think our base case estimates build in about 200, 210 to 220 rupees going through for FY25. So as and when that plays out, that's definitely going to sort of positively impact the stock.
Okay, we'll leave it at that. Thanks a lot for joining in, Prabal, and giving us your quick thoughts. So there is a decent set of numbers coming through and lots of positive surprises perhaps in the offing as well. Just wanted to take a quick look at some stocks. Let's look at Paytm. There, as we were telling you, the EBITDA improvement continues. The losses have gone down. There's a CLSA upgrade as well on Paytm. So that perhaps is one stock in pre-opening. It's up almost about 2%. So keep an eye out on that. You have Kotak Bank and ICICI Bank that will be coming out with numbers, and both those stocks are in the green. Remember, Hindustan Bank surprised with the net interest margins being on the positive side. Post that, there is a little bit of, positive sentiment in the other banking names as well. HUL from the frontliners is one stock that could be under pressure this morning because of weak numbers. And one pocket I'm looking at, because there's the big, Ram Mandir opening that you have on Monday. All of these travel and tourism stocks, right? Whether it's Indian hotels, whether it's IRCTC, a couple of smaller names as well, Indigo too, all of them are seeing traction.
Well, and all these railway-related stocks, Sonia, they're just, on fire. No one is pulling the chain at all to stop the train. You have RVNL, that's higher in today's trading session. IRFC, as you said, that one as well is higher in trade today. So quite a few of these names, they're moving higher, and they're moving higher on good volumes. Even Dhanlakshmi Bank is coming up with some big volumes. For the week, it's up close to around 24%. And in today's trading session as well, it's up close to around 7%. But Abhishek's with us, and he's going to run us through or give us a quick revision of Paytm's numbers. Abhishek.
We have CLSA on Paytm. They have upgraded the stock to buy from outperformance, and they have increased the target price a bit to about 960 per share from their earlier target price of 925 per share. They say that now Paytm is trying to diversify because BNPL is coming down. So companies are diversifying more after the scale back of BNPL that they did in Q3 FY24, which CLSA expects to continue in Q4 FY24 as well in terms of reduction in BNPL. So they say that company will try to offset the bulk of BNPL business lost by revenue streams that they are finding in new revenue streams, cost reduction, etc. So companies pushing higher ticket size personal loans in lending, and they plan to add another 5 to 6 partners over the next 6 months with respect to this. So high ticket PL will be more difficult to scale up as per CLSA view. They have increased the core EBITDA estimate by 3% over FY25 to 26. And Paytm is looking to grow in stockbroking as well as mutual fund distribution ship. So Paytm can make it big in derivatives trading as well as what CLSA has written. Back to you.
All right. Thanks, Abhishek, for that. Z, by the way, I just want to quickly point out, has issued a clarification. Z was down 7% by close yesterday. It's issued a clarification on reports which claim that Sony board will take a call on the $10 billion merger with Z Entertainment. Today, the company says that they're not aware of and cannot comment on any board meeting held or proposed to be held by Sony, and is committed to the merger with Sony. It's working towards the successful closure of the proposed transaction. The proposed merger company is engaging with Sony to discuss the extension of the date required to make the scheme effective. So that's coming in from Z at this point in time. I mean, day before yesterday, the stock had a big 6% up move. Yesterday, it sold off 7%. Kind of jumpy on this one. Traders are really all over the place over the last 2 or 3 trading sessions now.
Oh, absolutely. Let's take a look at the first tick on the index. Then remember, the Nifty has been, steady around the 21,700 mark. And that's where we're at this morning. The first tick on the index is up in the green. And in fact, 70 points higher now. Not too bad at all. Sensex is up about 210 points. Let's take it straight to the top gainers. The Nifty Bank, by the way, is also holding up with a gain of 0.6%. And what's leading from the front this morning, the advance decline ratio, by the way, is quite healthy at 1,094 stocks on the advancing side. Let's take a look at Reliance, HUL, and how they're reacting to numbers. Reliance, remember, the numbers largely were flat in line with estimates. So the stock is flat as well, not doing anything. HUL is the one that's dragging down almost about 3% because the numbers were weak, and the management said that the demand environment is challenging. Paytm, on the other hand, is the one that's up almost about 3%, reacting to a good set of numbers. Losses have gone down, EBITDA has improved, so Paytm looking good. And Hindustan Bank is also seeing some follow-on buying in its numbers after the kind of, in the stock, after the kind of numbers that it posted. So Hindustan Bank is up and about. Would be helpful to see what ICICI and Kotak are doing, given the kind of, given that today both will be coming out with their earnings. ICICI Bank up 0.4% and Kotak up 0.3%. IT stocks are also in focus. Kotak Mahindra is holding in the green, and a couple of other IT names also looking good. And then you have names like HDFC Bank, after being one of the biggest losers last week. HDFC Bank is finding some stability, finding its feet around that 1480, 1500 mark. So those are some stocks in focus. In the broader markets, names like CESC, Tejas, etc. under pressure. Nigel will take that forward. But for now, the opening is pretty decent. Let's see if the market is able to build onto these gains. But for now, green on the screen.
Well, that's right. CESC, that's a big loser. That's down close to around 4.5% in today's trading session. On the flip side, you have some big gainers. IRFC, what do you say about it? 175 rupees stock, 8% higher. RVNL, that stock is up 6.5%. Big move being seen out there. IRCON, up close to around 6.5%. So massive move is what we're seeing out there. EIL, I recall that around 200 rupees, Nimesh was talking about a potential big order that's coming in there. And we had highlighted this as well on Chartbusters, that the way the stock was moving, and we discussed this with Prakash Sivan as well, that maybe, past few years, it's been a bit of an underperformer. But that one, in fact, is bucking the trend. And I think in the last 20 days, it's up close to around 20% approximately. So big move is what we see on that one. NBCC as well, that one is up close to around 3%. And NHPC up close to around 3%. So quite a few big movers is what we're seeing in trade today. And to give you a data point on the Nifty Bank, we're moving towards the 50 DMA. That's around 300 points away from current levels, but it's closer to around 46,000. So that's good news. And on the Nifty, we have opened above the 20 DMA. So that's the other data point that I want to throw in there. RBL Bank will be joined by the management soon, but that's up 3%. Prashant.
Well, it's a good start, right? 75 points higher is what we have. The day's high, by the way, is 21,720. So, that 50% retracement is 21,704. So marginal crossover, throwover above that level. And then we've come off a little bit, but good. The question is, will around these levels, 21.7 and then 21.8, will this fizzle out, or, this is it and we've kind of put behind the midweek turbulence that we saw earlier? We were talking about, and we put that question to Mitesh earlier, some 12-odd PSU stocks, right? We can have, if you can pull the hot boards up, it'll give you a snapshot picture of what's happening across that pack. And you'll get a real sense of what's happening. Nigel was mentioning about some of those stocks, but maybe if you can have those, those sort of stacks up, stock stacks up. RVN, there you go, on your screen. This is the pack, right? RVNL, IRFC, IRCON, big gains between 7 and 11, 12%. Railtel, RITES, 5%, 3.5%. And then the ex-railway stocks, but PSU ex-railway stocks, HUDCO 3%, IRDA 6%, New India Assurance is up about 3% or so. There'll be more. There's NBCC 3%, REC is a little starting 0.5% higher. GIC-RE went up massively yesterday. It's up another 3.5%. So this is the pack to really focus on. And, it's just absolutely incredible. What I suspect perhaps is happening, there is, of course, a lot of retail and HNI participation that's essentially predominant here in this space. But I think not today, because, mutual funds are not working. But overall, I think there has been a fair bit of fund pickup as well, fund activity pickup as well. Guys, if you remember, on our birthday, the CNBC-TV18's birthday, on the 7th of December, we were speaking with Sridhar Shivaram. And we did that chat from the newsroom floor. And he said, well, the idea would be not to try and pick this or that in the PSU space, but buy a PSU fund.
Yes.
And I was just looking at, from that day, the index is up some 16%. From the 7th of, So, I think there is that, because there are fund houses now offering specific PSU schemes.
Yeah.
So I think fair bit of, and they are getting money every month, right?
Sridhar, in fact, a year and a half ago, he was on our show Smart Money. And at that time, nobody was touching PSUs. And at that time, he said, this is the time when you should be buying PSU stocks. It was a brave call, to be honest, at that time, but it did extremely well. And now just look at where it
I'll just chip in with the point on PSUs as well. And I did this piece on Editors Roundtable. 3 years ago, the entire PSU basket was 15 lakh crore rupees. Today, it is around 55, 56 lakh crore rupees. But at that point of time, the entire pat that you were getting from those PSU names was around 1.5 lakh crore. So you're saying, yes, the market capitalization has gone up by close to around 4.5 times. But in fact, the earnings as well have gone from 1.5 lakh closer to around 5 lakh crore odd. So that valuation, if you're talking about on a PE basis, this is the entire space, right? Put it all together. It's still trading at that same 11 times, 11, 12 times. So the PE re-rating has not happened, if at all it had to happen. Earnings have gone up in proportion with the prices, and that's just...
One more thing. You were talking about, Nimesh did a piece and we put that up, we did that on Editors Roundtable yesterday, that over the how P multiples have moved over the last many years, right? But the point is, I was looking at this Kotak note, and what they do very nicely is they give you what PEs were starting 2011. And you look at across sectors, everything was 14 times, 15 times, everything is now 30 times, depending on what sector you are.
Yeah.
So it's just that PSUs have also done well, and they've also gone up. But I think there is this aversion, right? I mean, the mental makeup with regards to PSUs as well. PSUs, these are the
Why
guys,
would you, yeah.
and the general kind of perception is these are the last things to move in a bull market. I mean, it signals this or that.
Yeah.
So that's been traditionally how they've looked at. But I think the point is that profitability has also gone up quite a bit, as you said.
Yeah.
So I think one needs to make account for that and not just kind of fall back on easy explanations, which is that P multiples have gone up because they've gone up for pretty much all sectors across the board.
Absolutely. I just want to make one point on IRCTC as well.
Yeah.
That stock is up almost 3.5%. In fact, let's take this question to Dheeraj Agarwal, Managing Director at Ambit Investment, who's joining in now. Dheeraj, you know, this entire space, right? I mean, not just PSUs. We're also talking about how there's now religious tourism, which has become a big thing, and, you know, names like IRCTC benefiting from both those themes, right? What do you do here if someone has missed this rally entirely? Does it make sense to take fresh positions here?
Well, if we're talking about the PSU as a basket and not just IRCTC in particular, I think PSUs as a basket were almost trading at bankruptcy valuations in 2020. I was actually tracking the price to book ratio for the BSE PSU index. And 2019-20, the price to book was 0.6 to 0.7 times for the entire PSU basket. A number of companies were offering dividend yields of double digits, 10 to 12%. And at that point of time, the usual investor refrain used to be that many of these companies, the terminal growth or terminal value is zero. So the price to book or price to earnings, the dividend yields don't matter. That narrative has totally changed now. And I think that there are more legs to the entire PSU rally. So from 0.7 times price to book, the BSE PSU index is now 1.6 times. The previous peak that we have seen in 2007 to 10 cycle was almost 2.7, 2.8 times, almost close to 3 times price to book. I don't know if it goes there, but I mean, who knows? The second thing is that every bull market, if you notice, there is one or two asset classes which actually keep running till the time it enters some sort of a bubble or a hugely overvalued zone. So the previous bull market was driven by quality. The current one is driven by PSUs, a bit of capex and mid caps. So I think there is more to come.
Okay, Dheeraj, hi, good morning and good to see you. Well, this market doesn't oblige consensus, right? And the consensus feeling at the start of this year was banks will do well. And if banks have to do well, what about the largest bank in there? Shocker coming in last week, right, from HDFC Bank. Now, the point is that maybe lack of positive triggers, but is downside limited from here? And would you look to get in at these levels, given the valuations, given the pedigree, given the quality of the bank?
Even I was on the camp that banks should do well this year, given 1 year of underperformance. In fact, last month on your show, I said
yes,
banks should come back this year. But I'm questioning that view at this point of time, and in fact, almost doubting it, because the few results which have come out very clearly show that there is tightness and liquidity which is showing up in banks facing difficulty in growing the deposit book. So we have known this for a while, that the credit growth has been stronger than deposit growth. The deposit growth needs to pick up in order to either maintain the credit growth or the margins will have to take a hit. This is now finally playing out. So I think there will be some more adjustment time for this process, either through some more margin contraction or even credit growth slowing down a little bit. So best case, I think banks bouncing back is now pushed to second half, if not next year.
Got it. Dheeraj, hi, good morning. Good to have you here. Just a quick word on IT services, where, if you look at growth expectations, right, except maybe a Persistent or a Tata Elxsi, if you look at pre-COVID growth, 3-year growth pre-COVID, all the way till 2019, and look at growth estimates for 2024 to 2026 or so, except these 2 or 3 names, and throw in a Cyient there as well, growth rates forecasted are actually, meaningfully lower as compared to the pre-COVID growth rates. What's your sense on this pack?
So in the last 1 month, especially, IT has benefited because banks have come down. So remember, we are seeing a very clear pressure on consumers, especially FMCG. So we saw HUL results yesterday with the volume growth of just 2%, and we've been listening to the commentary for the last 3 or 4 quarters now that rural will revive at some point of time. But at this point of time, there's a lot of skepticism and disbelief out there. So keep FMCG out. So that leaves only 2 large sectors, IT and banks. And this has actually been happening in the market for 4 or 5 years now. If one sector is under pressure, the second one automatically sees some inflow. So, but you're right, growth is under pressure for IT. I think the big sort of the judgment day for IT is going to be the December quarter results, when there'll be a much better sense on what the budgets for next year look like. There is still a divided house at this point of time on the street. Some people think that the growth will rebound in FY25. Some people think it will not, or not by meaningful margin. I would tend to be slightly in the second camp, because if everybody is expecting the US economy to slow down and the rate cuts to happen, it's difficult to envisage that IT growth will pick up in a very strong way.
Okay, well, for the market, I mean, the mid-cap end of trade is really surging right now, 350 points higher. And look at the way stocks are moving. RVNL is up 10%, IRFC is up 9%, IRDA is up 9%. The entire PSU basket is looking pretty good. Particularly, Dheeraj, I mean, just coming back to, we spoke about the PSU basket overall, but coming back to some of these themes, there's the renewable energy space, right? IRDA has had a fabulous run since listing. There's the railway space particularly. Do you think that it's too late to get in here, or do you think there's more scope now?
A few of the specific names, one has to look at the numbers and the valuations and be a little careful whether we're already discounting 6-7 years of good performance this year itself. Overall PSU theme, I've clearly said that I think there are more legs to it, but with each individual name, when a theme plays in the market, I'm happy to consider that the stocks will go into a little bit of a bubble zone. So I really like George Soros's quote when he said that when I see a bubble forming, I rush in to buy, add some fuel to the fire. So that might happen. We've seen bubbles forming in other parts of the market in different cycles, different bull cycles. This will also eventually form here because this has become the darling of the market. But I'm not commenting on each individual name whether they're buys or sells here. One will have to take into cognizance valuations with respect to earnings growth.
Okay, all right, Dheeraj. Well, good speaking to you, Dheeraj, today. Thanks so much for joining in on a Saturday morning, giving us your view on various sectors. Wishing you a good Saturday ahead, and let's hope this trading session continues to, be as strong, because we have a fair bit of green on the screen. Well, Hindustan Zinc, that's the other one that came out with its set of numbers yesterday. The key positive for it was that the cost of production has fallen by close to around $200 per ton in the last 4 quarters, and that's something that the street liked. In terms of, the float that's available in the market is very limited. Vedanta has 65%, Government of India 30%, and a couple of institutions have 2%. So basically, there's only around 3% float in the market. But to understand what went on in the past quarter, and more importantly, this cost of production is looking good. What's the way ahead from here on? We are joined by Mr. Arun Mishra, the Chief Executive Officer at Hindustan Zinc, who joins in on the show. Hi, Mr. Mishra. Good morning, and thanks so much for joining in. Well, zinc prices have recovered sequentially, but part of the West is still a little bit sketchy in terms of growth and demand. What does this mean on outlook on zinc prices?
I think looking at Europe, recovery has not happened, and I think Europe will remain largely muted even in this quarter. The US is doing well and will continue. China has not fired its engines the way we thought it would, with the government announcing spending on infrastructure and all that has not happened. So in all probability, next quarter also we would see a range between 2,500 to 2,600 only, most probably between 25 to 2550 kind of a number, unless suddenly China starts consuming or in a big way. So it will remain. I think next quarter also we'll see a number 25 to 26 only.
So you're gradually ramping up your capacity. Can you give us a couple of guidelines? What kind of annual rate are you going at currently? How do you see yourself ramping up towards that 1.2 million tons by 2025? Give us any kind of timeline on how you see things improving.
So current if you see the mined metal capacity, we are absolutely at the level of 1.2 million ton of mined metal capacity we have. Finished metal capacity this year we will meet the guidance. However, next year is the one when we will actually be trying out about 1.2 million ton of metal making capacity. It depends upon the business plan that we produce. We are currently working out the business plan. It will require quite a good number of low investment, quick payback, debottlenecking kind of projects to be completed. And so we are working that out.
Right. So talking about the silver fumer has got commissioned. What are the odds you sort of beat the guidance you've put out on board since the plant, the fumer plant, is finally commissioned?
We are not changing our guidance on silver as of now, although fumer has been commissioned, but it has its own teething troubles. We guess it will stabilize in Q4. We are supposed to produce 30 tons of silver in a year. So if we get 1 quarter benefit, it would come to about 6-7 tons of silver only. So I'm not adding much to the guidance that we had given. We'll remain largely at the guidance. Of course, next year, when we do the production numbers of silver, we will see a better number than what we have produced this year.
Well, Mr. Mishra, Coal India is ramping up production, so sourcing as well for you would be much better. Give us the current sourcing mix. What is the desired mix? And how much are you getting of what you want?
So from last year, last year, Q3, our cost was quite high. And from that, we have come down by about $200 in this quarter, largely because we took structural steps in between. As I promised last year, our power plant were ideally designed for 23 to 30% of domestic coal only. We have modified the ESPs of the power plants, and now we are able to consume up to 45% of domestic coal. And it has helped us to reduce cost of power very, very drastically, and which is reflecting in the overall cost of zinc production that has gone down by $200. It will continue. We will, depending upon the availability, if I give you the number, in Q2, we had 45% of the mix was domestic coal. In Q3, however, it dropped to 30% based on the availability of domestic coal. So we are ready as long as Coal India is able to supply us more and more domestic coal. We can consume up to maybe 50%, and the power cost will reduce further. Next year onwards, we will start getting the RE power, which will again reduce the power cost. So we are looking at structural cost reduction and journey to $1,000 kind of a number going forward, maybe year next.
Since you mentioned $1,000 per ton cost of production, Mr. Mishra, by when do you get there?
This quarter, we are at about 1,095. So we are quite close. Less than 1,100 number now we have come. So it's just maybe next year when the RE power comes and coal quantity increases, we should be close to $1,000 by next year.
So is there any fresh proposal to buy Vedanta's international zinc from HZL?
We are focused on growing Indian business, and Hindustan on the zinc international business. We have recruited a very capable CEO to run that business and grow that business. So they are growing on their own, and also our copper mines in Zambia starting up, but that's for Vedanta to comment. As far as Hindustan Zinc is concerned, we are not currently looking at acquiring that property anymore as of now.
Well, your shareholders will be happy, if you're not going to be doing that. But give us some more details. By when can we see action on that segregation of entities like silver?
Our design is ready. It's not an issue. And for Hindustan Zinc, segregating into two different businesses, zinc and lead and silver separately, is very much easier because the ownership pattern doesn't change. Most of the silver comes from SK mine. Most of the silver gets produced through Dariva smelter. So assets are also earmarked. It's just working through the papers. As far as ownership doesn't change, government's holding doesn't change, flow of dividend doesn't change. So it's much easier work than what we think.
Mr. Mishra, give us a little bit more. Give us a timeline. By when will you be able to close out this segregation of businesses?
We should get government's nod by next board meeting, which is in April, and then by first quarter, we should be able to close the work.
So by when will you be able to close this segregation exercise?
Our ability to generate cash has not changed. It's the question of without spending the cash and keeping the cash in cash reserve. So now we are also investing in our growth project, like we are putting up another roaster, we are putting up fertilizer plant. So all that investment we are making, at the same time we have given dividend. Our ability to generate 49-50% EBITDA does not change. We are one of the lowest cost producer among the top 10 zinc making companies in the world, and we'll continue that cost position. So nothing changes as of now. Giving dividend, not giving dividend is a matter for the board to decide. I will leave it at that.
But you'll have to give us some outlook for FY24 on the dividend front, that given that there's now no big cash balance on the books.
That's for government to decide. To me, if you ask me, if we allow the demerger to happen first, then perhaps the disinvestment of the OFS will be much easier to disinvest part of silver company and part of zinc and lead company separately to separate set of buyers.
All right. Thanks a lot for joining in. Appreciate your thoughts. By the way, the market's still holding up quite well and big moves coming into the PSU names yet again. When we come back from the break, RBL Bank will be on our radar. R. Subramanian Kumar, who's the chairman of MD and CEO of RBL Bank, will join in to put focus on their Q3 earnings. Stay tuned.
Welcome back. Things are looking good, but could have been better, right? I mean, we started higher and we've got about 50 odd points left. After a crossover of the 21,700 mark, we are 30 points under it at 21,670. But earnings, of course, are keeping us busy. RBL Bank is the next we're going to talk about. The third quarter earnings came in slightly below street expectations. Slippages have gone up. They're about 3.5% or so. Asset quality has deteriorated. Retail loan growth momentum looks strong. We have the management, Mr. R. Subramanian Kumar, Managing Director and Chief Executive Officer at RBL Bank, joining us to take some questions. Sir, good morning. Great to have you with us here. It's always a pleasure hosting you here on CNBC-TV18. Prashant, this side. Just talk us through some of the basic hygiene aspects. One, that provision against AIF investments of a little over 100 crores or so. I think that has curtailed sort of profits in the quarter, returns in the quarter. Talk to us a little bit about slippages as well in terms of, what is the breakup that you saw?
Good, Prashant. Thank you. Good morning to all of you. So first of all, this quarter has been an exceptionally great quarter for RBL. And some of the parameters, especially in the profit parameters, if I just set aside the AIF for the minute, the PAT grew by 50%. And sequentially also is grew substantially high. And ROA was as per the guidance at 1.03. However, the AIF should be looked from slightly a different angle, because this is a new direction which has come from the regulator in respect of the investments made in AIF. If the downstream, the AIF has given to the borrowers, if the customers are common between the bank as well as them, you have to either liquidate it or you have to provide for. The time available was 30 days, and you will definitely agree that it is too short a period for such a liquid fund is to be taken care. However, our investment in AIF is to be, it is a long term, it is highly disinvested funds where we have gone in. Our exposure is only 4 to 5% of the total. And we have the relationship with all these funds for the last 8 to 10 years. And we don't see any stress in those assets with which we have also been exposed to, where the AIF is also exposed. And it is extremely diversified fund. And nevertheless, we wanted to be on the right side of the direction. So we went in for the provisions of 115 crore, which is out of total 121 crores, which we have invested. 115 is eligible or entitled to be provided for, which we have provided. So if suppose I keep that aside, the profit growth has been exceptionally well. Now coming to the point, what we said about the slippage. First of all, the slippage is not alarming. Yeah.
So, sorry, just the slippage, before the slippage thing, you said AIF investment is 4 to 5%, you said?
No, the AIF investment in the funds in which we have invested, our share is 4 to 5% out of the total fund size. Okay. It is not ours. Ours is total.
Yes, that's what I thought. Yes, go on, sir. Go on with the slippage number. Yeah, the slippage breakup.
Yes, Prashant. See, as far as the slippage is concerned, it isn't alarming. There are two major reasons why the net slippage has slightly went up and the gross slippage has slightly gone up. It is in respect to the two factors, that is our credit card and microfinance. And we were a little prudent in respect of expanding the unsecured portfolio in 5 states, especially in microfinance, where it was put into elections. And that really, the growth was flattish. That's number one. The second, the recoveries in, because the festive season and all of the disruptions in this, some of these states, our recoveries were not to the extent what we have been planning for. However, in the month of December, we revived back. Our collection efficiency has gone back to our plan of 99.4%. And in December, our microfinance collection is 99.4, leaving a very little for forward flow, and that is under control. Similarly, in respect to the credit card, also bounced back to that recovery position and the collection position as we have been doing it before Q3. As such, this small 0.62% of the net slippage isn't alarming. We are pretty confident that whatever the recovery we will wish to do it in the Q3, will be able to claw back in Q4, and we'll be back to our the normal position. However, when I just relate this slippage to the credit cost, we are well within the range of guidance. We will be with the credit cost between the 1.5 to 2% of the guidance what you have given. At the maximum, it will swing between 1.6 to 1.8, and we are confident of maintaining the credit cost guidance as well.
Okay, so confident of maintaining your credit cost guidance as well. Mr. Subramaniam Kumar, good morning. This is Sonia here. Right. I think what really worked well is that the retail loan growth has been very strong this time. I mean, just look at the numbers, 33% year on year. Is this a loan growth that is sustainable over the next few quarters? And what has led to such a sharp pickup in retail loan growth? And what's the outlook for the full year?
Morning, Sonia. See, we have guided right to the beginning of the year itself that our focus is going to be on a retail and more so on the secured retail. We created a complete structure for that. The first what we did, we created a product which are not on the shelf of the bank. All these products were taking a time for establishing systems, procedure, processes, and keeping people on the floor. That took on a couple of quarters. And now all of them have started picking up. For example, if I tell you, my total disbursements in retail is around 6,000 crores, which was somewhere around 4,000 crores 2 quarters before, and exactly a year before, it was somewhere around 2,000 plus crores. It is because of the fact retail housing, retail LAP, that is a mortgage loan, which was one of the major focus area we were able to thrust upon. Since we have originally we started disbursing these loans at 68 locations. Now we have expanded that to 186 locations as we speak this quarter, and which will start paying us or which will enable us to build this portfolio in the coming quarters. So we are confident that we will be able to maintain we sustain the growth rate in the retail. Our guidance was that the total advances will grow by 20%. Within that, the retail grow in the range of around 25 to 30%. And within that, the secured will grow at 30%, which we are confident of doing it. In fact, this quarter, our secured retail grew by 50%, albeit the low base. And although we may not be able to do 50% quarter on quarter, it will never be below 30% what we have guided the market.
All right. Hi, sir. Good to see you. And Nigel on this side. You said you're confident of maintaining the credit cost guidance. What is that number for FY25?
It is in the range of 1.5 to 2%.
Got it. All right. So that's out of the that's out of the way. All right. You know, the CD ratio currently for you, I think it's in excess of 85%. Have you heard from the regulator? Has RBI told you that they would like you to bring it down to a particular level? Any communication?
See, we ourselves are conscious about this credit card, CD ratio, as per our strategic discussions within the board, as well as what we have communicated to the market as well, is that we will be in the range of 85%. When we talk about the CD ratio, I would like to have a different perspective to be seen. We have an option of drawing our refinance for funding our loan growth, and we are also having a long-term FX. These two are long-term and it is sustainable. So when I try to do this refinance, we have seldom made use of it in our earlier avatar. We have just started using that for funding our growth. If I combine the deposit and the borrowings, refinance especially, and the ratio will be in the range of 73%. Having said that, our focus is we have made it very clear that the branch-based deposit growth
which we saw 23% in last quarter, will be able to fund our incremental advance growth of 20%. Hence, we don't see any stress as far as the growing the book is concerned. And our CD ratio will continue to be in the range of 83 to 85%. When we combine the refinance, it will be around 73 to 74%.
Mr. Subramanian, just on that point on branches, right? I remember reading this note from Spark event as the broker, and the analyst there was had written a note basically saying that, you know, the fact that you are going back to branch basics is going to be a big game changer for you. Can you just explain that point? Essentially, the point was that your branches were essentially were focused on liabilities in a very big way. Most of the advances were coming through DSOs, etc. And now that is going to be it's going to be done via branches. Could you talk to us what change will this make, not just in the near term, but over the medium term? And if this is correct to begin with, go on.
Yeah. See, traditionally, the bank has been using the branches for the purpose of mobilizing the liabilities. So you have a restricted way of doing it. Then we made an analysis and find out we have to leverage this investment which we made it in the branches. So in order to leverage that, we need to have the retail product. So we have just launched the product, around 7 to 8 products which we have launched it. And now all the branch people were facilitated for sourcing the leads for the retail assets. The retail underwriting, risk underwriting continues to be centralized. There is a separate credit department work on it. So all these branches hitherto looking at the liability as a source of mobilizing in their area of operation or catchment area, they are now started working on. Just to give a pointer, a year before they were not able to generate any leads for retail. Today, out of whatever the monthly logins we get, 25 to 30% of the logins are coming from the branch itself. This is going to provide two things. One, the productivity of the people deployed at the branches is go up, and which will in turn help us to manage our investment efficiently. The second, it will also provide us an opportunity to get the liability people on floor. Asset-led liability is another important strategic move which we have done. And this particular action has given us a lot of positive shootouts. And what we have seen is the number of customers who are being enrolled at the branches has doubled in this quarter over that of the corresponding last quarter, which itself is an indication that the strategic direction is right. In addition to that, what we have done is we have a subsidiary which is having around 1,200 branches. All these subsidiary plus BSE put together is having 1,200 branches. And what we did, we identified 800 such locations, which we can leverage for the purpose of sourcing our liability. So now these touch points, we are moving away from the branch base to that of the branch touch points of the RBL, which we have said that. So 800 locations will be provided an opportunity to do the business through digitally enabled savings fund, digitally enabled term deposit. And these, they will be in their catchment area, they will be able to source it. I give a simple statistics. Out of this 800, even if they mobilize at 10 lakhs per month, 800 into 12 months, they will be able to add not less than 4% to my total base of the deposits. So this is an opportunity which we wanted to reap in, and the work has already started. The pilot is has been launched in some of the geographies. We are looking at the system issues and other process issues. Once it is streamlined in this quarter, and this will be also add up to our ability to add deposits in the bank.
Okay, all right. Final question, sir, before we let you go. Actually, final couple of questions. What is the ROE target that you have for FY 25-26?
Instead of getting into the ROE first, I'll start with the ROA. We wanted to have an exit of around 1.1 to 1.2 this year, and there will be an increase of 20% year on year thereafter. And thereafter, with a leverage of around, let us say, 9 times, you'll be in a position to have at the end of 26, as mentioned document, which we are working also around 14% of ROE at the end of 26. This is what we have been aiming at, and we are on track.
14%?
Yes, on 26 FI exit.
20. Okay, got that. And any plans to raise capital?
See, right now, our capital adequacy is well maintained. In fact, this time, even after the sequential growth, we consumed around 65 bips. Even after the regulatory directions of increase in the RWA, we are confident, and we feel with this, we will be in a position to manage for next 6 to 8 quarters the capital sufficiently available with us.
All right, we leave it at that, sir. Thanks a lot for joining in. Appreciate your time here on CNBC-TV18. Very optimistic there. That's RBL Bank up about 2%. But 2023 was a great year for the PSU stocks, with almost 34 of them seeing gains of over 100% in the past year alone. Nimesh, our colleague Nimesh, yesterday in our Editors Roundtable show told us how valuations are looking like for the PSU stocks. So let's revisit that.
The PSE index has rallied 81% in calendar year 2023. And they've added nearly 22 lakh crores in terms of market cap. The entire PSU basket has added nearly 22 lakh crores in market cap only in the last 1 year. If you look at the big gainers, the 1/3 of the PSU basket, which is 33 companies, have rallied between 100 to 300%. That's the kind of move we've seen in the PSU baskets in the last 1 year itself. Now, I'll just break into the different sectors now. The first sector I'm picking up is railways. Nobody knows where the train is going to stop. But just look at the rally and the kind of valuations now. I just want to put a word on the valuations. IRCTC, it's trading at 55 times on the current year valuations. Ircon, which has been the big mover, that's now trading at close to 18 times. RVNL close to 32 times, and RailTel is now trading at 35 times. I don't have the 5-year average for these companies, but this is the kind of valuation you're giving for the railway PSUs now. Next is look at the capital goods space. BHEL, that stock is, after rallying 155%, is now trading at close to 50 times. We don't have an average for that as well. HAL is now trading at close to 31 times versus the 10-year average of just 10 times. RITES is trading at 20 times versus the average of 12 times. And BEL is now trading at close to 34 times versus the 5-year average of 16 times. So that's the capital good basket, how they are trading at after the big rally in those stocks. The third is the power stocks. Look at the power stocks as well. NTPC, NHPC, SJVN and Power Grid. All are now trading in double digits multiple for current year valuations versus the 5-year average of all were trading below they were trading in single digits. Now all are into double digits. SJVN is now trading at 22 times on current year price to earnings. Now look at the finances of the PSUs. IRFC, the biggest mover of 2023. That stock is now trading at 4.2 times price to book on current valuations. You know, I don't think many of the, even private banks are not quoting that sort of valuations. REC, PSE are almost at 2 times now, which historically they've been trading at just half time in the past. So it's been a big move in terms of the power PSUs as well. Now look at the banking. This is an interesting chart. The PSU banks, despite the rally, look at the valuations now. SBI trading at 1.4 times, the historics around 1.4 times. So it's not trading at exorbitant valuations. Bank of Baroda, Canara Bank, all trading close to one time price to book. And historically, they've been close to one time or half time price to book. So in terms of valuation, the PSU banks are still not very, very expensive even after the rally. And same is the case with the OMCs as well. Look at the OMC stocks. They all have rallied and the momentum just continues. But even in terms of valuation, HPCL is now trading at close to 8 times. Historically, it's been trading at 4.5 times. BPCL, after the rally, is now still trading at 8.7 times, whereas historic has been around 10 times. Same is the case with IOC as well. The only outliner in that OMC basket is Chennai Petro. That is now trading at close to 8 times on current year valuations versus the historical average of around 2 times. So, again, as I said, the entire basket has done really well. The PSC stocks have added nearly 22 lakh crores in market cap, but keep an eye on the valuations. Some of the stocks are now trading expensive than even the private company stocks.
Interesting piece as always by Nimesh. And just to give our viewers one more data point, the total PSU market capitalization as we speak with the movement in today's session is at 60 lakh crore rupees. And to give you a context, 3 years ago, it was 15 lakh crore rupees. So 3.5 years or so ago. So there's been a big surge in terms of PSU market capitalization, 60 lakh crore. That's the latest number that we have post these big moves that we're seeing. But let's get you another big voice. Apollo Hospitals has launched its first AI-powered oncology center in Bengaluru and plans to expand with 25 more AI-run centers across the country. Ritu Singh caught up with Sunita Reddy, the managing director at Apollo Hospitals, and began by asking her the investment plan for this initiative.
We've invested 8 crores in this center, and we plan to open another 25 centers across the country.
Okay, and what kind of investment would be going into opening 25 centers like this?
It's 8 crores for this center, so we just multiply it, maybe 160.
I see.
Over a period of time.
How affordable is this going to be as a treatment, for the, even with insurance, etc.? What's the typical cost involved here?
it could, it varies from different protocols and treatment types. So it'd be very difficult to give you one answer because, like I said, every human being is an individual, comes with a different DNA and a different problem.
Okay.
So I think you should look at, typical cancer treatment could be somewhere in the range of 1.5 lakhs.
If I could get a general perspective, since we're starting the new year, what kind of occupancies you're seeing, what kind of trends you're seeing there during the quarter?
You're going into business now. Now we're seeing good occupancies, and I think more of this post the board meeting.
Oh, okay.
But very healthy occupancies, especially in Karnataka.
I see. But your hospital revenue, your pharmacy expansion, in any sense you could give us about the trajectory that you see starting this new year?
Let me just say that it'll be a very strong trajectory. And it's so strong that we are now investing in creating additional capacities.
What would that entail? You have about 70 hospitals, 10,000 beds, 6,000 pharmacies. To what extent are you looking to expand each of these?
So in the short term, which for me is 3 years, 2,000 beds.
Okay.
And 3,000 crores of investment.
And, would you be raising capital for that? What are the capex plans for this year? And, would there be any private equity investment involved? We've been seeing that trend across healthcare.
Thankfully, Apollo has very strong cash flows to fund expansion.
Okay. So what is your capex plan for the year, if you could share for us?
I said over 3 years, it's 3,000 crores.
Okay, well, that's, Apollo Hospitals commentary on the business as well. The progress in railway expansion and modernization is huge, says the Minister for Railways, Ashwini Vaishnav. Speaking with my colleague Shireen Bhan from the sidelines of the World Economic Forum at Davos, the Minister outlined expansion plans for the railways. I mean, stocks have been flying high in this space. Listen in to the Minister.
Let's also talk about railways. And you said that, you had meetings with the Swiss authorities here. But I also wanted to understand from you, in terms of the ambition and aspiration now as far as railway capex is concerned, as far as building on the project momentum is concerned, what's the view, what's the road ahead?
See, the progress in railway expansion and modernization is huge. For example, last year we added 5,200 kilometers of new tracks. That's like adding the whole network of Switzerland in 1 year. 5,200 kilometers. This year we are doing at a pace of 15 kilometers a year. So 15 kilometers a day. 15 kilometers a day is like huge. We have just, out of the $29 billion capex that we have planned for this year, 2,40,000 crore. We have already accomplished 77% as on yesterday. I get a report on a daily basis. I monitor it so closely. So we have already achieved 77% of it.
Okay, well, Ashwini Vaishnav, who's also the IT minister, backs the mobile industry's demand for tariff cuts on imported components. Also says that Vodafone Idea is making sincere efforts to get investors.
I want to go back to Telecom and address the Vodafone issue with you, because when we last spoke, you were hopeful that they would have been able to get investors on board. That hasn't been the case. The government continues to be the largest shareholder in Vodafone. Is that something that you are looking at today?
I think they are making their sincere efforts, and they've been regularly updating us about what they are doing. And I think we have done whatever we were supposed to do. And I think the journey so far has been okay. Of course, it's a listed company, so it's not proper for me to divulge any details or give any comments on that. But yes, they have been making sincere efforts.
So let's address each one of them specifically, and I'll start with talking to you about electronics, because that's the story that India has been pushing, and we have made progress and we've seen results. But industry is also demanding that there be a cut as far as tariffs are concerned, so that the story can gather even more momentum and growth can accelerate. Is that something that was taken up with you? Is that something that is up for consideration, up for review?
We have had a very detailed discussion on this with the industry participants, and most of the participants gave very clear, logical and cogent reasons why they are proposing what they are proposing. And basis our discussions, basis our consultations, we have also made a recommendations, kind of recommendation paper, and I think it's good logical next step, because what has happened is we have to now move from import substitution to export-led growth. That is the moment we need to, that is the transition we need to make. And that requires a totally different mindset, that requires totally different structure.
So there is a case to be made for a cut in tariffs, and you are in favor of that?
Absolutely, especially for the component ecosystem.
All right, let's do one thing. Let's take a quick commercial break on that note. But on the other side of the break, we will talk to Mitesh Thakkar for some technical trades. Stay tuned.
Obviously, you see, it's not that you get X amount of deposit and you extend that X amount as a loan. It's not like that. Share prices in the stock market do not necessarily reflect the fundamentals of a company. I'm talking in general terms, not with reference to a particular bank. Generally, if you see, the stock prices are determined by so many other factors and do not necessarily reflect the fundamentals of a company. You have examples in every sector, whether it is the financial services or banking or any other sector you look at. There are companies with very strong fundamentals, but its share prices should be low. And the converse also happens. So therefore, it will not be correct to judge the health of a particular sector like banking in particular in terms of share prices, movement of share prices, and that too on a single day.
There is a concern or perhaps confusion as far as the credit deposit ratio is concerned and whether the RBI is likely to mandate a number or not. Could you clarify this for us?
You see, we have not mandated any number. I think there was, let's leave that. But what I would like to say very clearly is that we have not mandated any number, that this shall be the credit deposit.
You know, we were asking the question in the morning whether the rally will fizzle out at about 21,700, right? It has fizzled out, at least for now. So look at what the Nifty intraday seems like. We're just about 10 points higher. So after a stop, which basically means we're about exactly 100 points off the day's high, because the high was 21,730. We're at 21,630 right now. So there's been a continuous drop which has happened since the morning, but this is still the first hour and you got the full session ahead of you. Maybe just take a look at the Nifty Bank also, which is still in the green. But of course, I mean, there has been a significant give back from the day's high. Market breadth is positive. 1,400 stocks are higher, and you got about 800 stocks which are lower at this stage. Mitesh is back with us, 10 a.m. trades, and just a quick view on the market. Mitesh, looking at the drop-off which has happened, what would you do?
So, Prashant, as I said, I think, we are in a process of consolidation. The markets are likely to chop around, and therefore, I think you will get these bouts of buying and selling during the day. I think that process will continue. Broadly, try to buy closer to 21,300, 350 zones and take a 50-point stop below 21,300 support area and exit and take profits as we get closer to 21,750. I think that remains the strategy for the next 5 to 9 sessions. And unless until we see a signal of this range getting violated on either side, I think we'll maintain this stance. On the stock side, Coal India is on the buy list. Disclaimer, we have recommended to our clients, so there's vested interest. It's a buy with a stop at 386 for targets of 410. And the other stock which I like is Power Finance Corporation, which is a buy with a stop at 412 for targets of 433.
All right. Thanks a lot for that, Mitesh. By the way, my colleague Hormuz very helpfully sent us this data on stocks like IRFC, RVNL, etc. The gain just in the month of January, right, for IRFC has been 77%. RVNL gain in just January, and we're not done with the month just yet, is 76%. And IRCON is up 47% in the month of January. So it's been a phenomenal month for many of these stocks. But let's do one thing. Let us talk about the overall market. How is investor participation looking like today? No prizes for guessing that one, actually. Surbi is joining in with all the details. It's a shock and awe sort of situation, Surbi. But I guess it's just you and me working today.
We're making the most of it, Sonia. We're polishing off some samosas and some croissants in the newsroom. Hopefully, there'll be some left by the time you guys come out of the studios. But, on a serious note, I was trying to find out from all the domestic mutual funds whether they will really be out there live with their dealing desks, you know, buying and selling, whether trades will happen. And the answer that I got from most AMCs was no. Now, there's no official statement on it, but the word is that, you know, the Saturday's trading session is being declared as a non-business day by AMCs. Now, what does non-business day essentially mean? That operations are going to be shut for most parts of it. There's no mandatory sort of, you know, norm to come in and buy or sell. In fact, a lot of the AMCs and fund managers that I spoke to said that they will not be trading today. And many perhaps won't even be going to office as well. So low participation for today, and not just today, for Monday as well. Monday is also being called a non-business day because anyway the equity markets are shut. And there was one clarification that if anybody is waiting for the redemptions to come through, the payout cannot happen on Monday because a lot of banks are also closed on Monday. So investors will have to wait till Tuesday to get their money if they're looking at any redemptions. And mutual funds are not taking in any money today either. So I think it's a long weekend for a lot of the fund houses out there. But yes, not for you and me. Back to you.
All right, Surabhi, thanks very much for that. So it's a quieter kind of day with you know, local institutions maybe out of it, and foreigners, of course, out of it as well, with you know, this being a Saturday. Let's shift our focus to big bank earnings. You know, big banks were always going to report today. Just that today turns out to be a trading session. You know, ICICI Bank will report, and so will Kotak Bank. Abhishek is with us to run us through each of them. Let's start with ICICI Bank, Abhishek. What should we expect?
Well, to start with, you know, it's good that they are giving results on a working day for us. So let's begin with ICICI Bank. Lowest NI growth in 21 quarters estimated by analysts on a YY basis, and sequentially you can expect a PAT decline. So to begin with, loan growth expected to be strong. Kotak Securities estimates loan growth of 18.5% YY and about 4% sequentially. The net interest margin can come under pressure. Morgan Stanley estimates anywhere between 15 to 20 basis point decline in net interest margin on a sequential basis. Provisions can rise quarter on quarter as per Kotak Securities. Slippages also may rise sequentially, but not much. Watch out for where the slippages come in from, either the known stressed accounts or actually the fresh slippages. In the difference between that will actually impact the stock price. Morgan Stanley estimates slippages of 5,250 crore. Last quarter it was at 4,690 odd crores. Asset quality can remain stable or improve. Motilal Oswal estimates gross NPA ratio of 2.5% versus 2.48% in the previous quarter. Watch out for commentary from management with respect to loan growth as well as deposit growth and movement of books, that is watch list about 4,790 crores and restructured book of 3,500 odd crores. That will be seen closely. Our polls suggest NI growth of 12.2% YOY and about 0.9% sequentially. We are working with a profit growth of more than 20% YOY and a decline of 2.6% sequentially. Back to you.
Okay, thanks a lot for that. Well, we also have Kotak Mahindra Bank that will be reporting its numbers. What can we expect?
For the entire BFSI sector, Sonia, net interest income or net interest margin is the key area of focus in these quarterly results, given the fact that cost of funds have risen massively. So watch out for, you know, NI growth, which analysts are pegging it to be the lowest in last 8 quarters and profit growth to be the lowest in last 9 quarters on a YY basis. Key thing to watch will be loan growth expected to remain strong. Motilal Oswal expects a loan growth of 16.5% YOY and about 4% sequentially. Deposit growth also can remain healthy. Motilal Oswal estimates a deposit growth of 20.5% YOY and about 3.5% sequentially. Net interest margin, if that remains stable, that will be a key positive. Morgan Stanley does estimate a flat net interest margin on a sequential basis. Need to watch out for the low-cost deposit momentum, which the entire street is witnessing a decline in CASA ratio. Last quarter, it was about 48.5% for Kotak Mahindra Bank. Asset quality can improve. Motilal Oswal expects gross NPA ratio to decline by about 9 basis points sequentially to 1.63% versus 1.72% in the previous quarter. And management commentary and outlook with respect to business growth momentum and other key parameters will be seen closely. Our polls suggest NI growth of 13.7% YOY and about 2% sequentially. We are working with a profit growth of 13.2% YOY and a decline of 0.9% sequentially. Back to you.
Okay, thanks a lot for that. Let's move away from banks now and talk about some of the auto stocks. Shireen Bhan caught up with Vice Chairman and Managing Director of Apollo Tyres, Neeraj Kanwar, in a wide-ranging conversation. Shireen spoke about the FY25 outlook, shared their blueprint for their foray into the electric vehicle sector as well. Very interesting conversation. Listen in.
Well, I think Q4 is going to be a positive sign. We are already seeing positive signs both in India and in Europe. Europe car tires, car OEMs have gone up 7%, whereas truck is still down, agri is down. But I see India coming back up. We are still single digit. We are not going to go to the double digit. Maybe next year, next financial year, but Q4 is much more positive than Q3.
Okay, so demand is expected to pick up both in India
yes.
and in Europe?
Yes.
What do you think are the causes for the kind of growth that you've seen, the slower growth that you're seeing at this point in time?
Well, I think people are being cautious of buying. Interest rates are high, and so they're holding on to. Supply chain is a big issue today. Given the Red Sea issue also, we are looking at a lot of disruptions in supply chain. Freight costs have gone up by 40%. Time taken on transit is taking up by more than 15 days. So these are some of the issues that people are facing today.
Has it impacted you in any way?
Yeah, big time. I mean, 40% costs are gone up in freight, and the availability of tires is taking 15 days longer. So yeah, there is a major challenge as far as supply chain is concerned.
Is there any way of being able to offset, if not the entire amount, but you know, what could the impact be on account of this?
No, I think it's just an interim issue. I don't think we can overrun the cost of this, but it's an interim issue. I hope that we'll be able to solve it.
So that, of course, is one of the uncertainties that you're dealing with. What are the other key risk factors at this point in time?
Well, right now, you know, the main thing is the supply side. Raw materials have eased out, so that's saving the companies, and the tire industry is doing pretty well over there. One is looking at going into EVs, which is very big. Europe has gone big time into EV tires. We have started launching EV tires in India as well. The biggest risk going forward is going to be carbon emissions, and Apollo itself is looking at becoming carbon neutral by the year 2050. The products also, we have to look at how we can come up with sustainable raw material products. We've already come out with 2 products in the car category and in the farm category with 75% sustainable raw material. So that's going to be a big challenge going forward on how do you use raw materials which are sustainable, how do you come down on carbon emissions. We've taken a target by 2030 we should be around 40% renewable energy.
Okay.
So these are some of the new things that one is looking at and the challenges that one is going to face.
So let's talk about the EV opportunity, and how do you expect that to play out for you? How are you gearing up for it?
Well, you know, EV tire is obviously you need less noise because now it's a battery. You need more torque, and you need much more rolling resistance. So companies like ourselves have been doing this for a long time. It's been driven by the OEMs. And so we are ready to take on that. I don't see that as a big challenge.
Okay, let's slip into a short break. On the other side, we'll get you excerpts from our exclusive conversation with the RBI Governor at Davos 2024. Stay tuned.
We have not, and at the moment we don't propose to, because credit deposit ratio is just one of the parameters to assess the health of a bank. There are several other parameters. So you have to look at it all in totality. All that I can say is that there should not be exuberance in lending, number one. Number two, there should be some correlation between your deposit base and your credit growth. There should be some correlation. But in terms of hard coding it, in terms of a particular number, there is no such proposal in our mind, and we have not prescribed any such number.
Let's address what's happening across industry today. And I want to address the issue of why Wipro's decided to sue Jatin Dalal. I mean, you know, been with the company for decades. Why the decision to do that?
Yeah. So Shireen, I'm not going to get into a specific case, but let me just say the following comments, right? One is we are simply enforcing a standard industry contract that everybody sort of follows. We are not creating any prevention of employment or job opportunity for anybody, right? And we're simply ensuring that, you know, that we've signed a contract, and we want to ensure that we protect ourselves from from an information standpoint along those lines. So I wouldn't read more into this. You know, I find sometimes there's a tendency to sensationalize this.
No, it's not sensationalizing. I mean, it's an unusual thing to happen.
We're simply enforcing contracts, which is not an unstandard thing.
For us, India is worth the investment that we're making in India. So when you look at India, it accounts for 10% of our global trip volume. So India is huge for us, and India is growing at about twice the rate that the rest of the world is growing at. So fast forward, if we're talking 5 years from now, India is going to be an even larger portion of our business.
Talking about the growth opportunity that you see in India, what is it going to mean in terms of expansion plans? What is it going to mean in terms of...
Okay, welcome back. We're about 30 points higher. So there's we actually slipped into the red, but the pullback has come. But 21,650 is where we're at. Quiet is the word you used to describe the markets today. On the sidelines, the recently concluded World Economic Forum in Davos. My colleague Shireen spoke with the RBI Governor, Shaktikanta Das, on a range of issues, including India's growth potential, its ability to deal with global geopolitical challenges, and also prospects of an impending possible rate cut in India. Listen in to a slice of that conversation.
In terms of macroeconomic stability, macroeconomic growth, in terms of financial stability, in terms of monetary policy actions and their outcome and bringing inflation under control, I think India is today well placed. It showed its resilience, and India is well placed and also well placed to deal with many emerging challenges. But having reached this point, I think what is now the focus, which should now be the focus, and what is our continuing focus, is to maintain that stability, maintain that resilience, and work towards improving it and strengthening it further. India is on the whole doing well, and will continue to do well as per the current indications.
Let me pick up on that comment that you made, and you have called it a period of great volatility between 2020 and 2023. On the back of the conversations that you've had here in Davos, as well as some of the emerging uncertainties, for instance, the attacks that we are seeing on the Red Sea, etc., what is the outlook now as far as 2024 is concerned? Domestic, of course, as you rightly pointed out, much more stable, relatively calmer. But what about the global factors that we will need to be watchful of?
You see, all these global geopolitical flashpoints are evolving. Around the Red Sea region, how it will evolve in the coming days, we have to wait and see. Only the time will tell. As things stand today, India will be able to deal with the existing challenges, but we have to see how it all plays out in the future weeks or months. And this kind of uncertainty, I think, is what is making policy making really that much more complex.
You know, speaking of complex policy challenges, the central banker's dilemma and the central banker's challenge at this point in time is that there is a clamor from industry, from consumers, perhaps even from government to cut rates. But there is a fear and the risk that if you move too prematurely or too early, you could in fact cause more disruption and upset things further. I know you've firmly said that there will be a change in stance or a cut only if we get to 4% on a sustainable basis. But you know, as a central banker, and you've been talking to other central bankers here as well, isn't that the big challenge and the big dilemma for you?
I think, you have partly answered the question. You see, the markets all over the world, the markets are running ahead of the thinking of the central banks. In India, you mentioned that there is an expectation from various quarters about a rate cut and all that. Frankly speaking, the serious players in everywhere, whether it is the industry or the private sector, or it is the analysts or the economists or the serious the market players, in the context of India, I don't think anybody is expecting a rate cut now. In most of the advanced economies, the markets and the stakeholders and the market players, their assumptions, it is ahead, they're overrunning their central banks. So far as India is concerned, I think the thinking of the central bank and the thinking of the market participants, they're much better aligned. In inflation, With regard to inflation, I have said elsewhere that our policy has to remain actively disinflationary till we reach the target of 4% on a durable or a sustainable basis. And that is our current stance. You see, ultimately, why are we working towards this 4% inflation? Because a stable inflation, a stable, what we call price stability, provides the support, the required support. It acts as a bedrock for growth, for sustainable growth. Otherwise, you will have off and on data of growth doing well, then again slipping back. And a premature, you are right, absolutely right in saying that any premature pivot in our policy, it can be very, very costly for the economy.
You know, you talked about growth, sir, and the NSO advanced estimate has pegged growth higher than the RBI's estimate. On the back of the data that we are looking at today, do you believe that there is an upside projection or growth could do better than your own estimates?
You see, we said 7% for the current year.
Yeah.
Our earlier projection for current year, that is 23-24, was 6.5%. In October, in end October, when I said, in one of the events and followed up by our monetary policy statement, when we said 7%, our previous number was 6.5%, and I think the market was also around 6.5%. That time, 7% was seen as optimistic. But subsequently, the NSO, that data which came about a month later,
yes.
So naturally they had a later period data, and NSO has access to several data to which we don't have access. Now 7.3, and in fact in the monetary policy conference, we had said, in fact the Deputy Governor had said that, it's actually 7% is a conservative estimate.
Yes.
So we were expecting that it can exceed 7%, but we wanted to be absolutely, absolutely sure about our number. Even for next year, I have said yesterday that the growth momentum is a momentum of economic activity is well maintained, and next year growth will be touching 7%. And when that happens, for 4 consecutive years, successive 4 years, India would have recorded a growth of 7% or more.
We saw a significant impact on the banking sector, on the banking stocks in specific. HDFC Bank came out with its numbers. There is a concern now as far as deposit as well as credit growth is concerned, and deposit growth not keeping pace with credit growth. Are you concerned about that?
You see, our deposit growth, if you see the last 1 or 2 years, the deposit growth has been around 12 to 13%.
Yes.
The credit growth has been about 15%. Now, obviously, you see, it's not that you get X amount of deposit and you extend that X amount as a loan. It's not like that. Each loan that you extend, money creates money. The money multiplier happens in the market. So, obviously, the credit will be little, will always be little higher. Now the question is whether it is unduly higher or it is sort of has a correlation with your deposit base. At the systemic level, at the individual entity level, at the moment, we don't see any risks. We are doing our regular, our supervision has become much more intense. We have now an ongoing method of our supervision is ongoing. It's not once in a year annual inspection or annual supervision of the banks. So at the moment, the Indian banking sector at the systemic level is very robust. Even at individual entity level, it is very robust. With regard to stock prices, the stock market prices, you see, stock markets have their own dynamics. And stock market, the prices, share prices in the stock market do not necessarily reflect the fundamentals of a company. I'm talking in general terms, not with reference to a particular bank. Generally, if you see, the stock prices are determined by so many other factors and do not necessarily reflect the fundamentals of a company. You have examples in every sector, whether it is the financial services or banking or any other sector you look at. There are companies with very strong fundamentals, but its share prices should be low. And the converse also happens. So therefore, it will not be correct to, judge the health of a particular sector like banking in particular in terms of share prices, movement of share prices, and that too on a single day.
There is a concern or perhaps confusion as far as the credit deposit ratio is concerned and whether the RBI is likely to mandate a number or not. Could you clarify this for us?
You see, we have not mandated any number. I think there was let's leave that. But what I would like to say very clearly is that we have not mandated any number that this shall be the credit deposit ratio. We have not, and at the moment we don't propose to. Because credit deposit ratio is just one of the parameters to assess the health of a bank. There are several other parameters. So you have to look at it all in totality. All that I can say is that there should not be exuberance in lending, number one. Number two, there should be some correlation between your deposit base and your credit growth. There should be some correlation. But in terms of hard coding it, in terms of a particular number, there is no such proposal in our mind, and we have not prescribed any such number.
And, you know, do you now regret getting out of Uber Eats in India? Look at what's happening with companies like Zomato and Swiggy there. Are you?
You know, I have to tell you, you know, the nice corporate-y thing to say is I have no regrets. I'm a little jealous. You know, it's a great opportunity. But we made a commitment as a company to invest in businesses where we thought we could be the #1 player. Because in order for you to have positive returns on capital, and in the end, we're a business, you know, you got to get to #1. We thought on food delivery, Zomato and Swiggy, they are great companies, and we didn't see a path to #1 that was worthwhile. We look at the mobility business, we see huge potential, and the biggest potential we see in actually mobility now are two-wheelers and three-wheelers. So our three-wheeler business, our two-wheeler business are growing at significant rates. We're looking to electrify those fleets as well. We're looking to partner with local companies in India who are building electric two- and three-wheelers and four-wheelers that are affordable, that are available to the mass market, et cetera. So we see India really as the crest of the electrification wave for us, in that we don't think electrification should be restricted to rich markets and you know, rich people. We think it should be available for the masses, and India is going to play a very, very big part in it.
Our sense is every client is looking at what generative AI can do for them. We've ourselves positioned as an AI first company, so we're using all of these things inside. We have assistants, AI assistants now for each of our functions, whether you look at HR, recruiting, sales, delivery. So that is a transformation inside. The client meetings are just extremely good, very positive thinking from most of the clients. Economies in Europe, US looking like they're coming to maybe not yet in terms of full recovery, but at least they see their work behind them in terms of what the issues were. Of course, the conversations are positive.
People are asking you, global investors are asking you about India and the growth momentum.
Thank you very much, first of all, for having me on your show. Well, as far as the global investors are concerned, they are quite keen. They are actually tracking the India story with a lot of interest. The kind of resilience which has been demonstrated as far as Indian economy is concerned, it is of significant interest for them. Many of them.
HUL falls on the back of weak third quarter earnings. Revenue declines marginally as volumes disappoint while EBITDA remains flat. Brokerages, HSBC and Morgan Stanley also issue bearish calls on the stock.
RBL's third quarter numbers miss estimates as slippages rise and asset quality deteriorates. But retail loan growth momentum continues to remain strong. On fundraising, the management tells CNBC-TV18 that capital is currently adequate for the next 6 to 8 quarters.
CSE under pressure after profit slips 10%. However, generation is higher by 28% quarter on quarter.
Railway stocks continue to surge ahead of the budget. Ircon surges nearly around 24%, while you have IRFC is up nearly 20%. RVNL2 is up 10% after a 20% move yesterday. Both RVNL and IRFC have now surged 75% in January.
Suntech Realty, that stock's down 2.5% after the company's third quarter revenue percentage was down 52%. The company has also reported an EBITDA loss of 16 crore rupees.
Hello and welcome to Chartbusters. I'm Nigel D'Souza. Join me as always is Mangalam Malu. It's a Saturday morning. We haven't done this before on a Saturday, but Chartbusters is coming to you live from the CNBC-TV18 studio. Mangalam, what's up? At least we have green on the screen.
Yeah, the one that's right above my head, the Midcap index, that's up 0.7%. The bank nifty is doing well as well. Though, those who are trading this Saturday, let's hope that they don't consider this move in the market as a real move, because we don't have a lot of volumes which are trading. And while, domestic and foreign institutional investors aren't trading as much, the retail investors, the HNIs, all of them are having a lot of fun. And the impact cost is a lot higher as well when volumes are low. So let's hope that this move is not mistaken to be a bit of a trend. And if it is, and the market does turn around, then great for everyone, I guess.
Mangalam, talking about fun times, Friday is normally good fun for me. I look forward to Friday and I really take a chill pill out there. But it seems that this Saturday working has disrupted your plans as well. From morning, I've been telling you, you're looking visibly disappointed.
Okay, you do exercise, right, every once in a while. So you see, when you're doing 10 reps on an exercise, the trainer comes and suddenly says, do 3 more reps. Those 3 are the ones which are most tiring. And that's exactly what happened. You worked for 5 days and Reliance was, we stayed in office till a long time yesterday, till about 7 p.m., 8 p.m. And then after the exchange came and said, hey, why don't you do 2 more reps? So that's exactly what happened. But, be that as it may, we're having a good time here and we'll ensure that you have a great time too. Let's welcome Soni Patnaik of JM Financial Services for a quick technical check on the market. Soni, we've invited you on a Saturday as well. What are your thoughts where the market goes from here?
Good morning, Mangalam and Nigel, and thank you so much for having me on this Saturday show. I think my take on Nifty would be that, we've seen it taken a good important support from 21,300, and as long as the support is not breaking on any closing basis, there could be some consolidation, but definitely the downside seems limited for Nifty. The only concern is that FI's position in the FNO space, has reduced significantly for longs from 66% to 46%. However, this is also considered as a support zone. So maybe, from the 45%, 44% of longs, it could see some bounce back and we could again go back to, 54, 55% of longs. So as long as, 21,300 is still protected, I think Nifty can, sort of consolidate over here. While Nifty is still showing a lot of signs of support. So I think it's just Bank Nifty that is still a concern. So major shorts have been witnessed in Bank Nifty this week entirely, and short covering can only be seen once it is above 47,000 level. So until then, it is wise to remain cautious on Bank Nifty and focus more on maybe Nifty and stock specific strategy.
Got it. Okay. All right. Soni, what about, since you're saying better to focus on stocks, tell us which is the stock on your radar?
So today, the first pick is on the Coal India. I think Coal India is seeing very good aggressive long builder positions today and a good technical breakout also. So Coal India futures can be bought at current level and on any declines till 394, keeping a strict stop loss of 384 and targets of 420 to 425. The second pick is on NTPC. NTPC also has good breakout coming up and, can buy in the range of 312 and 310, keeping a stop loss of 299 and targets of 325 to 330.
All right. Thanks a lot, Soni, for joining in and giving us all your views on the stocks. Let's talk about some ideas for profit. This comes in from our colleagues at Money Control Pro as always. And today we have with us Khushbu Rai Gupta.
JK Paper is one of the largest players in the domestic paper and pulp market. The first half of FY24 saw slowdown in the packaging paper demand, offsetting the robust growth in writing and printing paper. However, the demand had improved in the later half of the calendar year. Moreover, the office paper consumption will remain firm in the coming fiscal, while writing and printing paper demand, which is mainly driven by the education sector, will get a boost from the adoption of new education policy. The packaging paper segment, which accounts for more than 57% of the overall revenue, including virgin board and corrugation boxes, is expected to grow at a faster rate than other segments in the coming years. Given that the input cost had increased and is expected to inch up further, including the pulp and energy prices, the company is expected to increase product prices across segments in order to sustain margins. Also, if we look at the current valuation, the stock is trading at 3.3 times FY25 EV by EBITDA and could be a good bet for long-term investors at current levels, given the company's large-scale operation and backward integration.
Right, before we slip into a short break, just keep an eye out on Reliance. The stock is picking up. It's recovered about 1.5% from the lows, and that explains why Nifty is also picked up a bit of a pace as well, closing in on that 21,700 mark. Though, it's about 50 points higher on the Nifty. Reliance as the stock is just mildly inched higher. Take a short break, come back. On the other side, we'll have a conversation with Sri Digvijay Sime, and we have Anil Singh, who is the executive chairman of the company, joining in.
Look at their supply chain relocation, and they want India to be part of the supply chain. So I think to that extent, India's story is quite promising. And apart from the many other things, the green initiative of India, and more so in terms of solar, renewable, battery, EVs, these are the kind of things which are also attracting a lot of interest from the global investors.
The focus and the attention is on AI, but I know you want the world to focus its attention and its bandwidth on what's happening as far as attaining the healthcare goals are concerned. And you're concerned that we're slipping and that funding is an issue and a big challenge.
That's right. Making sure kids survive, making sure they're well nourished. There's been a lot of progress since the turn of the century, but with all of the unrest, the pandemic, we've lost attention to that, so we need to go back and keep reducing these deaths. We went down from 10 million to 5 million, and we can cut it in half again. India's a place that is making progress. We've got a lot of great partners there, but we need to get these new innovations.
Welcome back. Well, the markets are holding in the green, but yesterday you had one stellar set of numbers that did come out. And that was from Sri Digvijay Cement. The street liked it quite a bit. I think the last few days as well, the stock has run up. And the EBITDA per ton, that they have disclosed has come in at more than 1,500 rupees per ton. Mr. Anil Singhvi, the executive chairman at the company, joins us on the show. Hi, Mr. Singhvi. Good morning, and thanks so much for joining in. Well, we appreciate you actually joining in on Saturday. Our interview was scheduled for Monday, but good to see you in. And, the street really wanted to hear from you. Because when you've come on the show before, we have been quizzing you. Sir, can you do 1,100 or 1,200 rupees? You said, let's push this aside, just smack it out of the park. You've done 1,500 rupees. The question is, what is the sustainable EBITDA per ton number from here on?
Well, thank you so much for having me. I'm very glad you're now changing the tracks altogether. What is sustainable? Early it was 1,000 to 1,100, whether we can attain, now sustain. So attain to sustain. But let me answer this question very, very clearly. I think we have done a lot of work in last 4 years. We are very clear about our productivity, our cost controls. Though the markets in terms of pricing hasn't favored much. So if the prices remain where they are, if they don't slide or if they improve, I think this 14 to 1,500 looks to me a sustainable EBITDA level for this company.
So 14 to 1,500 per ton is a sustainable level. I just looked at a couple of things, Mr. Singhvi. One, your other expenses, they were down 33%. And secondly, your power and fuel costs did not fall. Can you explain this to us?
Yeah, two things happened. During the last year, the same quarter, we had a shutdown of the kiln for the maintenance. So that's why the expenses that quarter were higher. And since we did not have in this quarter, the power and fuel, the comparative number will be actually adjusted for the inventories. Because we have produced almost about 300,000 tons of clinker, which was not grounded in the same quarter on that. So if you adjust for the inventory, power and fuel is much lower than what it was. So per ton basis, we are much lower than what we were in December 22.
Got it. Okay. All right. Mr. Singhvi, so we're going with that 1,400 to 1,500 rupees per ton on the EBITDA front. You also had given us this volume guidance. I know you're almost at optimum levels. But I think, you were guiding for a growth of 7 to 8%, if I remember correctly, in terms of volume growth. Now, if you have to go by that, since you've grown by around 4.5% in the first 9 months, you'll have to do more than mid-teens growth in Q4. Do you want to revise the volume number for the year?
No, I wouldn't hazard a guess on that, but we had a very lackluster November, as I mentioned in my press release as well. November was, as you know, was a full of Diwali and festival season. But I think the Gujarat market, for a variety of reasons, including Rajasthan elections, the labor went back and did not come back till such time the voting took place. So November was a bit of a disappointment for us, where we lost about 25 to 30,000 tons of cement sale during the last quarter. But I think we'll more than make it up in this quarter. So I'm not looking at revising big way, but maybe 1% here and there, which doesn't change the scenario as far as profits are concerned.
So volume growth will be around 6-7% then for the year.
Yes. Yes.
All right, 6 to 7% volume growth. You seem to have sold some stake in the company over the past few quarters. What explains that?
Anyway, this is a personal decision. I think I'm here to explain what company has done. And let me also dwell on this matter that, when one looks at Digvijay Cement, I mean, it's the smallest company in the listed space. And fortunately, we had the results of the largest company in the cement space. Compare the two. In fact, that will give you a sense of that small also can be beautiful, small also can be smart. And I think this is what exactly we have done. According to me, my 40 years of experience, this vintage what it has produced in terms of clinker or what it has produced in terms of cost of production, I think it is the best profitability ever achieved by a vintage of 1984 kiln. So I would rather talk about the performance of this company, which was almost a written-off company. And I want to make one point very clear. Oftentimes, people talk about, cement companies and they are in favor or they are not in favor. I think there are three criteria where one should look at the cement company operations. One is per ton. Second is what is ROE. And third is what is ROC. I think these are very important factors because industry has gone for guzzling the capital, not giving a commensurate return on ROC and ROE. And I think this is an important factor. And as a very wise channel, I would say, because you don't take the crap and the nonsense, I think you should have every conversation on these three parameters. And people often talk about per ton, what is the value, $70, $80, $200. I think it's a complete nonsensical. What one can produce the numbers, ultimately the capital and return on the capital are the important factors, not per.
Yes, we take your points completely, Mr. Singhvi, and the fact that you've turned this business around, and as you said, good things do come in small packages because it was your personal decision, and your personal decision as a leader of the company does reflect on the way the street views it, which is why that question was valid. But you said that it's your personal decision.
Let me also answer that question. That having invested in 2019, again, this is a personal answer which I'm giving under my personal capacity. There is some point in time you want to see whether you have really had a good run on that, and some. It's not that I've sold all. I've sold some, and those decisions will always be there. Maybe I'm needing a house. Maybe I'm wanting to get my daughter married. I mean, those are very personal decisions, right? So one should not dwell on those. Every individual shareholder has a right to take a decision on when to invest and when not to invest or to divest from that.
All right, Mr. Singhvi, whatever you've booked it for, if it's something, I wish you the best in either if it's a personal or it's a family decision or it's a new house. Look forward to visit you as well someday. But you've not sold all of it. I recall, I think you had around 1.25 crore shares, right, in the company, and I think you've sold around 75 lakh.
Yeah, that's right. That's right.
So you're holding on to the remaining, or do you have some further plans on a personal front that maybe you'll sell those shares as well?
I think those were the decisions which were taken in 2023 when I needed money, and that is how I sold that. And let me tell you one thing: that was a very, very poor choice and poor decision because I sold it around 85, 90 rupees. Today is 120 rupees. So if there was anything to carry on this situation that I was hoping or I was expecting that things were not worked out well, and I did that, I think I'm terribly wrong. So it was perhaps a personally wrong decision, but I needed for some reasons, and I.
Good to you. Good to hear you being so candid, sir. You've been,
always
been in the, and we love it. So tell us about, True North, the other PE who owns the company. What's happening? I know that in the area that y'all are functioning only, there are a couple of units, a small 2 to 3 million units that are on the block. Some of them for years we've been hearing, but I believe now some of those promoter entities are coming to the table. But because of the nature of the PE business, they have already made so much of money. Are you all looking out as well? I believe there is some talk about that.
Well, it's a right question, but to a wrong guy. So that is where I will stop because that answer can best be answered by True North, not by me. I'm running the company, I think, best of my ability and have demonstrated this that small is beautiful. A company which is written off can also get the best of the numbers in the industry on that.
But so conversations are
that reflects on
conversations are underway, right? Conversations are underway. Perhaps not with you, but with True North.
I have no idea, no clue. Perhaps you guys know always the street, and you are ahead of the curve. So perhaps you know something which I am not aware of.
I believe that there is a possibility that a deal could be in the offing, but only, as always, bhav. What price will it be? It take place at? That's the debate. The seller always wants more, and the seller wants it at a better price, and the buyer wants more. But that's for quite a few assets in India as of now, and that's normal. Tell us about the expansion plans. The last time we had you, you were telling us about how you're going to be scaling up the business, more than doubling the capacity. So by when does this happen? And what is the funding mix, equity and debt, for that expansion?
Sure. But before I get into it, you raise a very important point, and I want to dwell on that we are trading today at around perhaps 10 times EBITDA. Most cement companies, particularly the pack of the five, trade around 18 to 20 times EBITDA. And as I mentioned to you, I think at the end of the day, it is EBITDA per ton, ROE and ROC. So I still think that we are undervalued. So that gives you the wow or value or valuation. Let me put it this way. To your second thing, that yes, expansion plans are on. I think if everything goes well, we should be up and operational by October to December 24 quarter. And the total cost of the project is going to be approximately, as I mentioned last time, 250 crores. We would look at half and half equity, half debt. We are doing reasonably well. Our cash flows are good. So we may borrow 125 to 150 crore, and remaining will be internal accruals. But having said this, I think this will be a short-term borrowing, because I don't think we really need to have a long-term borrowing for this, because companies' retained earnings are very good. And inshallah, I think profit should be good enough to repay it as soon as possible.
All right. We understand and take your point as well, and the direction that you gave on bhav itself. And as in your part of the country where you operate, they say bhav bhagwan che, God, price is God itself. But, sir, very quickly before I let you go, am I wrong on that about, in your region itself, we had discussed, the other Sanghi Industries when that was on the block. But I believe a couple of other smaller units are on the block in your area, in your vicinity, maybe 200, 250 kilometers away. Is that correct?
I focus only on the company. And it's a reward and return to the shareholders. Rest always left to the buyer and the sellers.
And demand on ground is looking very solid for the industry on the whole, or is there some signs of some kind of pullback?
I think November was a bit of a disappointing month. Yes. December 15th onwards, it started picking up. And as we speak today, the demand is good. And getting into the elections, the central and state elections, I'm sure demand will remain reasonably good for next at least couple of quarters.
And can push through a price increase? Sometime in January, has there been a price increase that's been taken?
I don't think it is really the all India phenomenon. Depending upon every region that you have dynamics of the pricing coming in play. But as I mentioned to you, the prices have remained more or less static. In fact, when we talk about the pricing, let me tell you that cement prices, which I have tracked for 40 years, they have not risen even at the rate of inflation. So I don't know, oftentimes, why do we have this discussion and debate? In fact, this is the most competitive industry I have seen across. And the beauty lies in reducing the cost of production, and the companies have done extremely well. They've not looked outside their gate to get the profit. They've looked inside their gate to get the profits.
Mr. Singhvi, you have managed with regard to this asset. I have to give it to you. At around 20 rupees, I saw there were no buyers actually. And I've been tracking for very long ago, from the Brazilian owner, to the Indian owner, to various owners. But that limestone problem, you all managed to resolve, and, that's why the profitability has scaled up. Just final question, this expansion comes on stream by when? I just missed that.
December 24.
December 24. Always a pleasure talking to you, sir. Do join us more often. We'll be happy to chat with you both on the industry.
I'm very casually dressed, but since you pulled me on Saturday, so there is no shirt.
Absolutely.
We appreciate you joining in, sir. You chill it out for the rest of the day as well. And, we are always happy to have you on the show. And thank you so much for adjusting your schedule.
Yeah, Nigel, it's a Saturday, we're casual. So we tried bowling at him, at the outside the off stump. He left all those balls. Yeah. We asked him those ones. And the ones that were in his hitting range, he just hit it out of the park.
Absolutely.
He just smashed it. So thanks a lot, Mr. Singhvi, for joining in. Wish you a very happy weekend as well. With that, we'll slip into a short break. But as we do that, remember the union budget. That's less than 15 days away. What's your wish list for the finance minister? Presenting to you the CNBC-TV18 budget ballot. You can now share your budget expectations with us on your website by scanning the QR code on your screen or by logging into cnbc-tv18.com/budget.
helping the patients.
What's the one big risk that you're most concerned about today as you look at the world?
Well, the instability, that includes things like U.S.-China relations, that could slow down all this progress. And so hopefully you get reasonable works on both sides. And, India can play a role there.
What role do you believe India can play there?
Well, India's, setting an example. India works both with China and the United States. And we saw at the G20, it was very constructive to turn the attention to win-win relationships.
The narrative in a lot of the popular press has been India as a prime beneficiary of supply chain relocation. And you've seen company-specific announcements out of companies like Apple that are continuing to ramp manufacturing capabilities in India. Obviously, the government's Made in India program is supportive of that as well. That is, however, not in fact occurring in the actual world. India has driven FDI of about $40 billion over the course of the last couple of years annually. Trailing 12 months is only at 13 billion, and we're looking at a best case scenario of 20 billion for the current year. So significantly below trend. And so inbound FDI is not coming. We're not seeing global multinationals make the bets that it seems like they're making if you only read the headlines. I think that the critical thing that we're looking at from an investor expectation perspective is this belief that multinationals are keeping their powder dry until we get past the political season in India.
Here in Davos, Geeta, everyone's talking about AI, the transformative impact of that, what it could potentially do to jobs, what it could do in terms of disrupting different sectors. What's your view on what AI could mean for the global economy?
Well, the PSU rally continues. A lot of them are surging. And in that, we have the railway pack, which continues to move, fast-tracking ahead. Hormaz joins in to discuss this rail rally. Record rail rally, Hormaz?
Yeah, it's the RRR factor, as you just said just now. But it's green signals everywhere, I guess, for the railway stocks, because they're just not showing any signs of stopping whatsoever. And on a day like this, when we were expecting lower volumes and lack of trading activity to take place, the railway stocks are just not showing any of that. And take a look at this. IRFC is up another 9%. RVNL is up another 9%, IRCON is up another 8%, RailTel is up 6%. So all of these railway stocks are going all guns blazing at the moment. But IRFC and RVNL are the two that I would like to single out, because in the month of January itself, both of them are up 75% each. And that 75% surge has happened in the last 10 days itself, not even through the entire month. IRFC has gained in 9 out of the last 10 trading sessions. RVNL has also gained in all 10 trading sessions. So this is the 10th straight day of gains for RVNL. IRFC just took a pause on Thursday, and it was back to winning ways over the last 2 days as well. So what has that done to the excess government stake now? The government holds around 72% stake in RVNL, which is currently valued at almost 50,000 crore rupees. It now owns around the 86% stake that is owned in IRFC. Now that is itself is worth 2 lakh crore rupees. We were speaking about IRFC's market cap crossing 2 lakh crores yesterday. Now the government stake itself is now worth 2 lakh crore rupees in IRFC, and IRCON International, that stake is now worth around 15,000 crore rupees. Now what has happened here? One thing that you need to keep in mind is in stocks like IRFC is that the float is very less. Now because of the float being very less, there is always a chance of the moves on either side, whether it be upside or downside, being in the extreme. So that is one thing that the investors need to keep in mind, and which is why there needs to be some caution that needs to be exercised. Now the railway minister, another potential trigger for this rally could be the fact that the railway minister Ashwini Vaishnav spoke to CNBC-TV18 at the World Economic Forum in Davos, and he mentioned the fact that the progress in expansion and modernization of the railways is huge, and the fact that they added close to around 5,000 kilometers of railway tracks last year, and they are looking to add more and increase the pace of adding more tracks this year and on a per day basis. So let's listen into what the railway minister had to say.
Let's also talk about railways. And you said that you had meetings with the Swiss authorities here, but I also wanted to understand from you, in terms of the ambition and aspiration now as far as railway capex is concerned, as far as building on the project momentum is concerned, what's the view, what's the road ahead?
See, the progress in railway expansion and modernization is huge. For example, Last year we added 5,200 kilometers of new tracks. That's like adding the whole network of Switzerland in 1 year. 5,200 kilometers. This year we are doing at a pace of 15 kilometers a year. So 15 kilometers a day. 15 kilometers a day is like huge. We have just, out of the $29 billion capex that we have planned for this year, 2,40,000 crore, we have already accomplished 77% as on yesterday. I get a report on a daily basis. I monitor it so closely. So we have already achieved 77% of it.
No one's pulling the chain for the train as of now, but we'll have to wrap up on this edition of Chartbusters. Wishing you a good Saturday ahead, but don't go anywhere. Trading Hour comes up next.
So, as you've seen, if you talk about AI to anybody, they can pick different facets of it, right, in terms of misinformation, but also the impact on the labor markets and so on. So we've actually done a pretty careful study on potential impact on the labor market. And our assessment is that about 40% of jobs globally, on average, 40% are vulnerable to AI. Right? That's a big number. That's a big number, Now, that varies. So if you look at the US, the 60%, that number would be 60%. If you look at India, that number is 30% because you have a large share of workers that are in the agricultural sector, which is not affected by, by AI, especially not the generative AI. Now, then there is a question of, okay, of this, if I take the US, and of the 60%, what fraction benefit from, get complementary, benefits from the AI, right? Become more productive because they have AI, versus how many of them are actually going to get substituted out, which means more likely to lose a job. And that then gets to it's about half of that 60% number, right? So we're talking about very large fractions of the population who are at risk of, at least if not losing their job, but in a sense being devalued a bit by the presence of AI, but also an important share that can benefit from it. The risks on inequality growing, especially wealth inequality, is something also that we flagged in this new research that we've put out.
The reality is that markets are pricing in an extremely aggressive view right now. You're looking at about a 70% odds of a rate cut in March. JP Morgan view is that it will be June at the earliest. Markets are pricing in over 140 basis points of rate cuts by the end of the year. JP Morgan's thinking somewhere around 120. And so you have very aggressive forecasts already built into rate markets at this stage, which we think are likely to be disappointed.
The union budget, though, is less than 30 days away. What's your wish list for the finance minister presenting the CNBC-TV18 budget ballot box coming to a hotspot near you? We'll be placing these ballot boxes at popular public spots, malls, colleges, theatres and others across major cities. We'll also be asking the newsmakers who drop into our studios for their budget wish list. So come join us and tell us what's your top budget wish list from the finance minister. Drop your wish list at a CNBC-TV18 budget ballot box near you. We'll compile them and present it to the finance minister before she presents the union budget.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Surabhi Upadhyay. It's a Saturday morning. I think this is the first Saturday trading hour that we're doing, right? But
Probably,
right?
At least in my memory. Like a full-blown trading hour.
On a
That's what we have, a full-blown trading session
but
on a Saturday.
But the good part is that next week becomes a 3-day working week.
Yes, I like the optimism, Reema. So take it away and tell us more about what's happening in the market. Thin volumes, but we have some green on the screen.
We've got green on the screen. So the benchmark indices are up close to about 0.2%. Mid-caps are outperforming. The mid-cap index is up 0.75 of a percentage point. Pretty good advanced decline ratio. We've got about 1,300 stocks gaining, 850 stocks in the red, and banks today are, bouncing back. Banks have had a rough week. So this week, while the Nifty is down close to about 1%, the banking index is down 3.6%. So banks have been underperforming, but today there is some life which has come back into the banking pack. And the big gainer is HDFC Bank in the private financials, a 1.5% rally there. Kotak Mahindra Bank, ICICI Bank on thin volumes, up 1% ahead of the big numbers. Coal India, Power Grid, NTPC. These are the top three Nifty gainers. So it's the PSU rally all the way, continuing for the large cap space. Coal India at a fresh 52-week high, 398 on that. Losers include IT, so Wipro, TCS under pressure, and HUL. The underperformance of HUL continues as weak numbers continue. HUL, top loser, 3% gone.
Okay, that is the shape of the market. I just wanted to point out, in terms of participation, and Rima, I was sort of discussing this with some of the domestic institutions, the mutual funds out there, because we know that FIIs are really not in the market today. So are there domestic institutions at least participating? Doesn't look like it. Volumes are anyway on the thinner side. This reminds me actually a lot of, of the 1st of January, where we are talking about less participation and how believable the stock moves are. But anyway, just a quick word on mutual funds in specific. A lot of them have declared today as a non-business day. Today as well as Monday, actually. So what is a non-business day? What does that mean? Basically, most fund houses are going with a no-dealing approach. That means they're not active in the market on the buy side or the sell side. A lot of the dealing desks will not be operational. Funds, a lot of the AMCs, I mean, it's not a blanket rule across the entire industry body, but a lot of funds, for instance, are not accepting fresh inflows today. And also, if there are any redemption requests that need to be processed, where money needs to be paid out by Monday, that's all getting pushed out to Tuesday now, because many banks are shut up, and PSU banks are shut on Monday. Some private sector banks are also going to be having partial working hours or full off on Monday. So because of all of this, any payouts gets pushed out to Tuesday. And largely speaking, I spoke about 5-6 at least, different big AMCs, and dealers are off. I think they're enjoying a long weekend. Less volumes and less participation from domestic mutual funds.
So retail in HNI?
Perhaps.
Perhaps.
Pretty much it.
Those would be the big participants in our
And that too, the retail who's not enjoying the little bit of a Mumbai, Maharashtra winter or the Delhi winter, who's not away for the weekend, I guess. So that part of retail in HNI.
That part of retail. Okay, let's begin the show then by focusing on some stocks that are moving this hour. First up, HUL, top Nifty loser, weak set of Q3 numbers. Mangalam with the fine print. Mangalam.
Well, irrespective of who's active in the markets today, one thing is for sure that everyone looks like they're selling HUL after it was a weak set, which the company reported yesterday itself. It's been 4 quarters since the company is reporting low single-digit volume growth itself. And this time around as well, going into numbers, the street wasn't expecting too much, just a 1% revenue growth. The company is actually seen a revenue decline, 15,188 crores versus street expectations of 15,385 crores. EBITDA, as a result of which, was also shy of street expectations by about 150 crores. Margins lower by 70 basis points as against street expectations. And we had the net profit, which came in at 2,500 crores as against street expectations of 2,650 crores as well. Volumes, like I said, 2% higher as against expectations of 2 to 3%. Gross margins, they improved by 400 basis points. But the company chose to plow that back into ad spends, and ad spends as a percentage of sales increased by about 260 basis points. Home care and beauty and personal care, both these verticals, the street was expecting anywhere between 0 to 2% sort of revenue growth. The company has gone ahead and shown a revenue decline of about 1%. Food and refreshments as well, out there the revenue grew just 1%, but there was a large volume decline on account of inflation in coffee as well as tea. Important to know that the company said that there has been a lot of external challenges and they are navigating through that. Even though 75% of their portfolio did see mid-single-digit volume growth and 60% of their portfolio saw market share gain, it's difficult macros to operate in, and that's what's reflecting in their number. 2 things that they'll be watching out for improvement in the macro sentiment. One would be rural income growth, and the second would be winter crop yields. Both of them would give some, guidance as to when rural recovery comes by.
The operating environment has remained challenging this quarter. The effect of uneven monsoon was felt on Kharif crop output, impacting agriculture yields and rural incomes. Lower reservoir levels continue to be a cause of concern for Rabi crop, albeit crop sowing recently recovering. Winter this year has been delayed and less severe, and this has impacted the winter categories. Further, with rural consumer sentiment remaining subdued, the anticipated buoyancy from festival season did not materialize. The dualism that we have seen in the recent past continues, with certain parts of the economy recovering faster than the rest. For example, urban growths continue to outpace rural. Home and personal care and beauty and entire business put together has grown mid-single digit. Remember, this is 3/4 of our business. So already 75% of the business has registered mid-single digit volume growth. And it's the foods and refreshment, which is the quarter of the business, which Rohit explained, given commodity inflation, given a very different commodity cycle, which is where we've seen low single digit volume decline. And also, I want to call out the premium categories. If you look at beauty premium categories, if I look at the plus range within Horlicks, again, the premium part of HFD. If I look at newer formats, mask, serum, if I look at innovations like mayonnaise peanut butter. So these parts of the businesses are already showing double-digit volume momentum.
That is HUL for you. Moving on, shares of RBL Bank are higher in trade despite reporting a sharp rise in slippages in the third quarter. Abhishek joins in with the fine print. Abhishek?
Well, Rima, to begin with, it looks like the stability in net interest margin might have excited the street, given the fact that slippages have increased, on a sequential basis, and earnings are below pole on account of the provisions that they have done in AIF book as per RBI norms. So, net interest margin at 5.52% versus 5.54% in the previous quarter. Slippages increased by more than 23% quarter-on-quarter, with annualized slippage ratio being the highest in last 3 quarters. Retail segment over there, the loan growth was pretty robust, growing at 33.5% YOY and about 6% sequentially, while wholesale loan book grew by less than 6% on a YOY basis. Net interest income was at 1,546 crore, which is up 34.5% YOY and about 4.8% sequentially. AIF related provisions of about 115 crore was done in Q3 FY24. So with respect to our poll, the NII was ahead of our poll, and on account of this AIF provision, PAT came in below our poll. Back to you.
Okay, all right. Well, got that, Abhishek. So that explains why the street is seeing RBL Bank more as a story of a glass half full than half empty. Market wasn't so charitable with Hindustan Bank. We remember that. But Abhishek, tell us about Paytm now. Here, the stock is, moving higher, and I guess looking at some of the parameters, the losses are reducing. The EBITDA seems to have grown a lot. Tell us more.
Well, EBITDA improvement continues for Paytm like last few quarters. However, the loan have declined on a sequential basis in line with what guidelines the Paytm management had given earlier. So total income is up about 40% YOY and about 12.5% sequentially. EBITDA is up 7 times on a YOY basis and about 43% on a sequential basis. Contribution profit margin that declined sharply on a sequential basis, coming in at 53.3% when compared to 56.6% in the previous quarter, and the net losses have narrowed down when compared to YOY or quarter-on-quarter as well. We have a note, on Paytm from one of the brokerages, that is CLSA. They have upgraded the stock to buy, and from outperformance, target price increased to 960 from 925 earlier. They said that the company is diversifying more after the scale back that they have seen in buy now, pay later, and they expect that trend to continue in Q4 as well. So focus is on cost reduction. Company will try to offset the bulk of BNPL, buy now, pay later business loss by new revenue streams, cost reduction, etc. So they plan to add another 5 to 6 partners over the next 6 months, and they have increased, CLSA have increased the core EBITDA by 3% over FY25 to 26. Paytm is looking to grow in stock broking and mutual fund businesses, while CLSA believe that Paytm can make it big in derivatives trading as well. Back to you.
Thank you very much for that. The other one that I'm looking at is Tejas Networks. Now, Tejas Networks is a telecom equipment manufacturer, for the telecom sector. Okay, now the company has reported their Q3 numbers, and the key is that the revenue growth is very strong. The company's top line has gone up by 40% quarter-on-quarter and more than 100% on a year-on-year basis. The key reason for that is the company won a very large BSNL deal, and they're executing for that. So that's driving the strong order book, and as they execute that order, the revenue growth for the company has been very strong. In fact, you would see that, if you pull up a trend chart of the company's revenues, for many quarters, revenues were hovering between about 150 to 50 odd crore. But suddenly in the last 2 quarters, you saw the bump up in revenues, and that's courtesy this BSNL deal. In fact, the company said the first 9-month revenues of the company have exceeded the whole of last year's by 24%. But Despite strong revenues, the company is reporting EBITDA losses and increasing losses at the bottom line. So in Q3, the company has reported a loss of 7.5 crore, and for the full year, it's a loss of about 45 crore. This is the biggest loss that we've seen in terms of a bottom line loss in some time. The reason is because they're executing this large project, the company is making investments, whether it's in R&D or in procuring equipment, importing. So the inventory cost for the company has ballooned significantly, and it currently stands at 2,683. So quarter on quarter and on a year-on-year basis, the inventory expense for the company has gone up. Because of that, even the receivables have been on the higher side. So this quarter, receivables for the company come at 855 crore, and look at that average in the prior few quarters, roughly close to about 500 crore. So that's the story in Tejas Networks. Very strong top-line growth, very strong order book. There is cash in the company's books. Cash is about 560 crore, but there is that loss on the bottom line, which has disappointed the street.
I was just looking at a note that MK had come out with towards the end of December, and MK sounded a very optimistic note on Tejas that price target is above 1,000, I think 1,050 as what I can see, because they're talking about the longer-term changes, exactly what you're describing, Rima, that, they're going after big deals, making these big commitments in terms of upgrading their systems. And they are making a commitment of investing 750 crores under the PLI scheme as well. So I think when the company is looking at very strategic, big moves, there's bound to be some volatility in the P&L. But anyway, the market's verdict is very clear today. Stock is down 4.5%. On that note, let's move on and take a very quick break. We'll come back on the other side and get you the complete breakdown on Reliance Industries numbers, the complete overview across all the businesses in just a bit after the break.
Over the last 25 years, CNBC-TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome back. You're with us on Trading Hour. As promised, let's straight away dive in and look at the performance that Reliance Industries has put up at the end of the third quarter, showing growth pretty much across all of its key operating businesses. Sonia is joining in with a consolidated overview on the numbers. Sonia.
Well, thanks a lot for that. For Reliance, across segments, they had a good performance, especially in the retail segment, which was a stellar performance for them, and Reliance Jio, which reported stable earnings this time. But let's take a look at what brokerages are saying. Morgan Stanley has an overweight with a target price of 28.21 on Reliance. They say that the company reported the slowest investment capex in the last 2 years. Gas production is what drove the numbers this time around, and the net debt was flat. CLSA has a buy with a target price of 3,060. They speak about how capex has fallen to an 8-quarter low for Reliance. Macquarie has a neutral on the stock. They say the key positives this time was the very strong retail performance that Reliance delivered and a solid Jio subscriber addition as well. Nomura has a buy with a target price of 31.65. They talk about a sustained healthy performance for Reliance, and both the consumer businesses, Jio and retail, are picking up pace, and there's a sharp uptick in the upstream business as well. Finally, Jefferies has a buy with a target price of 31.40. They say Jio saw healthy subscriber addition. The oil to chemicals profitability declined on maintenance and lower spreads in refining and the petchem space. So largely positive outlook from most brokerages. Back to you.
Well, let me zoom in a bit on the telecom business. That's Reliance Jio, and it was a very steady quarter, bang in line with street expectations. The company's delivered a 2.5% quarter-on-quarter revenue growth, 10% on a year-on-year revenue growth, in line with expectations. The company's top-line growth has been driven by subscriber additions. So the subscriber additions for the company have come in at 11.2 million subscribers. This is on a quarter-on-quarter basis. And this is ahead of consensus expectations slightly, and it's the best that we've seen in the last 10 quarters. The subscriber base for the company now stands at nearly 471 million subscribers. ARPUs, though, for the company have come absolutely flat, unchanged on a sequential basis. So in-line numbers from Reliance Jio, and once again, it's the strong subscriber addition which is driving growth for the company. But moving on to Reliance Retail, Mangalam joins in with the fine print. Mangalam.
Reliance Retail is a juggernaut that keeps rolling on. $10 billion is the highlight in terms of quarterly revenue that the company crossed this time around, and that's the milestone that really stood out for me. Both revenue as well as EBITDA have been at a record high this quarter, but that's something that Reliance Retail is used to already. But 23% jump in year-on-year revenue, 30% jump in year-on-year EBITDA is something on that base which is breathtaking indeed. 7.6% margins, that's a near 50 basis points improvement year-on-year. Importantly, total footfalls crossed about 28.2 crore. The company added 252 stores this quarter. For perspective, other retail players, the second one, for instance, D-Mart, has around 340 stores in total. Reliance's footprint now stands at around 19,000 stores. And importantly, digital and new commerce businesses contribute around 19% to their overall revenue. We also saw strong growth across all parameters, all sectors. So grocery, for instance, grew 41%. We saw consumer brands delivering 3 times growth over last year. Of course, this comes on a low base. Fashion and lifestyle itself grew 28%, and consumer electronic grew 19%. The last known valuation of the retail business was $100 billion, but now that it's done $10 billion in quarterly revenue itself, maybe there is a case for a valuation upset or upside on Reliance Retail.
Okay, all right, Mangalam, thank you very much. So Reliance Retail doing well for the company. Let's finally get to then the O2C, the oil to chemicals segment. We have Sonal joining in to tell us exactly how that played out. I guess the upstream segment, all the gas that Reliance is getting from the KG basin, that was a big headline, Sonal?
It is record high EBITDA there, but let me start with the oil to chemicals business. It was slightly subdued, but understandable since the company had taken a maintenance shutdown in the quarter gone by. First, running you through the numbers, the revenues came in at 1.41 lakh crore rupees, which is an increase on a YOY basis. Their EBITDA came in at 14,064 crore rupees, largely in line with what the street was estimating. It is a decline on a quarter-on-quarter basis, but it is a good performance on a YOY basis, leading to EBITDA margins of 10%, which is an increase of 40 basis points on a YOY basis, down 100 basis points on a sequential basis. The company says that planned maintenance and inspection shutdown impacted yields and profitability. Had the planned shutdown not taken place, there would have been an increase in EBITDA both on a YOY and on a quarter-on-quarter basis. And planned shutdown is something that refineries do. It is a process which happens every 7 to 8 years for increasing the efficiency. So this is the reason for the weak performance on a sequential basis. Now going on to the oil and gas business, record high EBITDA, and it has been surprising every quarter. Their revenues came in at 6,719 crore rupees, EBITDA at 5,804 crore rupees, which is a big increase on a YOY and on a quarter-on-quarter basis, and higher than what Street was estimating as well. EBITDA margins came in at 86%. Their block KG-D6 is currently producing gas of around 30 MMSCMD, and to give you some perspective, 50% of the gas consumed in India is actually domestically produced, and we consume around 180 MMSCMD of gas every year. So this will be a big chunk of addition in terms of domestic gas production coming in only from Reliance Industries. Now I have a brokerage note which is from ICICI Securities. They say performance was strong across segments barring O2C. However, the last few weeks are seeing a jump in Singapore GRM, something that we've been pointing out, and this is something which would mean good refining performance from the company in Q4. Now going forward, the updates on green energy segment, media merger with Disney Hotstar, and momentum in retail and the upstream segment will be the key triggers to watch out for going forward.
Thank you very much for that. Let's move on then. We'll slip into a break. On that note, we'll come back, discuss market technicals. Mitesh Thakkar joins in. Stay tuned.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year with new milestones being achieved on Dalal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high. We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC-TV18, embarking on a quarter century of excellence.
CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key.
Welcome back. Here with us on Trading Hour. It is time to get to our technical experts to look at some trades for the day. Mitesh is with us. Mitesh, hi, good morning and happy Saturday. Didn't think we'll be discussing trading ideas on a Saturday, but here we are. So what do you make of things right now, the market, and any thoughts for today?
Good morning, Surabhi. I think the extra working on Saturday is compensated by the extra vacation or leave on Monday. So I think that balances it. But yes, I think, the markets, as I said, have been chopping around. They've broadly been in a range and we don't have a signal of a directional bias. So I think making a new high in the short term is ruled out. The key here would be 21,300. We saw that level come into play a couple of days back. I think as long as we are holding about that, this choppiness will play out for the next few days and then we should again start getting into some kind of an uptrend. Having said that, the stock calls that I have right now, GNFC, after a good decline from levels of 800 plus, has seen the stock price come down to about 700 and now is giving a reversal. So that's a buy with a stop at 744 and a target of 790 can be looked at. And M&M, disclaimer here, this is a recommendation to our clients. We have recommended the stock a couple of days back as well. I think it's given a pullback today. So giving a good entry point from this road equation. So keep a stop below 1630, 1628 here and look for targets of around 1680.
Okay, 1680 on M&M and GNFC is the other buy call from Mitesh. Thank you very much for joining in. Now moving on to the big story. 2023 was a great year for PSU stocks with almost 34 of them seeing gains of over 100% in the last 1 year alone. Nimesh yesterday in Editors Roundtable told us how the valuations are stacking up for PSUs. Let's revisit.
The PSE index has rallied 81% in calendar year 2023 and they've added nearly 22 lakh crores in terms of market cap. The entire PSU basket has added nearly 22 lakh crores in market cap only in the last 1 year. If you look at the big gainers, the 1/3 of the PSU basket, which is 33 companies, have rallied between 100 to 300%. That's the kind of move we've seen in the PSU baskets in the last 1 year itself. Now, I'll just break into the different sectors now. The first sector I'm picking up is railways. Nobody knows where the train is going to stop. But just look at the rally and the kind of valuations now. I just want to put a word on the valuations. IRCTC, it's trading at 55 times on the current year valuations. Ircon, which has been the big mover, that's now trading at close to 18 times. RVNL close to 32 times and RailTel is now trading at 35 times. I don't have the 5-year average for these companies, but this is the kind of valuation you're giving for the railway PSUs now. Next is look at the capital goods space. BHEL, that stock is after rallying 155% is now trading at close to 50 times. We don't have an average for that as well. HAL is now trading at close to 31 times versus the 10-year average of just 10 times. RITES is trading at 20 times versus the average of 12 times. And BEL is now trading at close to 34 times versus the 5-year average of 16 times. So that's the capital goods basket. how they are trading at after the big rally in those stocks. The third is the power stocks. Look at the power stocks as well. NTPC, NHPC, SJVN and Power Grid all are now trading in double digits multiple for current year valuations versus the 5-year average of all were trading below they were trading in single digits. Now all are into double digits. SJVN is now trading at 22 times on current year price to earnings. Now look at the finances of the PSUs. IRFC, the biggest mover of 2023, that stock is now trading at 4.2 times price to book on current valuations. You know, I don't think many of the even private banks are not quoting that sort of valuations. REC, PSE are almost at 2 times now, which historically they've been trading at just half time in the past. So it's been a big move in terms of the power PSUs as well. Now look at the banking. This is an interesting chart. The PSU banks, despite the rally, look at the valuations now. SBI trading at 1.4 times, the historics around 1.4 times. So it's not trading at exorbitant valuations. Bank of Baroda, Canara Bank, all trading close to one time price to book. And historically, they've been close to one time or half time price to book. So in terms of valuation, the PSU banks are still not very, very expensive even after the rally. And same is the case with the OMCs as well. Look at the OMC stocks. They all have rallied and the momentum just continues. But even in terms of valuation, HPCL is now trading at close to 8 times. Historically, it's been trading at 4.5 times. BPCL, after the rally, is now still trading at 8.7 times, whereas historic has been around 10 times. Same is the case with IOC as well. The only outliner in that OMC basket is Chennai Petro. That is now trading at close to 8 times on current year valuations versus the historical average of around 2 times. So, again, as I said, the entire basket has done really well. The PSC stocks have added nearly 22 lakh crores in market cap, but keep an eye on the valuations. Some of the stocks are now trading expensive than even the private company stocks.
Okay, all right. Well, that's a very handy reference check in terms of valuations after this absolutely phenomenal PSU rally. Thank you, Nimesh, for that. Take a break, come back and have a discussion on the markets with Rohit Srivastava from India Charts.
Of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Welcome back. As promised, let's get that conversation going with Rohit Srivastava of IndiaCharts.com. Rohit, thank you for joining in. Good talking to you on a weekend. I guess we're discussing markets this Saturday. So, tell us, it's a good time to kind of sit back and analyze everything that's going on. Now that we've had all this volatility around banks with a couple of the bank earnings, then there's the IT pillar, which provided some support. But when you put it all together, what does it tell you about the market? After the shakeout that we had this week, how do things look and where do we stand?
Not a pretty picture. Of course, we'll get the weekly closing only today based on the charts because, Saturday does get counted into the previous week when we actually plotting data. But having said that, this 3-day decline that we saw last week does look like a trend reversal of sorts. On classic Dow theory, when you stop making higher highs and higher lows, it's a trend reversal. So that is the first thing that has happened. The second is then are we just looking for a bounce? And if that is true, then typically you will not retrace more than 50 or 60% of what we have, done so far. Now, 50% is already done today at 21,710 odd. 61% is closer to 21,800, which leaves open possibility of maybe another 100 points on the upside. But our sense is that we might not go much beyond that and possibly the market turns lower from here and then, heads back towards a 20,600 kind of level. So that's the view with which we are working right now. The only alternate, I think, could be that given that we have a budget coming up, sometimes the markets may just not fall immediately. They may just remain lackluster till the event itself. Again, something we can't certainly say will happen, but a possibility that we'll have to deal with. But I'm at least not looking at new highs in the market right now.
No new highs, but a extension of the current bounce to levels of 21,800 is certainly possible. Rohit, what about HDFC Bank? That's taken the biggest knock this week. What are the charts telling you?
So HDFC has generally been a underperformer. It's not a stock that we trade actively either because it doesn't. When a stock typically doesn't move, then we sort of lose interest in even trading that stock. So it's been out of radar, but it is a surprise the way everything panned out simply because you don't expect these kind of wild movements when for quarter to quarter we were seeing some kind of earnings growth. There was a hope actually that things would actually pick up, but that has actually not happened. And now that it's sort of sold off, we might try to think, okay, is it oversold? Is the worst priced in? But like I said, the chart's not a pretty picture. It's like a double or triple top near the level of around, I think, 1710 where it peaked. And if I am very close to, I think, the previous support level, which is at around 1460 or so. If we break that, the risk is that it would then go to the next swing level, which is like 12,040 or 50. So we'll be watching this very closely. Does it really hold on to the low that it made, more than a month back from where it was attempting to rally again, closer to 1460, 1440? That range, if it holds, then there is hope. If that range breaks, then you'd see lower levels. That's how I'll think about it.
Rohit, so, considering that the overall picture for the market is looking a little tentative right now, what is the approach that you would take? And I'm not talking for someone, who's looking at day trading bets over here, but for positional investors or even positional traders, what's the best way forward now?
So for positional traders and investors, I think this is not the right time to be taking an entry because it's not clear that the correction is over, even though I know overnight US markets have made a new high. But you can get these kind of intermarket divergences in late stages of a rally where, one market makes a higher high, the other does not. Even in the internals of the US market, you can see that in the Russell not making a new high along with the NASDAQ or S&P yesterday in that sense. So similarly, at a global level, Indian markets may have peaked at the recent top. The US may still be making a new high, but doesn't necessarily mean that our market also, goes on and joins it. In fact, we've seen the unwinding process start when you look at positioning. When you look at FI positioning, they had gone long to almost 90,000 contracts. And now that is, down to almost zero. So which means they've given up all their long positions on the index futures. Now the question should be, will they start building on the short side? Because the last time the market bottomed, there was a short position of almost 175, 180,000 contracts. And we are far away from there. So I think there's room for a lot more selling to happen. And that is why this is not the entry point for positional traders. The trade, though, might actually be on the short side. So investors will, of course, have to wait for a better price point to be buying. But for traders, there may be a trade on the short side. We've retraced almost 50%, like we discussed earlier of the Nifty. Max 61% gives me around 100 points risk on the upside and possibly a downside of, 1,000 points from there. So the trade is really, I think, on the sell side of this right now.
Okay, that's interesting to note. And the time frame for this view of yours, Rohit, that markets perhaps are headed lower, they've formed a peak in the near term. Is it just still the budget or, in the next 15 days, or does it hold for a longer period of time?
So I will give it time a little more beyond the budget because, what we are not sure of is sometimes markets can simply remain lackluster till the budget before that sell-off happens. So will the sell-off happen before or after the budget? I think that will be harder to call. Keep time till sometime in February, maybe mid of February for this to actually play out.
Fair enough. Healthcare is a sector that you like. Why is that?
Well, the pharma sector was one of the underperforming sectors of, 21, 22, even when the market was doing well, it was not participating. So somewhere after that initial COVID rally, you saw a lot of pharma stocks, sell off, except for maybe the big ones like a Sun Pharma. But everything else was down, whether you go to Lupin, Wockhardt, Dr. Reddy. And now they are actually starting to pick up. And since we are seeing a pickup in this sector, I think what will actually happen is defensive bets start taking place when the markets weaken, when global macros start, creating certain headwinds. And that defensive buying into pharma, which has sort of been an underowned or undertraded sector for quite a while, can create a outperformance or a rally for pharma stocks, and therefore I think that's probably the only place I would be willing to take any bets on the long side. That is.
Okay, all right, Rohit, we will leave it on that note then for today. Thank you very much for joining in. Wish you a good rest of the weekend. Thank you for being with us today. Well, with that, let's move on and get you some important policy updates as well. IT Minister Ashwini Vaishnav has backed the mobile industry's demand for tariff cuts on imported components. He also says that Vodafone Idea is making sincere efforts to get investors. Take a look.
I want to go back to Telecom and address the Vodafone issue with you, because when we last spoke, you were hopeful that they would have been able to get investors on board. That hasn't been the case. The government continues to be the largest shareholder in Vodafone. Is that something that you are looking at today?
I think they are making their sincere efforts, and they've been regularly updating us about what they are doing. And I think we have done whatever we were supposed to do. And I think the journey so far has been okay. Of course, it's a listed company, so it's not proper for me to divulge any details or give any comments on that. But yes, they have been making sincere efforts.
So let's address each one of them specifically, and I'll start with talking to you about electronics, because that's the story that India has been pushing, and we have made progress and we've seen results. But industry is also demanding that there be a cut as far as tariffs are concerned, so that the story can gather even more momentum and growth can accelerate. Is that something that was taken up with you? Is that something that is up for consideration, up for review?
We have had a very detailed discussion on this with the industry participants, and most of the participants gave very clear, logical and cogent reasons why they are proposing what they are proposing. And basis our discussions, basis our consultations, we have also made a recommendations, kind of recommendation paper, and I think it's good logical next step, because what has happened is we have to now move from import substitution to export-led growth. That is the moment we need to, that is the transition we need to make. And that requires a totally different mindset, that requires totally different structure.
So there is a case to be made for a cut in tariffs, and you are in favor of that?
Absolutely, especially for the component ecosystem.
Okay, let's talk about railways then, because Ashwini Vaishnav went on to say the progress in railway expansion and modernization is huge. The minister outlined expansion plans for the Indian Railways. Listen in to that excerpt too.
Let's also talk about railways. And you said that you had meetings with the Swiss authorities here, but I also wanted to understand from you, in terms of the ambition and aspiration now as far as railway capex is concerned, as far as building on the project momentum is concerned, what's the view, what's the road ahead?
See, the progress in railway expansion and modernization is huge. For example, last year we added 5,200 kilometers of new tracks. That's like adding the whole network of Switzerland in 1 year. 5,200 kilometers. This year we are doing at a pace of 15 kilometers a year. So 15 kilometers a day. 15 kilometers a day is like huge. We have just, out of the $29 billion capex that we have planned for this year, 2,40,000 crore, we have already accomplished 77% as on yesterday. I get a report on a daily basis. I monitor it so closely. So we have already achieved 77% of it.
Well, that is the word coming in. With that, let's move on. The union budget is less than 15 days away. What is your wish list for the finance minister presenting the CNBC-TV18 budget ballot? You can now share your budget expectations with us on our website by scanning the QR code on your screen. or by logging in to CNBC-TV18.com/budget.
Grow on the go with CNBC TV18. Now streaming live 24/7 on YouTube. A show that is unmatched.
We tell you stocks to watch out for and which sectors are impacted.
Thought-provoking.
In India, the allocation to equity is about 5 to 10%, which is not beating inflation. So investing aggressively, you can actually look at even beating inflation.
And will give you maximum value for your money.
It is a good time to look at debt funds as a category. There's no better time than this in that sense to lock in rates for the long term.
A masterclass with India's biggest market experts. Smart money at these times. The last hour. Anything can happen between the bells. But what happens during the last hour is what matters the most. The biggest market swings. A close-up look at what's driving them. And how the investors are reacting. Watch the most seasoned market mavens guide.
Welcome back. The rally in railway stocks continues. RailTel has gained 14.5% today. RVNL has an up move of 10%. IRFC has gained 10%. The fierce gains in these stocks continue for yet another day. Tourism-related stocks. So ITDC is a stock which, pops up right now. ITDC has a gain of close to about 9.2%, and it's moving up on pretty large volumes this year itself. ITTC, that's Indian Tourism Development Corporation, has a gain of close to about 44-45%. And other than that, you've got Tourism Finance, also a big mover today, 15% rally. And in this year, it's seen a gain of about 55%. So tourism-related stocks, railway stocks, SIS too, where there are certain reports which suggest that SIS has been tasked with the security at Ayodhya. So SIS has been moving up and on pretty good volumes. PSUs, the rally there continues. So MMTC stands out for the kind of price action that it's seen, and PTC India Financial has suddenly surged in trade, and that stock is up close to about 15%. But the big day, in fact, there are 40 companies reporting numbers. The prominent one amongst them will be ICICI Bank and Kotak Mahindra Bank. But then you've got others like IDBI Bank, Persistent Systems also reporting numbers. So let's talk about ICICI Bank. Abhishek joins in with the key expectations. Abhishek.
Well, for ICICI Bank, cost of funds could weigh on the net interest margin, given the fact that analysts are pegging NII growth to be the lowest in last 21 quarters on a YY basis, and PAT estimated to decline on a sequential basis. The key thing to watch will be that Kotak Securities estimates loan growth to be strong, about 18.5% YY and 4% quarter-on-quarter. Net interest margin can come under pressure. Now, Morgan Stanley estimates net interest margin to decline by 17 basis point quarter-on-quarter. Provisions can rise quarter-on-quarter as per Kotak Securities estimate. Now, slippages may rise quarter-on-quarter, but watch out for the fact that where the slippages is coming from, either from known stressed accounts or fresh slippages from the book that is coming around. Morgan Stanley expects slippages of 5,250 crore, which compares to a little under 4,690 crore in the previous quarter. Asset quality will remain stable. Motilal Oswal expects a gross NPA ratio to be at 2.5% versus 2.48% in the previous quarter. Watch out for the commentary with respect to business momentum going ahead, that is loan growth and deposits. And two key book numbers will be seen closely, that is watch list about 4,790 crores and restructured book of 3,540 odd crores will be seen how they behave. Our polls suggest NII growth of 12.2% YOY and about 0.9% sequentially. We are working with a profit growth of 20.3% YOY and a decline of 2.5% sequentially. Back to you.
All right, Abhishek, also Kotak Mahindra Bank, what's the expectation there?
Well, here as well, cost of funds could weigh on the NII growth. So Street is anticipating lowest NII growth YOY in last 8 quarters, while PAT growth to be the lowest in last 9 quarters in terms of the growth rate momentum. Now, loan growth expected to be strong. Motilal Oswal estimates a loan growth of 16.5% YOY and 4% quarter-on-quarter. Again, Motilal Oswal expects deposit growth to be strong, about 20.5% YOY and 3.5% quarter-on-quarter. Net interest margin can remain stable sequentially. Morgan Stanley estimates flat net interest margin quarter-on-quarter. You need to watch out for the low-cost deposit momentum. Remember that for the entire industry, CASA ratio is declining, and we need to see how much it declines for Kotak Mahindra Bank as well. Last quarter, it was around 48.3% for the bank. Asset quality expected to improve. Motilal Oswal expects a gross NPA ratio to decline by 9 basis points quarter-on-quarter to 1.63%. And management commentary and outlook with respect to business momentum going ahead will be seen closely. Our polls suggest NII growth of 13.7% YOY and 2.1% quarter-on-quarter. We are working with a profit growth of 13.2% YOY and a decline of a little less than 1% on a sequential basis. Back to you.
Okay, thank you very much for that. Persistent Systems in the IT pack will be reporting numbers. Expect a steady quarter. It's not going to be a great quarter, but it's not been a great quarter for the industry because of seasonality, higher furloughs, and plus discretionary demand. And Persistent gets a fairly high share of the discretionary demand that's been under pressure. So 2.2% dollar revenue growth, constant currency revenue growth is seen at 2.6%, and this is slightly lower than the growth rates that Persistent has clocked in the last couple of quarters. Margins are seen up 40 basis points to 14.1%, and that's because Q2 margins were lower on account of wage hikes, and there will be a slight increase in the profitability. The company has been talking about industry-leading growth this year and expansion of margins over the next 2 years. In terms of what will be watched from the management, as I said, they have a higher contribution or share of the discretionary tech spending, and they had indicated that the macro is challenging, that now it takes 2x the pipeline to convert it into a deal versus 1.5 times earlier. So I think, is the macro changing, improving? That's something the street will be tracking, considering the stock has done very well. We'll slip into a very short break. As we do that, listen into market opinion coming in from Dheeraj Agarwal, MD of Ambit Investment Managers.
The few results which have come out very clearly show that there is tightness in liquidity, which is showing up in banks facing difficulty in growing the deposit book. So we have known this for a while, that the credit growth has been stronger than deposit growth. The deposit growth needs to pick up in order to either maintain the credit growth, or the margins will have to take a hit. This is now finally playing out. So I think there will be some more adjustment time for this process, either through some more margin contraction or even credit growth slowing down a little bit. In the last 1 month, especially, IT is benefited because banks have come down. Growth is under pressure for IT. I think the big sort of the judgment day for IT is going to be the December quarter results, when there will be a much better sense on what the budgets for next year look like. There is still a divided house at this point of time on the street. Some people think that the growth will rebound in FY25. Some people think it will not, or not by meaningful margin.
Second hour for trading day. NSE closing bell. At these times, only on CNBC-TV18 and CNBC-TV18.com. From David to Goliath, from the smallest business ventures to multi-million-dollar global corporations. Meet the movers and shakers, today's newsmakers, and tomorrow's leaders. Understand what makes markets move, how companies make quantum leaps, and how giant corporations stay ahead. Get the biggest business stories of the day, power-packed into 30 minutes. On Business 360 at these times. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
On the back of the measures that you've already taken and one involving the AIF, so there are representations being made by that industry.
Welcome back. There is still some green, but the Nifty is also slipping a little bit. We have to keep that on play. Just 14 points up on the Nifty, hardly 3 points. Okay, sensex in the red now, even as I'm saying that sentence out. The large cap indices, they are slipping, though the mid caps are doing much better. Let's pull up the intraday chart if we can very quickly. Talk about where the pressure on the Nifty is coming in from. Reliance Industries is a stock that's heading lower, and HDFC Bank is losing some of that early momentum that we saw. And then there's likes of TCS and HUL in any case. So these, between all of them, these big four are ensuring that we're getting some red now on the large cap names.
Even M&M has actually moved to the day's low. So pull up M&M, that's down 1.5%. And Hindustan Bank follows up yesterday's cut with another 1.5% downtick. So sensex in the red, the Nifty is completely flattened out. Mid-caps, so far at least, are holding on to their gains. But as we wrap up on Trading Hour, we will leave you with some interesting opinion that we got from Davos. The India steel demand will grow in double digit. There is a strong focus by the government on infrastructure capex across sectors. That's the word coming in from Jayant Acharya, joint MD, CEO at JSW Steel. Speaking to Shireen at World Economic Forum in Davos, he outlines their capacity expansion plans, talks about the company's upcoming green steel facility.
Given the fact that you are excited about what is happening in India as well as the opportunity that it presents itself in the near term, in terms of your business, what is it going to mean? We spoke just before the year closed out, and you were confident about being able to add capacity, both from a domestic point of view as well as an export perspective. How are things shaping up in 2024?
Things are shaping up well. As I mentioned that time, I think the India demand, we believe, is going to be in double-digit numbers, possibly for the medium term. This year, we see a growth of 14% in demand in India, which is very encouraging. We see a strong focus by the government on infrastructure and the capacity and capex across sectors. So that's very good. Manufacturing is strong. We see the energy transition piece being encouraged very, very strongly by them. So solar, wind, hydro. And all of these, as we discussed the other day, require steel. And therefore, a strong demand of steel is emanating. Typically, during this nation-building phase, as we call it, I think India is going to need a lot of steel. So we are adding domestic capacity, JSW, as a part of the national steel vision to reach 300 million ton of capacity. We would like to be at about 50 million ton by 2030. Our plans are more or less on track. Currently, we are commissioning a 5 million ton facility in Vijayanagar in the next few months. And we believe that the next phase of expansion in brownfield locations in India will be our next priority between Dolvi, Vijayanagar and Jharsuguda in the east.
Okay, so you gave us a 2030 outlook and you also talked about the brownfield expansion. So say by 2025, in terms of the incremental capacity that comes on stream, what could it look like?
So JSW Steel today is about 30 million tons worldwide. Out of that, 28 million plus is in India. We expect to be about 35 million ton by FY25. And the international piece stays at about 2 million odd. And we plan to grow this in 3 locations, as I was mentioning, 5 million tons each. So there'll be an additional facility which will come at Vijayanagar in south of India. And there'll be one which will come in the west of India in Dolvi. And the third one will be in Jharsuguda. So this 15 million will take us to 50. And we do expect that in the next 5 to 6 years, we'll be there with this capacity on ground. We are also planning to add a green steel facility, in view of the various climate challenges which we see and steps being taken by the European Union specifically. We are planning a green steel facility which will also mostly be in the west. We're considering various locations, but mostly in the west.
What's the outlook then in terms of prices and through 2024, given the supply and demand at this point in time, as well as the implications of what happens in China, whether we see a recovery that takes shape or it's going to be slower than expected? What could it do to global steel demand and pricing?
So from a supply-demand perspective, I think as you mentioned, China did have a slowdown because of the property sector. But the rest of the sectors in China have done quite well, surprisingly so. And I think they have taken various initiatives to stabilize the economy. So we are seeing the steel production by and large at a similar level as last year, and the steel consumption at a similar level as last year. But the exports from China have gone up, and that is a concern. And the supply, therefore, into the world has increased. Going forward, I think this year we see, the good things are the inflation is reduced quite a bit. We see interest cuts which have already been indicated by US and by other regions as well. So that would encourage consumption and investment both, and that would require steel. A lot of rebuilding of countries and rebuilding of regions will happen. So we feel on a supply demand in the medium term it should be good. On the shorter term, I think we need to be cautious in India because India is growing. We should be wary of any unfair trade which comes into India at low prices, which would hurt us.
Well, that I think the government is always watchful for, and mechanisms are in place to impose duties as and when the government believes there to be a case. Is there a case at this point in time to be made?
There is a case growing because I think today India is a net importer in this year of steel, which is not a good thing. And what is worrisome is that some of the cheap imports are coming into India at prices which are predatory, and that is our concern. If it's fair trade, we are good to go. If it's prices which are below at times their domestic prices or at a loss, then it's a concern.
Have you taken this up with the government recently?
Yeah, we are in discussion with the government in terms of
any
steps
specific
which
products
should be taken. It is actually across various product lines, but mostly in the flat steel space.
Okay, and what is the, when you talk about predatory pricing, I mean, how predatory is it?
I think without going into numbers, over the last 3-4 months, it has been a little challenging. But I think of the last few weeks, Chinese prices have gone up. Maybe international prices has gone up as well. So Chinese prices have moved up by $40 or so. The prices are still a little on the lower side, and we understand that Chinese steel companies are probably at a loss or at a marginal cost at this level. So there is a case for us to take up with them appropriately.
Etc. to the Finance Ministry as well as to the Reserve Bank, saying that perhaps there needs to be a review of that decision or at least more time given. You've obviously, I would imagine, have heard from them. How do you respond to that?
You see, this decision is the result, is the culmination of more than 1 year of keeping track of the developments in the AIF sector. It's not as if suddenly something came to our notice and we acted. We have been tracking these developments for about more than a year now. And initially we saw some signs here and there. So when we see some signs here and there, we try to deal with it on entity-based approach. Our supervisors take it up with that particular entity and try to deal with it on a bilateral basis. But when we see something, becoming, showing signs of getting widespread, we had to act.
How widespread is the problem today?
No, I can't again quantify it, but there was this whole issue of evergreening that was taking place. So therefore that had to be prevented. All that we have done is that we have also said we have not stopped any lending. We have only said that if you want to continue, you treat it as, you treat it in a particular way and you provide for it in your accounts. And so that is what we have said. And some representations have come, they are being examined.
But could there be any kind of review as far as the
decision is concerned? No, I can't say. It is being examined. We have got number of representations. They are being examined. And with regard to the decision, it's a well thought out decision to prevent a kind of a new source of stress or a new source of problem for the Indian banking sector.
Market trades in a narrow band with the Nifty and the Sensex holding on to minor gains. Banks and PSU stocks lead the up move with FMCG and IT seeing some profit taking. The mid-caps outperform in an otherwise thinly traded day.
Reliance Industries reports what is a steady third quarter. We have the retail business revenue, which hits a record high. Jio reports a 2% rise in average revenue per user. Oil and gas business reports record high margins of 86%.
HUL falls on the back of weak third quarter earnings. Revenue declines marginally as volume disappoints while EBITDA remains flat. The management cautious on macros and rural recovery. Brokerages bearish on the stock.
RBL Bank gains 2% as the street overlooks the rise in slippages, focusing on the stable net interest margins and strong loan growth. Paytm is in the green as losses reduce quarter on quarter and EBITDA surges 43%. Tejas Networks falls 4% on mounting losses courtesy rising R&D costs. Well, hello and welcome to a halftime report. I'm Ekta Batra and with me is Mangalam Malu. Well, it's turning out to be a Saturday session, you'd have to say. So it's absolutely flat for the Nifty and the Sensex. We have some amount of interest which is coming in for the mid-cap, so up around 0.7%. The Bank Nifty, which is up around 0.5%. And Mangalam, I was just noticing that despite the fact that it's a holiday, it's quite important in terms of a trading session when it comes to earnings as well as especially the financials. We've spoken ad nauseum about ICICI Bank and Kotak coming out with numbers. Just look at the other numbers coming out today. Union Bank, IDBI, IDFC First Bank, JNK Bank, Canfin Homes. All of these companies are reporting numbers today. So I think Tuesday is going to become quite critical if in case they do come out post-markets. Separately, besides non-financial numbers, we have Persistent, JK Cement, Rosari Biotech. So it's a full day.
It is a full day. In fact, more than a full day because 25%.
It's not only a full day for working.
Yes. 25% of the Nifty is either reacting to earnings or is likely to report earnings. So we have Reliance and HUL, which are reacting to earnings that came post-markets yesterday. And then we have, the other ones as well, which are reporting their numbers, which is the likes of ICICI and Kotak, the ones that you're talking about. Meanwhile, a bunch of these mid-caps are doing well. Rain Industries, for instance, up around 5%. Our team just fired Rosari Bio. That was up as well. Tire stocks are higher. But there's not much that can be made of these moves because the larger participants of the market, both the FIIs and the DIIs are largely absent. And as a result of which, there perhaps could be some sort of fun and games happening in individual stocks itself. So just be mindful of those moves itself. Ekta, you said that, it's turning out to be a certain session. But what's interesting is that yesterday when we opened the show, we were like, oh, this is the last trading day of the week. Turns out not.
Well, yes, absolutely. We were in for a surprise on that one. But nonetheless, next week, in fact, we just have 3 trading sessions. So I think maybe, that's the reason and the rationale behind keeping today open entirely. But nonetheless, like you mentioned, the interest is definitely much lower. Volumes are much lower in today's trading session. But we have a lot of stocks which are still reacting. And first up is HUL, which is in fact one of the top losers on the Nifty today. It is weak on the back of what is a weak set of Q3 numbers. Brokerages such as HSBC and Morgan Stanley also have issued bearish calls. Tell us more.
Well, the numbers were weak. The expectations were weak. The numbers were weaker than what the weak expectations were. And this has been the case for HUL for the last few quarters, more than, 3 or 4 quarters. In fact, Morgan Stanley has written and they say that their earnings for HUL have been below estimates for the 4th quarter in a row. Weaker top-line growth due to lower volume growth. Negative pricing growth remains a headwind. They've cut their target price from 2,500 odd rupees. Remember, the stock has not done much in the last 12 months anyway. The target prices have been cut further now to 2,464 odd rupees as well. They have an equal weight rating on the stock. HSBC has downgraded the stock to reduce. The target's cut from 2,700 to 2,350. They say the outlook appears uncertain and growth itself is lackluster. Importantly, the terminology FMCG for HUL and all the others, ICICI has decided to perhaps question that itself. They're calling it SMCG. Now, it's not fast-moving consumer goods, it's slow-moving consumer goods. So let's see how that pans out. In fact, I spoke to the management yesterday post, the results itself and spoke about when is it that they expect any sort of recovery in the volume growth and also, importantly, the outlook on margins. The company spoke about 2 things in particular that they're watching out for. One is income growth in rural India and secondly, the yields of the winter crop. Those two factors will give them a reasonable sense of what is expected in the rural economy. Listen in.
Our focus remains on driving gross margin. First, we got our gross margin improved, and we brought it to the levels of pre-high inflation. The second job that we have, so remember pre-inflation, we had roughly 52% margin, gross margin, which we brought back. And our job now is to go back to pre-COVID levels, where we had 54% gross margin. And hence, driving gross margin will continue to be a tremendously important focus for us. But equally, as Rohit mentioned, dialing up investments, not only in advertising, sales promotion, but also in product superiority, also in capability, remains squarely important, and leaning in as required on price and promotion, the way we have done in this quarter. When you saw in this quarter, our sequential margins for beauty and personal care and home care declined a little bit compared to the previous quarter, because we leaned in with product investments, we leaned in with price and promotion to ensure fuller volume recovery. So there are those puts and takes always in the P&L, and where our margins are today at 23.7, they are healthy margin. And we have maintained that the levels of margin that we have today, we are happy with this margin. Our single-minded focus is to ensure fuller volume recovery and keep dialing up growth.
Your assessment would lead to, growth in volumes once again from a macro standpoint. By when do you see recovery in rural?
Yeah, so there are two factors we called out which will really determine the pace of recovery. Number one is the rural income growth, and we know that that's an area which is important for us to see those markers. And second is the winter yield. In our view, those two elements should determine the pace of recovery as far as rural is concerned. And as you mentioned that overall there are categories like F&R, which today we have lower single-digit volume decline because of commodity inflation. Now, the good news again is where we are today, we are seeing commodity inflation in food categories also moderating, which means now, like the balance 3 quarters of the business, even this part of the business then should start seeing year-on-year price inflation getting moderated, and then should help further recovery of volumes in that portion of the business as well. So those, I would say, are the two large elements which should determine sequential further recovery of volume from where we are today.
And just to follow up on that, the points that are within our control are invest in market development, sales, which have got the future spaces where we see consumer upgrading. We see high growth there already at about roughly 2 or 2.5 times our average. Premiumization, we see again, those segments are growing very, very fast. Innovations both in value and feature. So the job we as market developers and market makers is essentially to lean in on those vectors. And we see high level of productivity of doing that. And all of the investments and moves that you're seeing from us are essentially to put more focus around market development, premiumization, and innovation.
Okay, well, that's the management of HUL. We need to take a short break. But on the other side, we will have the FMCG analyst of Sher Khan joining in to discuss more on the Q3 performance of the company. Stay tuned.
Whether it is the industry or the private sector, or it is the analysts or the economists or the serious the market players. In the context of India, I don't think anybody is expecting a rate cut now. In most of the advanced economies, the markets and the stakeholders and the market players, their assumptions, it is ahead, they're overrunning their central banks. So far as India is concerned, I think the thinking of the central bank and the thinking of the market participants, they are much better aligned. In inflation, with regard to inflation, I have said elsewhere that our policy has to remain actively disinflationary till we reach the target of 4% on a durable or a sustainable basis. You are right, absolutely right in saying that any premature pivot in our policy, it can be very, very costly for the economy. If you see the last 1 or 2 years, the deposit growth has been around 12 to 13%. Yes. The credit growth has been about 15%. Now, obviously, you see, it's not that you get X amount of deposit and you extend that X amount as a loan. It's not like that. share prices in the stock market do not necessarily reflect the fundamentals of a company. I'm talking in general terms, not with reference to a particular bank. Generally, if you see, the stock prices are determined by so many other factors and do not necessarily reflect the fundamentals of a company. You have examples in every sector, whether it is the financial services or banking or any other sector you look at. There are companies with very strong fundamentals, but its share prices should be low. And the converse also happens. So therefore, it will not be correct to judge the health of a particular sector like banking in particular in terms of share prices, movement of share prices, and that too on a single day.
There is a concern or perhaps confusion as far as the credit deposit ratio is concerned and whether the RBI is likely to mandate a number or not. Could you clarify this for us?
You see, we have not mandated any number. I think there was...
Welcome back. Well, for the mid-cap index, it's holding up with a gain of around 0.7%. We have a good advanced decline ratio on our hands, so there's no complaints coming in. We have HUL, which is the top loser on the Nifty, so down around 3-odd%. Mangalam, we have an analyst waiting by to field a couple of questions.
Yes, we do. We have Kaustubh Pavaskar of Sharekhan joining in. Kaustubh, HUL has continued to disappoint for the last 3 or 4 quarters, but the stock also hasn't done much. So what are your thoughts? I mean, would you look at allocating some part of your investment portfolio to HUL, given that it's done nothing and maybe now things may improve, and as a result of which valuations appear a lot more attractive than what they were, say, 1 year ago? Or would you look at other growth opportunities in the space?
Obviously, so HUL for past 1 year it has underperformed the broader indices, and the clear reasons are its overall underperformance in terms of performance for past 3 quarters. But we believe that once rural recovery is back, I think HUL will also see a good recovery in its volume trajectory. The company has already undertaken pricing action in some of their high competitive categories, and we have already seen 75% of the portfolio recovering to mid-single digit volume growth. 25% of the portfolio, which is foods, largely foods and refreshment, the volumes are lower on YY basis. I think in recovery in that particular space should also start from quarters ahead, considering the fact that even dairy prices are somehow stabilizing. So I think we should expect volume growth recovery to start maybe from Q1 of FY 2025. We should also expect some government push in budget for the rural economy, and that should also help to build in the sentiments. So overall, we expect that one should start seeing recovery from maybe Q1 end or Q2 of FY 2025, and that should continue.
Okay. Kaustubh, just, sort of narrowing down in terms of the volume estimates, can you tell us what you're anticipating or expecting in terms of volumes when it comes to Q4? Hence, what would their exit be? And what is your expectation in terms of Q1 when you're talking about that possible recovery to come through?
See, I think in Q4 and Q1, I believe the volume growth will remain in low single digit, maybe around 2%, because as I said, that 75% of the portfolio is doing good, and there the volume growth would continue to remain at a mid-single digit. The only issue is food and refreshment part, where they should start seeing recovery in the volumes. So once that happens, we should expect volume growth to recover to mid-single digit, and then it should gradually recover to its range of around 6 to 8% once we start seeing a good recovery in the rural markets. So that is what expected is like from second half of FY 2025, if everything is well, and even if monsoons are a little good, I think we should expect volume growth to recover to around mid to around 6 to 8% kind of a thing. But in the near term, we should expect it to remain in low single digit.
All right. Where would you put your money in the FMCG space then? If HUL is doing low single digit volume, there are a couple of stocks which are outperforming in this sector in terms of revenue and volumes. The last 1 year or so, Nestle has done well, Tata Consumer has done well, Jyoti Labs has done well. We've seen decent numbers coming from Godrej Consumer as well. But all these stocks have moved higher too. So what are your top picks right now, and how do you play this space?
See, our top picks in the space are Tata Consumer Products. So clearly, we have seen that that company is performing really well, and they have been increasing their portfolio organically, inorganically. Their growth business is doing extremely well. It is growing about 20%, and I think with recent acquisition, it will continue to grow above that. These are the margin accretive acquisitions, and over the next 2 to 3 years, we should expect at the consolidated level Tata Consumer's margins to also improve. So I think Tata Consumer is one of our topics. We also like ITC mainly because of the fact that valuations are still attractive compared to overall basket, and we believe that the FMCG business will continue to do well. Its margin will continue to improve in the coming years, and that will be key driver from the earning perspective for ITC along with its core cigarette business. So I think even ITC looks good. In this small cap space, we like Mrs. Bector's Food because that company has consistently driven double-digit kind of a volume growth. The clear thought process is to expand its reach in the domestic market, which will help it to achieve good volume growth, and even the margins have improved consistently in past few quarters. So I think that stock looks attractive considering the fact that it has seen a good correction in the recent times. Jyoti Laboratories also we like because, as you correctly said, that it is one of the outperformance in terms of the growth what we have seen in past few quarters it has done. So I think that will also continue to do well.
Okay, all right, Kaustav, we're going to let you go and enjoy your Saturday. Thanks very much for joining in and speaking with us and giving us your brief in terms of the HUL numbers. Well, it is going to be critical, and Sher Khan expects that volume recovery is probably going to play out Q1 FY25 onwards. For the next 2 quarters, at least for Q4, we can expect low single-digit volumes for that FMCG major. Well, we need to take a short break, but up next, Sachidanand Uttikar of Trade Bulls will join in with his trading calls. Stay tuned.
Let's leave that. But what I would like to say very clearly is that we have not mandated any number that this shall be the credit deposit ratio. We have not, and at the moment we don't propose to, because credit deposit ratio is just one of the parameters to assess the health of a bank. There are several other parameters. So you have to look at it all in totality. All that I can say is that there should not be exuberance in lending, number one. Number two, there should be some correlation between your deposit base and your credit growth. There should be some correlation. But in terms of hard coding it, in terms of a particular number, there is no such proposal in our mind, and we have not prescribed any such number.
Let's address what's happening across industry today. And I want to address the issue of why Wipro's decided to sue Jatin Dalal. I mean, been with the company for decades. Why the decision to do that?
Yeah. So Shireen, I'm not going to get into a specific case, but let me just say the following comments, right? One is we are simply enforcing a standard industry contract that everybody sort of follows. We are not creating any prevention of employment or job opportunity for anybody, right? And we're simply ensuring that, that we've signed a contract, and we want to ensure that we protect ourselves from an information standpoint along those lines. So I wouldn't read more into this. I find sometimes there's a tendency to sensationalize this.
No, it's not sensationalizing. I mean, it's an unusual thing to happen.
We're simply enforcing contracts, which is not an unstandard thing.
For us, India is worth the investment that we're making in India. So when you look at India, it accounts for 10% of our global trip volume. So India is huge for us, and India is growing at about twice the rate that the rest of the world is growing at. So fast forward, if we're talking 5 years from now, India is going to be an even larger portion of our business.
Talking about the growth opportunity that you see in India, what is it going to mean in terms of expansion plans? What is it going to mean in terms of incremental investments? And do you now regret getting out of Uber Eats in India? Look at what's happening with companies like Zomato and Swiggy there. Are you?
I have to tell you, the nice corporate thing to say is I have no regrets. I'm a little jealous. It's a great opportunity, but we made a commitment as a company to invest in businesses where we thought we could be the number one player. Because in order for you to have positive returns on capital, and in the end, we're a business, you got to get to number one. We thought on food delivery.
Well, the volumes are generally on the lower side today, but we do have a bunch of stocks which are doing extremely well. Some of them include the likes of RITES, which has just bagged an order of close to around 414 odd crores for construction work in IIT Bhubaneswar, as a result of which the stock has spiked by about 11 odd percent. Most of the gains coming by in just the last few seconds as the flash hit the screens. But a lot of these PSUs, EPC and engineering stocks are doing well, and most of them belong to the railway category as well. Case in point, IRCON, we have IRCTC as well, which is now spiked higher, almost 6% higher as we speak. NBCC is the other one from the broader markets, which is doing well at the high point. And Container Corp reports its results next week on the 24th. That stock is up ahead of those numbers. We do have their volume update already. But in this low trading session, what should your nifty trading strategy be and individual stocks? We have Sachidanand Uttekar joining in on this Saturday to tell us. Sachi, good to see you all suited up on a Saturday afternoon. What are your thoughts on the index and individual stocks?
Good afternoon, Mangalam. Good afternoon, Ekta. I think clearly it's a low, volume trading session, and if you look at both the indices, they are still, trending within their previous day's swing range. But when you look at, both the data, I think data is much more promising when it comes to Nifty, and probably the way it has been responding towards the support area at around 21,570, which is its 5-day exponential moving average. Probably we may see this particular range of 21,600, 21,700 getting breached on the higher side, and we may see an extension move towards 21,850. So probably, Nifty is one particular area wherein some long commitments can be taken. Even right now, the data is more of consolidation. But eventually we see that there could be a price expansion which can push the Nifty higher towards 21,850. And that's why we are recommending long positions here at with a stop loss summit close to around 21,570. When it comes to Nifty Bank, I think the range is well defined until unless we don't see it crossing that 46,300 mark on the higher side. We may not see any major turnaround in the trend. But on the lower side, the weekly support area, the gap support which has been formed at 45,300, it is a major trend support. So probably we may see Bank Nifty, drifting one shade lower, but it may remain range bound within this particular, range of 46,300 to 45,300. So I think Nifty is in a better spot wherein some long positions can be committed.
Okay. Any, strategy specifically on financials which you would recommend, considering that that's going to be an extremely newsy space?
Well, Ekta, as of now, we are not focusing on financial stocks because there are a lot of variations there. But if you look at some of the pockets of strength, as Mangalam pointed out, there's a good traction within railway stocks. Concor is one particular area stock which we expect that there could be a strong rebound. The stock has already given a decent correction. It looks like a classic zigzag wave completion. And we are seeing that the stock can rebound back to its life high level. So here we are recommending long positions. A disclosure that we have also recommended, taking long positions here in Concor to our clients. So we are expecting a trading target of around 920. And the stop loss can be placed somewhere close to around 864 from a trading perspective. The other space which has been buzzing is the tire stocks. And here I think Balkrishna Industries has been oscillating within the range of 2,700 on the higher side to 2,500 on the lower side for the last 3 months. So right now we are anticipating that that particular consolidation is quite mature now, and probably we may see the stock ejecting that range. So from a trading perspective, we are expecting a swing towards 2770, and that's why we are recommending long positions here, keeping a stop loss somewhere close to around 2620.
All right, thank you, Sachidanand, for giving me your stocks and individual picks, etc. But I'm rather curious with the way he's suited up on a Saturday afternoon. Are you sure that you are fully suited up, or are there shorts that you're wearing, Sachidanand?
It's business as usual, so it continues.
So it's a full suit that you're talking about.
But I have to admit, it must be tougher because I could hear your kids from behind. It's no school,
exactly.
And it's a full working day for you. So hats off.
Thank you so much.
We're not going to ask you to stand up. We're not going to ask you to stand up. All right, Sachi, thank you so much for joining in and giving us your stock and individual views. Let's move on and talk about 2023, which was a great year for the PSU stocks, with almost 34 of them seeing gains of over 100% in the last 1 year alone. Nimesh yesterday in the Editors Roundtable told us how valuations are looking like for the PSUs after this massive up move that we've seen. Let's revisit.
The PSE index has rallied 81% in calendar year 2023, and they've added nearly 22 lakh crores in terms of market cap. The entire PSU basket has added nearly 22 lakh crores in market cap only in the last 1 year. If you look at the big gainers, the 1/3 of the PSU basket, which is 33 companies, have rallied between 100 to 300%. That's the kind of move we've seen in the PSU baskets in the last 1 year itself. Now, I'll just break into the different sectors now. The first sector I'm picking up is railways. Nobody knows where the train is going to stop, but just look at the rally and the kind of valuations now. I just want to put a word on the valuations. IRCTC, it's trading at 55 times on the current year valuations. Ircon, which has been the big mover, that's now trading at close to 18 times. RVNL close to 32 times, and RailTel is now trading at 35 times. I don't have the 5-year average for these companies, but this is the kind of valuation you're giving for the railway PSUs now. Next is look at the capital goods space. BHEL, that stock is, after rallying 155%, is now trading at close to 50 times. We don't have an average for that as well. HAL is now trading at close to 31 times versus a 10-year average of just 10 times. RITES is trading at 20 times versus the average of 12 times. And BEL is now trading at close to 34 times versus the 5-year average of 16 times. So that's the capital good basket, how they are trading at after the big rally in those stocks. The third is the power stocks. Look at the power stocks as well. NTPC, NHPC, SJVN and Power Grid all are now trading in double digits multiple for current year valuations versus the 5-year average of all of it trading they were trading in single digits. Now all are into double digits. SJVN is now trading at 22 times on current year price to earnings. Now look at the finances of the PSUs. IRFC, the biggest mover of 2023, that stock is now trading at 4.2 times price to book on current valuations. I don't think many of even private banks are not quoting that sort of valuations. REC, PSE are almost at 2 times now, which historically they've been trading at just half time in the past. So it's been a big move in terms of the power PSUs as well. Now look at the banking. This is an interesting chart. The PSU banks, despite the rally, look at the valuations now. SBI trading at 1.4 times, the historics around 1.4 times. So it's not trading at exorbitant valuations. Bank of Baroda, Canara Bank, all trading close to one time price to book. And historically, they've been close to one time or half time price to book. So in terms of valuation, the PSU banks are still not very, very expensive even after the rally. And same is the case with the OMCs as well. Look at the OMC stocks. They all have rallied and the momentum just continues. But even in terms of valuation, HPCL is now trading at close to 8 times. Historically, it's been trading at 4.5 times. BPCL, after the rally, is now still trading at 8.7 times, whereas historic has been around 10 times. Same is the case with IOC as well. The only outliner in that OMC basket is Chennai Petro. That is now trading at close to 8 times on current year valuations versus the historical average of around 2 times. So, again, as I said, the entire basket has done really well. The PSC stocks have added nearly 22 lakh crores in market cap, but keep an eye on the valuations. Some of the stocks are now trading expensive than even the private company stocks.
All right, Nimesh, thanks very much for that. Well, that's on PSU stocks, but we have a private bank which has released numbers. Net profit for Kotak has come in at just about 3,000 odd crores. It is below our estimates of around 3,161 odd crores, and it compares to 2,791 or 92 crores same time last year. So there is a growth which has come through, but it is below our estimate. So it's around a 10% odd growth which they've reported. NII should come up for you as well. And remember that we're looking only at the standalone numbers for Kotak to get the pure banking business in terms of the reporting. NII has come in higher than estimates. So 6,554 crores is where the NII has come in. So I think that equals to around a 15% growth, which they've reported. Not bad, and we were anticipating around a 14%, 13.7% growth. So the NII is a tad better than expectations. The profit is a little below what at least we were anticipating.
Ekta, the reason why perhaps the profit could have been below our anticipation is largely because of the provisions. So provisions have increased by close to around, from 1.5 billion rupees to around 5.79 billion rupees. That's around 580 crores. So 149 crores has turned into 580 crores or 579 crores, and that delta is what is reflected in the decline in the net profit as against street expectations by about 150 odd crores as well. No problems when it comes to the asset quality. Gross NPA 1.73, this compares with 1.72 the quarter ago. Net NPA has actually seen an improvement from 0.37. It's come to around 0.34. So that explains the improvement in net NPA largely because of the increase in provisioning. The NII has been in line with expectations. We're just looking at all the other details which are flashing by as well. But for now, it looks like the profitability has been slightly below expectations, largely because of higher provisions.
Yes, and I think that the street likes the NII. That's the reason why the stock has actually moved up to around 0.8% in terms of a gain at this point. So I think the street is quite happy with the NII performance. But
and there is some clarification on the provisions as well, where the company is saying that they provided roughly 190 crore rupees in the quarter for investments in AIFs. So maybe they are, providing for their investments in AIFs, as a result of which the provision number has increased, and that has meant that the net profit is below expectations. But no problems with the NII. Asset quality looking good. Important to find out what the loan growth is, because the street expects around 16 to 17% advances growth coming in for Kotak Mahindra Bank. So the street is now ignoring the miss on the net profit, looking at the NII and the improvement in asset quality, and as a result of which the intraday chart of the stock comes up for you. A big move is what we've seen from the lows, currently sitting with a gain of about 1.5%, but from the lows it's seen a decent recovery, moving towards the higher end of today's trading range.
Okay, well, in terms of the gross NPA also, it's just a marginal move higher of around 3.5%. But if you compare it on a year-on-year basis, they're standing at an gross NPA on an absolute basis at around 6,301 crores as compared to around 5,994 crores. I'm talking about year-on-year. If you look at it on a Q-on-Q basis, it's much more subdued. So 6,300 odd crores compares to around 6,087 odd crores. If you talk about the net NPAs, that actually has been lower on a sequential basis. So it's around 1,225 odd crores as compared to around 1,274 crores in the previous quarters. So that is actually a reduction which has come through of around 4 odd %. So there are a couple of positives which have come through, which we just want to highlight, is that they have clarified with regards to the provisions why exactly they are higher this time round, because there is a significant jump. The NII is better than expectations. The gross NPAs as well as the net NPAs have been largely stable this time round as well. Ashutosh Mishra, who's the head of research institutional equities at Ashika Stockbroking, joins in with his quick take. Well, Ashutosh, thanks very much for joining in. What is your first take on Kotak, and what do you want to hear from the management?
The most important, the result looks quite good. The way I have not seen the number in very detail just now, but it looks on a first basis that we have a lot of positives also. But what we require to more look from the new management, that what is their strategy, especially strategy on the deposit front, and know how they are going to tackle the deposit growth so that they are able to participate in the loan growth going forward from here.
All right, and of the numbers that we have right now, provisions have increased. That's largely because of their exposure to AIFs, and that's dented the profitability by a little. Would you worry on that, or you think this is par for course and there are other more important parameters to look for in Kotak Mahindra Bank than just that?
So this AIF provision is across the private sector banks we are going to see this, because RBI has found out that this was a loophole which few banks may be misusing it. Kotak may not be misusing it all out there, but yes, RBI has come out with the regulation that banks need to provide on it, so that every bank who has this type of exposure needs to do it. What we're trying to know is that what type of structure bank has used in this part, and is there any risk post the RBI regulation coming into this area? So we just need to understand a little bit more on that front. But I don't find it to be a major concern area at this point of time.
All right. Okay. Just looking at some of the back of the envelope calculations here, turns out that maybe advances growth year on year could be close to around 15.5%. But we'll let Abhishek do those calculations. Abhishek, I believe, has done his early set of calculations and has joined us. Abhishek, of the numbers that are reported so far and what you've seen so far, what does it look like for Kotak Mahindra Bank?
Mixed set of numbers. To begin with, loan growth looks to be pretty strong, about 4.5% as per my calculation on a sequential basis, that is quarter on quarter. However, operationally, it's a weak quarter for Kotak Mahindra Bank because operating profits have declined by 1% on a sequential basis. All other banks have seen operating profit growth on a sequential basis, but Kotak Mahindra Bank is perhaps one of the few lenders who are seeing operating profit decline on a sequential basis. So 4.5% growth of loan have actually aided the net interest income this time around, and it's higher than our poll. In terms of provisions, as you guys have been discussing, provisions are up 58% quarter on quarter. We need to see whether this is only on account of AIF. I don't think so. It's only on account of AIF because of two key reasons. One, gross NPA in absolute value have increased by 3.5%, while net NPA has declined by 3.9%. So we need to look at the credit cost that has come in this quarter, and it may be on the higher side than what analysts were pegging in. And that is why, on account of elevated provisions due to AIF and slippages, which might have, increased on a sequential basis, you are seeing profit below our poll. Back to you.
Okay, well, that's a very good point to take forward, because that's the next question I wanted to actually take forward is the slippages. We have Rahul Malani, who's the equity research analyst at Sharekhan, joining in with his quick take. Rahul, slippages were around 1,314 crores in the previous quarter. They have ranged within that space. What was your estimate for Kotak's slippages this time? We're waiting by for the absolute figure. But what, according to you, would be an inline number? What, according to you, would be a disappointment?
So anything slippages about 1,300 crore will be a disappointment, because we were working with an estimate of around 1,250 to 1,300 crores of slippages this quarter.
Okay. The other key point, which I think the street would want to watch out for, is also the stability in the net interest margin, something which, deterred sentiment with others. What is your sense, Rahul, in terms of what exactly the consolidated or standalone net interest margins would be for Kotak? What are you anticipating? Again, what is your parameter in terms of in line to maybe a disappointment?
See, if you look at the net interest income, it has grown by sequentially 4%. So my understanding is that the NIMs are flat quarter on quarter, and due to the one of the reason, because last quarter there had been one of around 15 to 20 basis points in the NIMs. And despite that, cost of funds have increased for this quarter, but NIMs have remained stable because of the one-off effect in the last quarter. So adjusted for that, NIMs have declined by 15 to 20 basis points this quarter. But it is looking at a flat because of the last quarter base effect.
Okay. Ashutosh, you have had some time to pore over the numbers, listen to all the analysis that has been going on so far as well. Have you, is there any more perspective that you can add to what we have so far?
So, if you look, on a NIM front, I clearly see that across the bank, we are going to see some margin compression. Because cost of fund is now increasing much higher than the yield on fund. Yield on fund was, we had seen increase earlier, and now the cost of fund is catching up. So this trend will continue. Even if suppose the bank is not showing any margin dip in this quarter, probably we would like to know from management that what will be the trend going forward from here on that front.
Okay, Ashutosh, one of the things that Abhishek in fact brought up in his link is that we need to see more granular details in terms of the provisions. So while there could be a component of AIF, do you think that would be the majority reason for the uptick that we've seen in provisions? And what would you like to hear about it from the management?
Yeah, I think so, because almost all major private banks have somewhat of other exposure towards this AIF, and whatever increase in provision we may be seeing at this point of time can come from the AIF portion of it, because other than that, we are not seeing any major negative impact on the asset quality. So yes, what we'd like to know more on that front is that from what type of exposure the bank has on that account, and going forward, what is their strategy to address the regulatory concerns which arise post the RBI notification on this matter.
All right, finally, gentlemen, before we let you go, your call on the stock quickly. Ashutosh, you go first.
So post the management change, more positive. I think this was the biggest hangover on the bank, and now this hangover is getting addressed. So we'd like to look about the growth strategy and how we want to take it forward from here. And given the type of growth prospect Indian banking has and the way Kotak is positioned itself, I see the good prospect of the bank in the near future. If I let it, yes, revisit after the management call.
Okay, Rahul, your call?
So we have a positive view on the stock, and we have a target price of around currently at 250 rupees.
Oh, okay. All right, Rahul, as well as Ashutosh, we're going to let you go on that note. Thanks very much for joining in and speaking with us. So Kotak Mahindra Bank holding up with a gain of around 0.9%, almost 1% post its numbers. But remember that there will be more details during markets for Kotak Mahindra Bank, because they will be coming out with their presentation soon enough. So that will have more details. But the real meat in terms of the slippages, as well as the granular details in terms of asset quality provisions going forward, will be from the press conference this afternoon at 3:15 p.m. So stay tuned for that.
And Swiggy, they are great companies, and we didn't see a path to number one that was worthwhile. We look at the mobility business, we see huge potential, and the biggest potential we see in actually mobility now are two-wheelers and three-wheelers. So our three-wheeler business, our two-wheeler business are growing at significant rates. We're looking to electrify those fleets as well. We're looking to partner with local companies in India who are building electric two- and three-wheelers and four-wheelers that are affordable, that are available to the mass market, etc. So we see India really as the crest of the electrification wave for us, in that we don't think electrification should be restricted to rich markets and rich people. We think it should be available for the masses, and India is going to play a very, very big part in it.
Our sense is every client is looking at what generative AI can do for them. We've ourselves positioned as an AI first company, so we are using all of these things inside. We have assistants, AI assistants now for each of our functions, whether you look at HR, recruiting, sales, delivery. So that is a transformation inside. The client meetings are just extremely good, very positive thinking from most of the clients. Economies in Europe, US, looking like they're coming to maybe not yet in terms of full recovery, but at least they see their work behind them in terms of what the issues were. Of course, the conversations are positive.
People are asking you, global investors are asking you about India and the growth momentum.
Thank you very much, first of all, for having me on your show. Well, as far as the global...
Welcome back. Well, it is moving higher for Kotak Mahindra Bank, because one of the key concerns for the market was any kind of disruption in terms of net interest margins, which has absolutely been flat on a sequential basis at 5.22%. And overall, it seems as though the numbers are looking good in terms of the incremental details which are flowing in. So net interest margins unchanged at 5.22% sequentially for Kotak Mahindra Bank. We'll get more details as the presentation uploads on the exchanges, and more of the details once the press conference takes place at 3 p.m. this afternoon. But let's shift focus back on the PSU space. We have Hormuz, who's joining in with an interesting piece of data on government stake in PSUs. Hormuz, over to you.
You know, it's that kind of a day, right? This PSU rally is showing no signs of slowing down, and it is only ensuring that the government laughs all the way to the bank whenever it decides to monetize this stake, that is. Now, as of today, there are 19 government companies where the government owns more than 75% stake. And at the current price, that stake is valued at 2.4 lakh crore rupees. Now, out of these 19 companies, there are 9 of them where the government stake is in excess of 90%. Now, most of the names in this list are the smaller PSU banks like UCO Bank, Central Bank, Punjab and Sindh, along with India's largest insurance company, and that is LIC. Now, when we first reported about this in July last year, that excess government stake was worth 1.5 lakh crore rupees. When we did a follow-up in September, that stake was worth 1.9 lakh crore rupees. And now 4 months later, a further 26% surge has taken the value of the stake to 2.4 lakh crore rupees. So which are the companies where the value of the government stake is the highest? Unsurprisingly, it's LIC. Now, having sold only 3.5% stake during its IPO, the government still owns 96.5% stake there. Now, that excess stake in LIC as of today's price is worth 1.2 lakh crore rupees. However, in this case, the government has time until 2032 to comply with the minimum public shareholding norms. Now, next on the list is IRFC. Actually, IRFC is everywhere these days. The government still owns an excess 11% stake in this railway financier, which, if it plans to monetize, will fetch them a handsome 22,500 crores. And as I highlighted earlier, the smaller PSU banks where the government owns more than 90% stake, these are the ones that complete this list. Now, barring LIC, most of these PSUs, other than these smaller banking names, have seen a stellar run over these last few months. IRFC is up 4x, Mazagon Dock has tripled, HUDCO has tripled. Even a stock like General Insurance Corporation, which we don't speak about as frequently as the others, has doubled over the last year. But harping back to IRFC, why this should also be in focus? Because its lock-in period is ending on the 29th of January, which will mark 3 years of its listing. Now, that will make 261 crore shares of IRFC, or 20% of its outstanding equity, eligible to trade. Now, that's according to a Novama note. Now, 2023 was the year of PSUs. 2024 has begun on a similar note. The government is very much in the money, and the ball is now in their court as to when they choose to rake in the mullah.
Indeed, Armas, thank you so much for that. But who's also in the money is someone who would have bought Kotak just 15 minutes ago. Currently, right now, is up 2%, and that's as we get some more details coming in. 289 crore, the total slippage is already upgraded within the third quarter. But the important number was the slippage number that came in close to around 1,100 and some change crores. This compares with 1,300 crores, which was there at the same time last quarter. So the slippage line should come up for you on the screen. A little over 1,100 crores is what the company has reported in terms of slippages. That's better, at least in the last 3 quarters data that we have right now. Last quarter, it was 1,300 crores. The quarter before that, it was close to around 1,200 crores. So there you have it, 1,177 crores the slippages. And we've seen 289 crore worth upgrades already. The asset quality in the second quarter was the best that we saw in 33 quarters or more. And turns out that there's only further improvement to that. And this is something that the street perhaps is now taking note of. We're seeing a bit of a further spike in the stock price. Slippage is manageable. We have provisions which have been elevated. We have some details on that. 190 crore of the increased provision goes into, is on account of the AIF. And as Ekta pointed out at the start, that the NIMs at 5.22% are also unchanged at a time where a lot of the banks are actually seeing some sort of NIM compression.
Well, just want to point out, and add to what you said about the asset quality, that they've also indicated that 289 crores of the slippages were already upgraded this quarter. So I just want to know what the absolute figure was. Is it included within that figure that we're flashing, or is it X of that? But nonetheless, and the other point is that now we know what that AIF provision was. So 389 crores still is higher on a sequential basis when it comes to provisions. And I think the street would just want to know what exactly it consists of, what would the trajectory be in terms of provisions going forward. But nonetheless, I think the granular details are working in favor of Kotak. Lower slippages to 89 crores upgraded, as well as the net interest margins, which are completely, which are maintained on a sequential basis.
And what's also interesting is that we have some more details on the deposit growth. 18.6%, not particularly bad at a time when a lot of the banks are seeing slower than expected deposit growth. So 18.6% deposit growth is what Kotak Mahindra has reported. So yeah.
And just the fact that the stock is coming off, I would assume could also possibly be to do with the provisions which are X of AIF, which is also what the analyst had pointed out. So I think that would be critical, and maybe that's the reason why the stock is off.
All right. What we'll do is we will get more details from Kotak Mahindra Bank as and when incremental details do pour in. But stay tuned. At 3:15, we will have the management addressing the press too and giving you more on these numbers. As of now, the stock holding up with a gain of about 1.5%, meandering between this 1 to 2% sort of move. But it's the union budget, which is less than 15 days away. What is your wish list for the finance minister? Here's presenting to you the CNBC-TV18 budget ballot. Now, instead of looking at just the ballot box, you can also share your budget expectations with us on our website. Hang in there, open your phone, scan the QR code which is there on your screen, and you'll be redirected to cnbc-tv18.com/budget. If you can't, then go log on to the website, the same one, cnbc-tv18.com/budget. It's for you on the screen.
Concerned, they are quite keen. They are actually tracking the India story with a lot of interest. The kind of resilience which has been demonstrated as far as Indian economy is concerned, it is of significant interest for them. Many of them are very keen to look at their supply chain relocation, and they want India to be part of the supply chain. So I think to that extent, India's story is quite promising. And apart from the many other things, the green initiative of India, and more so in terms of solar, renewable, battery, EVs, these are the kind of things which are also attracting a lot of interest from the global investors.
The focus and the attention is on AI, but I know you want the world to focus its attention and its bandwidth on what's happening as far as attaining the healthcare goals are concerned. And you're concerned that we're slipping and that funding is an issue and a big challenge.
That's right. Making sure kids survive, making sure they're well nourished. There's been a lot of progress since the turn of the century, but with all of the unrest, the pandemic, we've lost attention to that, so we need to go back and keep reducing these deaths. We went down from 10 million to 5 million, and we can cut it in half again. India's a place that is making progress. We've got a lot of great partners there, but we need to get these new innovative tools out helping the patients.
What's the one big risk that you're most concerned about today as you look at the world?
Well, the instability.
Welcome back. Well, for the markets overall, it has given up gains, so just about flattened out for the Nifty. We have the Midcap index, which is up around 0.6%. Kotak is now sitting with a gain of around 1.8%, so still negotiating with its numbers at this point. But nonetheless, let's talk about Reliance Industries, which did come out with numbers yesterday post-market. Sonia joins in with the details.
Well, thanks a lot for that. For Reliance, across segments, they had a good performance, especially in the retail segment, which was a stellar performance for them, and Reliance Jio, which reported stable earnings this time. But let's take a look at what brokerages are saying. Morgan Stanley has an overweight with a target price of 28.21 on Reliance. They say that the company reported the slowest investment capex in the last 2 years. Gas production is what drove the numbers this time around, and the net debt was flat. CLSA has a buy with a target price of 3,060. They speak about how capex has fallen to an 8-quarter low for Reliance. Macquarie has a neutral on the stock. They say the key positives this time was the very strong retail performance that Reliance delivered and a solid Jio subscriber addition as well. Nomura has a buy with a target price of 31.65. They talk about a sustained healthy performance for Reliance, and both the consumer businesses, Jio and retail, are picking up pace, and there's a sharp uptick in the upstream business as well. Finally, Jefferies has a buy with a target price of 31.5. 40. They say Jio saw healthy subscriber addition. The oil to chemicals profitability declined on maintenance and lower spreads in refining and the petchem space. So largely positive outlook from most brokerages. Back to you.
Positive outlook from most brokerages indeed. Reliance retail business is doing extremely well this time around. The stock holding up with a gain of about 1/3%. Take a short break, come back, at you more on the markets and individual stocks.
That includes things like U.S.-China relations, that could slow down all this progress. And so hopefully you get reasonable works on both sides. And, India can play a role there.
What role do you believe India can play there?
Well, India's, setting an example. India works both with China and the United States. And we saw at the G20, it was very constructive to turn the attention to win-win relationships.
The narrative in a lot of the popular press has been India as a prime beneficiary of supply chain relocation. And you've seen company-specific announcements out of companies like Apple that are continuing to ramp manufacturing capabilities in India. Obviously, the government's Made in India program is supportive of that as well. That is, however, not in fact occurring in the actual world. India has driven FDI of about $40 billion over the course of the last couple of years annually. Trailing 12 months is only at 13 billion, and we're looking at a best case scenario of 20 billion for the current year. So significantly below trend. And so inbound FDI is not coming. We're not seeing global multinationals make the bets that it seems like they're making if you only read the headlines. I think that the critical thing that we're looking at from an investor expectation perspective is this belief that multinationals are keeping their powder dry until we get past the political season in India.
Here in Davos, Geeta, everyone's talking about AI, the transformative impact of that, what it could potentially do to jobs, what it could do in terms of disrupting different sectors. What's your view on what AI could mean for the global economy?
Yeah, so as you've seen, if you talk about AI to anybody, they can pick different facets of it, right, in terms of misinformation, but also on the impact on the labor markets and so on. So we've actually done a pretty careful study on potential impact on the labor market.
Welcome back. Well, for the Midcap index, it's holding with a gain of around 0.6%. We have the Bank Nifty, which is, picked up a cool 300 odd points at this point in time as well. So it is definitely going to be a much more interesting trading session when it comes to specific stocks. Kotak Mahindra Bank is now speeding away with a gain of almost around 3 odd percent, just shrugging off any kind of concerns, may it be deposits, may it be provisions. Right now, the street only likes what it sees in terms of the slippages, in terms of the net interest margins, as well as the NII growth. Well, with that, we need to wrap up on the show, but thanks for watching. We have Business Lunch which will take all of the action this Saturday forward.
And our assessment is that about 40% of jobs globally, on average, 40% are vulnerable to AI. Right? That's a big number.
That's a big number,
Now, that varies. So if you look at the US, the 60%, that number would be 60%. If you look at India, that number is 30% because you have a large share of workers that are in the agricultural sector, which is not affected by, by AI, especially not the generative AI. Now, then there is a question of, okay, of this, if I take the US and of the 60%, what fraction benefit from, get complementary, benefits from the AI, right? Become more productive because they have AI, versus how many of them are actually going to get substituted out, which means more likely to lose a job. And that then gets to it's about half of that 60% number, right? So we're talking about very large fractions of the population who are at risk of, at least if not losing their job, but in a sense being devalued a bit by the presence of AI, but also an important share that can benefit from it. The risks on inequality growing, especially wealth inequality, is something also that we flagged in this new research that we've put out.
The reality is that markets are pricing in an extremely aggressive view right now. You're looking at about a 70% odds of a rate cut in March. JP Morgan view is that it will be June at the earliest. Markets are pricing in over 140 basis points of rate cuts by the end of the year. JP Morgan's thinking somewhere around 120. And so you have very aggressive forecasts already built into rate markets at this stage, which we think are likely to be disappointed.
The union budget, though, is less than 30 days away. What's your wish list for the finance minister presenting the CNBC-TV18 budget ballot box coming to a hotspot near you? We'll be placing these ballot boxes at popular public spots, malls, colleges, theatres and others across major cities. We'll also be asking the newsmakers who drop into our studios for their budget wish list. So come join us and tell us what's your top budget wish list from the finance minister. Drop your wish list at a CNBC-TV18 budget ballot box near you. We'll compile them and present it to the finance minister before she presents the union budget.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC-TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Market trades in a narrow band with Nifty and Sensex just around the flat line. Banks and PSU stocks lead the up move with FMCG and IT seeing profit taking. The mid-caps outperform. Reliance Industries reports a steady third quarter. Retail business revenue hits a record high. Jio reports a 2% rise in average revenue per user. Oil and gas business reports record high margins of 86%. And HUL falls on the back of weak Q3 earnings. Revenue declines marginally as volume disappoints while EBITDA remains flat. The management is cautious on macros and rural recovery. Brokerages are bearish on the stock. Kotak Mahindra Bank gains on a mixed third quarter. Net profit and net interest income beat estimates, but provisions spike up. The management also points to a challenge on the deposits front. RBL Bank gains 2% as the street overlooks the rise in slippages, focusing on stable net interest margins and strong loan growth. Paytm is in the green as losses reduce quarter on quarter and EBITDA surges 43%. Tejas Networks falls around 4% on mounting losses courtesy rising R&D spends. Good morning and welcome to Business Lunch on this Saturday afternoon. We are seeing very flat trade on the frontline index right now, just around 25 points in the green. Of course, much lower volumes as well. But you know, there are pockets of this market which are doing very well. So the broader market is in fine form even today, 320 points higher on the midcap index. So that's doing very well. The banks also doing well. We're getting a little bit of, divided trade on the banks, but overall the index is up around 0.8% right now. If you take a look at the advanced decline, that's also holding up. So you have around 1,300 stocks which are advancing for just around 900 which are in the red right now. So the shape of the market looks quite all right. We'll just pull up some of those banks, names like ICICI, Kotak. Kotak, of course, just posted results as well. So you're seeing that reaction play out a little bit as the street is digesting those numbers. But it's been quite a mix set. The street is, for now at least, looking quite okay with those numbers. It's up 3%. But you do have some of the larger banks which are under pressure as well. So names like IndusInd, Axis also at the low point of the day. So there's a mixed trade coming through. But overall, the index is looking quite good. There's no looking away from the PSUs, okay? So take a look at the CPSE index, the PSE index, once again completely topping the charts over here. You have names like IRCON, IRFC, the usuals which have been doing very well all through this year. Once again, seeing big moves. There you have it on your screen, between 10 to 15% on all of these stocks. What's seeing a little bit of profit taking? You have some of the consumption names led by HUL, which is reacting to earnings, but also some of the IT stocks, which are a little bit in the red right now. So that is the market. We'll keep coming coming back to this. But let's kickstart the show by focusing on some big stock moves this afternoon. First up, HUL is the top loser on the Nifty after having reported what was quite a weak set of third quarter earnings. Revenue and margin both came in lower if you look at it on a sequential basis. Earlier today, the company's chief financial officer and the company's said that the company is operating in tough macros with slow rural recovery as well. So listen in to some snippets of that conversation.
The operating environment has remained challenging this quarter. The effect of uneven monsoon was felt on Kharif crop output, impacting agriculture yields and rural incomes. Lower reservoir levels continue to be a cause of concern for Rabi crop, albeit crop sowing recently recovering. Winter this year has been delayed and less severe, and this has impacted the winter categories. Further, with rural consumer sentiment remaining subdued, the anticipated buoyancy from festival season did not materialize. The dualism that we have seen in the recent past continues, with certain parts of the economy recovering faster than the rest. For example, urban growth continue to outpace rural. Home and personal care and beauty and the entire business put together has grown mid-single digit. Remember, this is 3/4 of our business. So already 75% of the business has registered mid-single digit volume growth. And it's the foods and refreshment, which is the quarter of the business, which Rohit explained, given commodity inflation, given a very different commodity cycle, which is where we've seen low single digit volume decline. And also, I want to call out the premium categories. If you look at beauty premium categories, if I look at the plus range within Horlicks, again, the premium part of HFD. If I look at newer formats, mask, serum, if I look at innovations like mayonnaise peanut butter. So these parts of the businesses are already showing double-digit volume momentum.
Okay, that is the word coming in from HUL. It is still the top loser on the Nifty, down around 3% as we speak on that one. But let's talk about some more earnings, and from the banking space here, RBL Bank, which saw third quarter results come in below what the street was factoring in. Their slippages have also moved up quite sharply, and asset quality has deteriorated this time around. So earlier today, we spoke with R. Subramaniam Kumar, who's the managing director and CEO at RBL Bank, to discuss the quarter that just went by and what they expect moving into next year as well. Listen in.
This quarter has been an exceptionally great quarter for RBL. And some of the parameters, especially in the profit parameters, if I just set aside the AIF for the minute, the PAT grew by 53%. And sequentially also it grew substantially high. And ROA was, as per the guidance, at 1.03. However, the AIF should be looked from slightly a different angle, because this is a new direction which has come from the regulator in respect of the investments made in AIF. If the downstream, the AIF has given to the borrowers, if the customers are common between the bank as well as them, we have to either liquidate it or you have to provide for. The time available was 30 days, and you will definitely agree that it is too short a period for such a liquid fund is to be taken care. We ourselves are conscious about this credit card, CD ratio, as per our strategic discussions within the board, as well as what we have communicated to the market as well, is that we will be in the range of 85%. When we talk about the CD ratio, I would like to have a different perspective to be seen. We have an option of drawing our refinance for funding our loan growth, and we are also having a long-term FX. These two are long-term and it is sustainable. So when I try to do this refinance, we have seldom made use of it in our earlier avatar. We have just started using that for funding our growth. If I combine the deposit and the borrowings, refinance especially, and the ratio will be in the range of 73%. Right now, our capital adequacy is well maintained. In fact, this time, even after the sequential growth, we consumed around 65 bips. Even after the regulatory directions of increase in the RWA, we are confident, and we feel with this, we will be in a position to manage for next 6 to 8 quarters the capital sufficiently available with us.
Okay, that is the word coming in from the RBL Bank management. But let's talk about Kotak Bank's earnings as well. We just got them a while ago, and the stock has moved up. It is, one of the top gainers on the Nifty as well, seeing a near 3% rise. So Abhishek is here to take us through the details. Abhishek, some good, some bad here?
mixed set of numbers that have come in. However, the key thing to note in their presentation is that they have mentioned there is deposit challenge. If you take a look at the CASA ratio of 47.7% is perhaps the lowest that you are seeing in last 6 years or 24 quarters versus 48.3% in the previous quarter. Now, the loan growth has also come in below analyst estimate. YOY, the loan growth is about 15.7% and sequentially it's at 3.25%. Motilal Oswal was pegging a loan growth of 16.6% YOY and about 4% sequentially. Loan growth was led by CVC, that is commercial vehicle construction equipment segment, tractors, small business, personal loan and credit card as well, which are the unsecured book. Now, deposit growth was pretty weak, 15.6% YOY and just about 1.9% sequentially. Motilal Oswal was pegging deposit growth at 20.5% YOY and about 3.5% sequentially. So there is a miss on both deposit growth and loan growth by the bank versus analyst estimate. Now, slippages were below analyst estimate. Now, 1,177 crore is where the slippages have come in. One of the analysts was estimating a 1,300 crore of slippages in this quarter. Gross NPA is up 3.5% in absolute value. Restructured book has declined to 0.13 of the loan book versus 0.15% in the previous quarter. In subsidiary profits, life insurance subsidiary profit that's down about 57.6% YOY and more than 43% sequentially. Even Kotak Securities PAT is down about 5.5% on a sequential basis. In terms of return on asset for the bank, it's come in at 2.2%, which is the lowest that you are seeing in last 6 quarters. And the PNL versus poll, the profits were their NII was higher than our poll. However, profits came in below our poll. Back to you.
All right, Abhishek, thanks a lot for breaking down all of those numbers for us and telling us how Kotak Mahindra Bank's third quarter earnings have been. By the way, some of the other banks, in addition to Kotak, have also moved to the high point of the day. So ICICI Bank has recovered 1.5% from the lows of the day. It is also one of the top gainers on the Nifty. HDFC Bank also holding with an 0.8% gain as well. So that is the banking pack. We'll get into a short break now, but on the other side, we're going to get you a very interesting dive into some data on the government stake in PSU. So stay tuned for that. This space has been all the talk. We'll get you the details.
Net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high. We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC-TV18, embarking on a quarter century of excellence.
CNBC-TV18's most comprehensive and
Hey guys, welcome back. You're still tuned into Business Lunch. Now, less than 2 weeks are left to the interim budget, and sources have told CNBC-TV18 that the government could moderate the pace of capex in a bid to help it stay on the fiscal glide path. So, Sapna joins us with all of the details on this one. Sapna, what are you picking up on this?
Well, there appear to be indications that going forward, there could be some moderation in terms of the government's capex allocations in the budgets, be it the interim budget or maybe at the time of the July budget. If you look at railways and road transport, the two big ministries which occupy 50% of the capex target of 10 lakh crore in this financial year, there appears to be a slowdown in the pace of the capital spend. So that's one indicator to watch out for. Of course, there are other ministries like shipping, housing, telecom, defense that are doing very well in terms of the capital expenditure. So maybe it's going to be a balancing act where the government actually reassesses its capex outlays in the coming budgets. That's one. Second, also another indicator, the entire 30,000 crores kept aside as capital investment for OMCs in the current financial year. That's very unlikely to be utilized completely. Third, last but not the least, in terms of states also, out of the capex loans worth 1.30 lakh odd crore which have been earmarked for them in the current financial year, they have availed less than 50% of that. 61,000 crores is what appears to be the centre's release so far as of December. So these are indications that going forward there could be a moderation in the capex outlays by the government. Also, let's keep in mind they have a fiscal glide path to meet 4.5% FD target by FY26. That's a tall order that we are talking about. So we have to wait and watch and see how that capex story actually pans out in the coming budgets.
All right, let's see how that works. Sapna, thanks a lot for getting us all of those details on this important story. But let's now talk about the entire PSU space, because this entire basket has been on a complete tear, right? 2023 was a great year for the PSU pack, with almost 34 of them seeing gains of over 100% in just 1 year. So Nimesh yesterday in Editors Roundtable told us about how the valuations are looking for PSUs now. Let's go back and take a look at that piece.
The PSE index has rallied 81% in calendar year 2023, and they've added nearly 22 lakh crores in terms of market cap. The entire PSU basket has added nearly 22 lakh crores in market cap only in the last 1 year. If you look at the big gainers, the 1/3 of the PSU basket, which is 33 companies, have rallied between 100 to 300%. That's the kind of move we've seen in the PSU baskets in the last 1 year itself. Now, I'll just break into the different sectors now. The first sector I'm picking up is railways. Nobody knows where the train is going to stop, but just look at the rally and the kind of valuations now. I just want to put a word on the valuations. IRCTC, it's trading at 55 times on the current year valuations. Ircon, which has been the big mover, that's now trading at close to 18 times. RVNL close to 32 times, and RailTel is now trading at 35 times. I don't have the 5-year average for these companies, but this is the kind of valuation you're giving for the railway PSUs now. Next is look at the capital goods space. BHEL, that stock is, after rallying 155%, is now trading at close to 50 times. We don't have an average for that as well. HAL is now trading at close to 31 times versus a 10-year average of just 10 times. RITES is trading at 20 times versus the average of 12 times. And BEL is now trading at close to 34 times versus the 5-year average of 16 times. So that's the capital goods basket, how they are trading at after the big rally in those stocks. The third is the power stocks. Look at the power stocks as well. NTPC, NHPC, SJVN and Power Grid. All are now trading in double digits multiple for current year valuations versus the 5-year average of all of it trading below they were trading in single digits. Now all are into double digits. SJVN is now trading at 22 times on current year price to earnings. Now look at the finances of the PSUs. IRFC, the biggest mover of 2023, that stock is now trading at 4.2 times price to book on current valuations. You know, I don't think many of the, even private banks are not quoting that sort of valuations. REC, PSE are almost at 2 times now, which historically they've been trading at just half time in the past. So it's been a big move in terms of the power PSUs as well. Now look at the banking. This is an interesting chart. The PSU banks, despite the rally, look at the valuations now. SBI trading at 1.4 times, the historics around 1.4 times. So it's not trading at exorbitant valuations. Bank of Baroda, Canara Bank, all trading close to one time price to book. And historically, they've been close to one time or half time price to book. So in terms of valuation, the PSU banks are still not very, very expensive even after the rally. And same is the case with the OMCs as well. Look at the OMC stocks. They all have rallied and the momentum just continues. But even in terms of valuation, HPCL is now trading at close to 8 times. Historically, it's been trading at 4.5 times. BPCL, after the rally, is now still trading at 8.7 times, whereas historic has been around 10 times. Same is the case with IOC as well. The only outliner in that OMC basket is Chennai Petro. That is now trading at close to 8 times on current year valuations versus the historical average of around 2 times. So, again, as I said, the entire basket has done really well. The PSE stocks have added nearly 22 lakh crores in market cap, but keep an eye on the valuations. Some of the stocks are now trading expensive than even the private company stocks.
All right, that is how the PSU valuations have moved. Nimesh, thanks a lot for taking us through that very interesting piece. But sticking with this space, let's also go across to Hormaz, who is joining us with some interesting data on what the government's stake in the PSUs is currently like. Hormaz, it's over to you.
It's the flavor of the season, PSUs, and this rally is showing no signs of slowing down, and it is only ensuring that the government laughs all the way to the bank whenever it decides to monetize this stake, that is. Now, as of today, there are 19 government companies where their stake is more than 75%. As of today, that stake is valued at 2.4 lakh crore rupees. Now, out of these 19 companies, there are 9 of them where the government stake is in excess of 90%. Now, most of the names in this list are smaller PSU banks like UCO Bank, Central Bank, Punjab and Sindh, along with India's largest insurance company, and that is LIC. Now, when we first reported about this in July of last year, that excess government stake that I'm talking about was worth 1.5 lakh crore rupees. Now, by the time we did a follow-up 2 months later in September, that stake was worth 1.9 lakh crores. And now 4 months later, a further 26% surge has taken the value of the stake to 2.4 lakh crore rupees. So which are the companies where the value of the government stake is the highest? Unsurprisingly, it's LIC. Now, having sold only 3.5% stake during its IPO, the government still owns 96.5% stake there. That excess stake, as of today, is worth 1.2 lakh crore rupees. However, in this case, the government still has time until 2032 to comply with these minimum public shareholding norms. Now, next on the list is IRFC. Actually, IRFC is everywhere these days. The government still owns an excess 11% stake in the railway financier, which, if it plans to monetize, will fetch them a handsome 22,500 crores. And as I highlighted earlier, the smaller PSU banks where the government owns more than 90% stake, these ones complete this list. Now, barring most of these PSU banks, these smaller names, most of the other PSUs have seen a stellar run over the last 12 months. Now take a look at this. IRFC is up 4x. Mazgaon Dock has tripled. HUDCO has tripled. Even a company like General Insurance Corporation, which we don't speak about as frequently as the others, has doubled over the last year. But harping back to IRFC, why should this also be in focus is because its lock-in period is ending on the 29th of July, which will mark 3 years of the stock's listing. Now that will make 261 crore shares or 20% of its outstanding equity becoming eligible to trade. That's according to a Nuvama note. So 2023 was the year of the PSUs. 2024 has begun on a similar note. The government is very much in the money. Now the ball is in their court as to when they choose to rake in the moolah.
All right, let's see. Hormaz, thanks a lot. And those are some big numbers. So thanks for taking us through that. By the way, those are IDBI Bank's numbers, which are flashing on your screen. The NII is up around 17.4%. So it's coming at around 3,400 crore rupees. The net profit is up 57%. It's coming at 1,458 crores as well. The stock is holding up well in the green. It's up around 4.2%. You know, even this year, if you look at it, that means just in these, I think, 20 odd days, or it's been doing quite well. It's up around 15% in that time as well. So it was going into its results quite all right. And now you can see the stock is only building on its gains as well. Numbers look quite good at the outset. I only have the first 2 flashes for you, but we will try to get more details as well. NII, once again, up around 17%. The net profit has gone up around 57%. Those are the asset quality numbers. The gross NPA has come in at 8,500 crores, 8,600 crores around, and the net NPA at around 600 crores versus 650 crores that we had last time around. So those are the initial numbers coming through from IDBI Bank. We do need to get into a short break, but on the other side, we're going to get you a quick check on the pulse on the ground in Ayodhya ahead of January 22nd. More on that when we come back.
News show India Business Hour drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key news makers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube. A show that is unmatched.
We tell you stocks to watch out for and which sectors are impacted.
Thought-provoking.
In India, the allocation to equities.
Welcome back. Now, the Ram Temple consecration ceremony is inching closer and the rituals have started inside the complex and will continue till January 21st, that is till tomorrow. The idol of Lord Ram has also been placed inside the sanctum of the temple and security has been beefed up ahead of the January 22nd ceremony. We have CNN News 18 Siddhant Mishra who gets us this report on the security arrangements as well as the big facelift in and around the temple premises.
Well, ahead of Pran Pratishtha in Ayodhya, Ram Lala's idol has been installed inside the Sanctum Sanctorum. We are at Kar Sevak Puram and perhaps one can see the color, the vibe in whole of Ayodhya as Ayodhya is getting decked up, is getting prepared for the grand Ram Temple inauguration. We are at Kar Sevak Puram and this is a place where devotees are bringing precious gifts for and special and unique gifts for their beloved Ram Lala. In fact, behind me you can see Ramchand ji's Charan Padukas have arrived from Sitapur, Uttar Pradesh. And other than this, boxes of camphor have also come to Ayodhya. Then there is a laddu of 1265 kgs have also been brought in here by the devotees. In fact, I will ask Rama Shankar to give the shots of log, this giant log which has come from Aligarh. Aligarh is a city of logs. So with each passing day, the great unique gifts, precious gifts are coming to Ayodhya at Kar Sevak Puram as an offering for Lord Ram ahead of Pran Pratishtha.
All right, thanks a lot for getting us that ground check and taking us through what's really going on. All eyes on Ayodhya up until January 22nd. But with that, we do have to wind down in this edition of Business Lunch. Thanks a lot for tuning in. We have Midcap Radar on the other side.
%, which is not beating inflation. So investing aggressively, you can actually look at even beating inflation.
And will give you maximum value for your money.
It is a good time to look at debt funds as a category. There's no better time than this in that sense to lock in rates for the long term.
A masterclass with India's biggest market experts. Smart money at these times. The last hour. Anything can happen between the bells. But what happens during the last hour is what matters the most. The biggest market swings. A close-up look at what's driving them. And how the investors are reacting. Watch the most seasoned market mavens guide you through the most important hour of the trading day. NSE Closing Bell. At these times, only on CNBC-TV18 and CNBC-TV18.com. From David to Goliath, from the smallest business ventures to multi-million-dollar global corporations. Meet the movers and shakers, today's newsmakers, and tomorrow's leaders. Understand what makes markets move, how companies make quantum leaps, and how giant corporations stay ahead. Get the biggest business stories of the day, power-packed into 30 minutes. On Business 360 at these times. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits, and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
On the back of the measures that you've already taken, and one involving the AIF, so there are representations being made by that industry, by the AIFs, etc., to the Finance Ministry as well as to the Reserve Bank, saying that perhaps there needs to be a review of that decision, or at least more time given. You've obviously, I would imagine, have heard from them. How do you respond to that?
You see, this decision is the result, is the culmination of...
Afternoon, welcome to Midcap Radar in the Mumbai studio. I'm Sonal Bhutra, with me is Pavitra Parekh, looking like a green screen for our own markets. But we'll start the show with the top headlines, and then we'll discuss the individual stories in detail. Broader market outperforms key indices as markets trade in a narrow band. FMCG and IT drag, while financial services and metal lead gains.
RBL Bank has come down after seeing an up move earlier in the day, even as it misses street estimates in Q3 as retail loan growth momentum remains strong. On fundraising, the management tells CNBC-TV18 that capital is currently adequate for the next 6 to 8 quarters.
Paytm gains after reporting an improvement in EBITDA and decline in loans in the third quarter. CLSA upgrades its rating on the stock. Stock rallies over 2%.
Tejas Networks dips 3.7% after reporting its Q4 numbers. The company reports widening of losses due to increased inventory as it executes large projects.
Railway stocks continue to surge ahead of the budget. Ircon surges nearly 26%, while IRFC is up nearly 20%. The outlook on the companies looks steady. RVNL2 is up 10% after a 20% move yesterday. Both RVNL and IRFC have now surged over 75% in January. Okay, all right, those are the top headlines that we are tracking for you, and it is a green-looking screen, as we earlier told you, led by the Bank Nifty. Quickly, let's take a look at the Nifty as well. It is off around 64 points from the day's low, but and in the green right now, but it is still not back to the highs that we saw for the day. The Bank Nifty, which is up around 390 points, and it's the mid-cap side of things which are doing really well as well. And couple of stocks that are buzzing in how. We have PCBL, that stock is up around 23% this week itself, and that has come in after the strong numbers that the company reported. DB Corp, it's up around 3% today and has been surging this entire week, so that stock should be on your radar. Ad revenues in focus ahead of budget and the events that we have going ahead as well. The other stocks will be the fertilizer names. They have been surging in how ahead of budget. That is something that we see usually. So the likes of NFL, FACT, RCF, all of them are higher in trade. And we have numbers on Tuesday coming in from Rallis and MGL. So watching out for these two. Rallis is higher in trade, and MGL expected to be a weakish quarter, but it is flat with some positive bias. So we have a lot of earnings. IRIDA 2 up 10%. Looks like a decent quarter. 92.1% versus 88% in terms of margins on a YY basis.
Oh, absolutely. And you know, it's been gaining all through the morning. So you know, the stock is still holding up with that. The profit is up around 67% right now. This is for IRED. It's coming at 335 crores. Revenue is up around 45% as well. EBITDA up 51%. Looks like a very solid set. Like Sonal was pointing out, the margins also have expanded very well. So it's come in at over 92% on the margins. And what we had last year was around 88%. So there's a lot of action in, you know, in the PSU space, but in the overall mid-cap space as well. So if we have Hormaz with us to take us through all of the mid-caps that are really moving around in trade. Hormaz.
To add to a little bit about what you mentioned about IREDA, It's almost around 40 to 45 days since IREDA listed, and it's almost 5x from its IPO price. It shows the kind of rally that we have seen in the PSUs. And speaking of rally, the railway stocks, they are continuing to see one green signal after another, and they're just not showing any signs of stopping. IRFC, today it surpassed Power Grid's market cap. It's up another 10% today. IRCON is up 17%. IRCTC is up 6%. RVNL is up another 10%. And now that is the kind of moves that we are seeing in railway stocks. RVNL now is up for the 10th day in a row. What has also been doing well over the last few days but is getting overshadowed by the railways is the tire companies. And those stocks are also remaining in a very firm grip. And I'll talk about CEAT, 15% higher there. JK Tyre is up 8%. Apollo Tyres is up 3.5%. And it's trading at around a 3-month high today. Balkrishna Industries another 4.5%, and MRF another 3% today. It's almost nearing $1.5 lakh a share. That is the kind of moves that we have seen in tire stocks. Now moving on to the next bunch of movers that we are looking at right now, and those are the two stocks that are buzzing on the back of order wins. RITES has just won an order worth around 400 crore rupees from IIT Bhubaneswar, and HFCL, it won an order yesterday worth around 600 crore rupees, and both of these stocks are 17% and 11% higher respectively. Stocks that are moving on the back of strong volumes, and those are the ones that are also seeing steady gains today. NHPC is at a record high. That stock is now already well above its OFS price, and another 10% today. GIC, I was just mentioning, don't talk about this very often. That has already doubled over the last 12 months, 6.5% higher there. Rain Industries, FACT, MMTC, all of them seeing some stellar moves in today's session. But lastly, there are some stocks that are not doing well even in a session like today, and that is Tejas Networks. Most of them are seeing some earnings impact. Tejas Networks losses widened year on year, 5.5% down there. CESC another 3.5% post results. Mastech, Poonawalla FinCorp, and Laurus Labs ahead of its results is not having a very good day today. Back to you.
Okay, Armas, thanks a lot for taking us through all of that action that we're seeing in the mid-cap space. Clearly a very active market right now, but of course this is on lower volumes as well because, this is a Saturday. So let's get in a check on, how the technicals are looking as well. We have Ashish Kyal joining us for exactly that. Ashish, thanks for joining us on this Saturday and, taking the time. For the market, right now we're seeing some minor gains, but the Nifty Bank is where we've been seeing quite a bit of force today, as well as the broader market. So take us through how you're looking at just these indices.
See, if you look at Nifty, we can clearly see that after a sharp decline that we saw just about 2 days back, Nifty moved from around 22,120 levels to the lows of around 21,250. So that was a very sharp decline. And right now I'm seeing this as a pullback to this decline. So I'm not too convinced about the rise. Yes, we are over short term in an upward move, which is a pullback. I don't think Nifty is going to touch the lifetime highs over the next few weeks. We are going to consolidate in a broad range. On the downside, the support is at around 21,420 and the hurdle on the upside is 21,840. So that's a broad range. And having said that, for today, I think I'm going to trade very cautiously because the volumes are going to be thin. And Nifty has a immediate resistance of 21,720. So over here, if I get any kind of a dip, maybe buy for a target of 21,720. And on the downside, the support is going to be around 21,550. So it's a very narrow range bound market. I think selling options is making better sense right now. And as far as Bank Nifty is concerned, Bank Nifty did not show any kind of a recovery yesterday. When Nifty managed to show a decent enough pullback, Bank Nifty did not do that. So Bank Nifty remains a concern. Today we are seeing some kind of a positive traction on Bank Nifty, but it is essentially stuck in a range. On the upside, I think Bank Nifty needs to break above that 46,300 level for a meaningful upside retracement. And on the downside, the support for Bank Nifty is going to be around 45,500. So that's the range for Bank Nifty. And if 46,300 breaks, then we can say we are headed towards 46,750 on Bank Nifty. So I'll play for a range in Bank Nifty.
Okay, all right. So that is the level to watch out for on the major indices. What about individual names, Ashish?
The first stock pick is going to be Reliance India. We can clearly see a very strong rise in today's session. The volumes are decent enough on the stock despite of the market is open on Saturday. We are seeing decent enough volume. So Reliance India, one can create long positions over here, keeping a stop loss of 256. Aiming for the target of 285. And the next stock pick is going to be NLC India. Over here also we can see a very clear bounce back from the 20 days average. The stock is moving up, buzzing right now with good volumes, and long positions can be created here. Maintain a stop loss of 238, aiming for the target of 265.
Okay, Ashish, thanks a lot for getting us those quick picks as well as a check on the market. With that, it is time for a short break. But on the other side, we're going to focus on Sigachi Industries in our special segment Midcap Spotlight. Stay tuned. We'll tell you why it's up and away when we come back.
More than 1 year of keeping track of the developments in the AIF sector. It's not as if suddenly something came to our notice and we acted. We have been tracking these developments for about more than a year now. And initially we saw some signs here and there. So when we see some signs here and there, we try to deal with it on entity-based approach. You know, our supervisors take it up with that particular entity and try to deal with it on a bilateral basis. But when we see something, you know, becoming, you know, showing signs of getting widespread, we had to act.
How widespread is the problem today?
No, I can't again quantify it, but there was this whole issue of evergreening that was taking place. So therefore, that had to be prevented. All that we have done is that we have, we have also said we have not stopped any lending. We have only said that if you want to continue, you treat it as, you treat it in a particular way and you provide for it in your accounts. And so that is what we have said. And some representations have come, they are being examined.
But could there be any kind of review as far as the
decision
is concerned?
No, I can't say. It is being examined. We have got number of representations. They are being examined. And with regard to the decision, it's a well thought out decision to prevent a kind of a, a new source of stress or a new source of problem for the Indian banking sector. Whether it is the industry or the private sector, or it is the, the analysts or the economists or the serious, the market players. In the context of India, I don't think anybody is expecting a rate cut now. In most of the advanced economies, the markets and the stakeholders and the market players, their assumptions, it is ahead, they're overrunning their
Welcome back. You're still tuned into Midcap Radar on CNBC-TV18. The Nifty is slightly off the highs of the day, so just keep an eye out on that. There's not a major move, but it is up around 15 odd points. It was higher just a while back. But we do have the broader markets which continue to do really well on a thin trading day like this. This is our segment Midcap Spotlight. Ekta is joining us to focus on Sigachi Industries. Ekta, what's happening here?
Well, Sigachi is in focus because just to give you a brief about the company first, it manufactures inputs that go into pharma, supplements, food industries. Pharma is 75% of sales, 26% of sales come from India. Now, this particular company has reported numbers and is doing well on the back of that. So, revenue up 61%, EBITDA 21 crores, margins 18.7% versus 20.4%. So, that's taken a little bit of a hit. But nonetheless, the street likes the growth which has come through in terms of the revenue. And that has come down in terms of the profit, which is coming at around 16 crores versus 9.8 crores year on year. Even on a Q-on-Q basis, there's growth in terms of sales. So, revenue up 12%. Margins, though, have been lower year on year on a Q-on-Q basis, but the profit has shown a good amount of growth on a Q-on-Q basis. Now, 9 months as well, revenue up 28%, EBITDA 60 crores versus 46 odd crores, and profit of around 42 odd crores. 9 months basis, the margins have been maintained at 20%. Now, if you look at it on a long-term basis, the three-year CAGR of the company, revenue 29%, EBITDA growth of 33%, profit of around 29%, FY23 cash flow stood at around 29 crores. The company says its net debt to equity currently stands at around 0.03 times.
Okay, Ekta, thanks a lot for taking us through all of those details. Big move in Sigachi Industries today, up around 11%. But let's talk about one stock which is not seeing such a good move, which is HUL Industries. It's reacting to muted Q3 earnings. Sonal, take us through the details here. Where has the miss really come through?
Well, the earnings came yesterday while we were talking on the show itself, but then they gave out the investor presentation. There's been a brokerage commentary which has come by as well. It was a muted set, something that we'd been pointing out. The company did agree with that. They said that revenues declined declined due to lower sales realizations that the company has been getting. There were better volumes because of more domestic market participation, but it was compensated by weak demand in the export markets, and that's why they could not continue to do well. And that's why they did see a decline on a YY basis, where profits came in at 70 crores versus 105 crore rupees. Now, if we talk about what the other things that the company has said in its presentation, let's talk about that in terms of their working capital, which increased mainly due to increase in current investments that came by. And that is what company says, that because they invested higher amounts in mutual funds as well. The lower price realization and subdued demand in Latin America resulted in weak performances in their life sciences chemicals, and lower price realization and export demand was partly compensated by good performance in their domestic markets. So export continues to be a problem for the company. And lower realizations was something which impacted their numbers as well. Centrum says that they have lowered their FY24, FY25 estimates by 12 and 10%. They've also downgraded the stock to a sell from a reduce, with a target price of 6,063 rupees a share. So not looking good, because this company has continuously been seeing downgrades come by, because the chemical industry in general has not been doing so well. So no recovery in sight, and that's why not looking so good for the stock as well.
Okay, got that. Sonal, thanks for taking us through all of those numbers from Atul. But the other stock we're looking at is Paytm today, and this one is seeing quite a good move higher. They reported an improvement in the EBITDA. The losses have also narrowed to just around 220 crores in this quarter. In fact, CLSA has also gone ahead and upgraded its rating on the stock. So Abhishek is here to take us through all of the details as well as what CLSA has to say. Abhishek.
Well, EBITDA improvement continues for Paytm like last few quarters. However, the loan have declined on a sequential basis in line with what guidelines the Paytm management had given earlier. So total income is up about 40% YOY and about 12.5% sequentially. EBITDA is up 7 times on a YOY basis and about 43% on a sequential basis. Contribution profit margin, that declined sharply on a sequential basis, coming in at 53.3% when compared to 56.6% in the previous quarter, and the net losses have narrowed down when compared to YOY or quarter-on-quarter as well. We have a note, on Paytm from one of the brokerages, that is CLSA. They have upgraded the stock to buy, and from outperformance, target price increased to 960 from 925 earlier. They said that the company is diversifying more after the scale back that they have seen in buy now, pay later, and they expect that trend to continue in Q4 as well. So focus is on cost reduction. Company will try to offset the bulk of BNPL, buy now, pay later business loss by new revenue streams, cost reduction, etc. So they plan to add another 5 to 6 partners over the next 6 months, and they have increased, CLSA have increased the core EBITDA by 3% over FY25 to 26. Paytm is looking to grow in stock broking and mutual fund businesses, while CLSA believe that Paytm can make it big in derivatives trading as well. Back to you.
Okay, all right, that's about Paytm, but there's no dearth of earnings and earnings reactions today, right? So RBL Bank, the Q3 earnings came in below street estimates last night. The slippages have surged and asset quality has deteriorated. Earlier today, we spoke to Bank's MD and CEO R. Subramanian Kumar on their Q3 performance. Listen into what they had to say. The stock is up around 2%. So let's listen in what the commentary is like.
This quarter has been an exceptionally great quarter for RBL. And some of the parameters, especially in the profit parameters, if I just set aside the AIF for the minute, the PAT grew by 53%. And sequentially also it grew substantially high. And ROA was as per the guidance at 1.03. However, the AIF should be looked from slightly a different angle, because this is a new direction which has come from the regulator in respect of the investments made in AIF. If the downstream, the AIF has given to the borrowers, if the customers are common between the bank as well as them, you have to either liquidate it or you have to provide for. The time available was 30 days, and you will definitely agree that it is too short a period for such a liquid fund is to be taken care. We ourselves are conscious about this credit card, CD ratio, as per our strategic discussions within the board, as well as what we have communicated to the market as well, is that we will be in the range of 85%. When we talk about the CD ratio, I would like to have a different perspective to be seen. We have an option of drawing our refinance for funding our loan growth. And we are also having a long-term FX These two are long-term and it is sustainable. So when I try to do this refinance, we have seldom made use of it in our earlier avatar. We have just started using that for funding our growth. If I combine the deposit and the borrowings, refinance especially, and the ratio will be in the range of 73%. Right now, our capital adequacy is well maintained. In fact, this time, even after the sequential growth, we consumed around 65 bips. Even after the regulatory directions of increase in the RWA, we are confident and we feel with this, we will be in a position to manage for next 6 to 8 quarters the capital sufficiently available with us.
Okay, all right, that's the word coming in from RBL Bank. But the Union Budget, that is the next big event. It is less than 15 days away. What is your wish list for the Finance Minister presenting the CNBC-TV18 budget ballot? You can now share your budget expectations with us on our website by scanning the QR code on your screen or by logging into cnbc-tv18.com/budget.
Banks. So far as India is concerned, I think the thinking of the central bank and the thinking of the market participants, they are much better aligned. In inflation, with regard to inflation, I have said elsewhere that our policy has to remain actively disinflationary till we reach the target of 4% on a durable or a sustainable basis. You are right, absolutely right in saying that any premature pivot in our policy, it can be very, very costly for the economy. If you see the last 1 or 2 years, the deposit growth has been around 12 to 13%. Yes. The credit growth has been about 15%. Now, obviously, you see, it's not that you get X amount of deposit and you extend that X amount as a loan. It's not like that. Share prices in the stock market do not necessarily reflect the fundamentals of a company. I'm talking in general terms, not with reference to a particular bank. Generally, if you see, the stock prices are determined by so many other factors and do not necessarily reflect the fundamentals of a company. You have examples in every sector, whether it is the financial services or banking or any other sector you look at. There are companies with very strong fundamentals, but its share prices should be low, and the converse also happens. So therefore, it will not be correct to...
Welcome back. You're still tuned into Midcap Radar. Now, there are a lot of companies which are reacting to their earnings, and shares of Tejas Networks are under pressure despite a strong revenue growth in Q3. So Rima is here to decode the company's third quarter results and tell us where the disappointment has come in this time. Rima.
Tejas Networks is under pressure today because despite very strong revenue growth, revenues are up 40% quarter on quarter, they've doubled on a year-on-year basis. The company has reported an EBITDA loss of 7.5 crore and a bottom line loss of 45 crore. And the bottom line loss for the company has been expanding over the last couple of days. So the reason for this loss, well, the company had recently won a very large BSNL deal. As it executes this deal, it's boosting the top line, but the company is incurring some expenses. There are investments to be made, there are R&D costs. The company is also sitting on very high inventory levels of about 2,683 crore, much higher both quarter on quarter and on a year-on-year basis. And that's the reason why the company has reported expanded bottom line loss this time, and it's also the reason why the trade receivables for the company have shot up to 855 crore. The silver lining is the cash on the books is pretty good at 559 crores.
All right, that's Tejas Networks. Thank you, Rima, for that analysis. And let's stay with the telecom space. IT Minister Ashwini Vaishnav backs the mobile industry's demand for tariff cuts and imported components. Also says that Vodafone Idea is making sincere efforts to get investors. Listen into what he had to say.
I want to go back to Telecom and address the Vodafone issue with you, because when we last spoke, you were hopeful that they would have been able to get investors on board. That hasn't been the case. The government continues to be the largest shareholder in Vodafone. Is that something that you are looking at today?
I think they are making their sincere efforts, and they've been regularly updating us about what they are doing. And I think we have done whatever we were supposed to do. And I think the journey so far has been okay. Of course, it's a listed company, so it's not proper for me to divulge any details or give any comments on that. But yes, they have been making sincere efforts.
So let's address each one of them specifically, and I'll start with talking to you about electronics, because that's the story that India has been pushing, and we have made progress and we've seen results. But industry is also demanding that there be a cut as far as tariffs are concerned, so that the story can gather even more momentum and growth can accelerate. Is that something that was taken up with you? Is that something that is up for consideration, up for review?
We have had a very detailed discussion on this with the industry participants, and most of the participants gave very clear, logical and cogent reasons why they are proposing what they are proposing. And basis our discussions, basis our consultations, we have also made a recommendations, kind of recommendation paper, and I think it's good logical next step, because what has happened is we have to now move from import substitution to export-led growth. That is the moment we need to, that is the transition we need to make, and that requires a totally different mindset, that requires totally different structure.
So there is a case to be made for a cut in tariffs, and you are in favor of that?
Absolutely, especially for the component ecosystem.
Let's also talk about railways, and you said that you had meetings with the Swiss authorities here, but I also wanted to understand from you, in terms of the ambition and aspiration now as far as railway capex is concerned, as far as building on the project momentum is concerned, what's the view, what's the road ahead?
See, the progress in railway expansion and modernization is huge. For example, last year we added 5,200 kilometers of new tracks. That's like adding the whole network of Switzerland in 1 year. 5,200 kilometers. This year we are doing at a pace of 15 kilometers a year. So 15 kilometers a day. 15 kilometers a day is like huge. We have just, out of the $29 billion capex that we have planned for this year, 2,40,000 crore, we have already accomplished 77% as on yesterday. I get a report on a daily basis, I monitor it so closely. So we have already achieved 77% of it.
All right, so that is an interesting word coming in. But with that, let's also take a look at Canfin Homes numbers actually. That stock is slipping in trade. It's down around 2.5% right now. Net profit is quite all right. It's around 32% higher. NII has come in around 30% higher as well. So it's coming at 330 crores. What we had last year was around 250 crores. The gross NPA is 0.91%. So those are just the initial numbers that I have. But like you can see on your screen, the stock has seen a sudden slip. So we'll wait for some more finer details on this as well. But moving on now, let's talk about one company which is due to declare results today. That is Persistent Systems from the Midcap IT space. They will be reporting their Q3 earnings. So Rima is here to tell us what we can expect this time around. Rima.
Expect a steady quarter from Persistent this time, though growth rates are going to come down. Q3 is a seasonally weak quarter. Persistent has a very high share of discretionary spending, tech spending, and that's been under pressure. So dollar revenue growth has gone up by 2% on a quarter-on-quarter basis, according to the CNBC-TV18 poll. On a constant currency basis, the expectation is of a growth of about 2.6%. Margins could expand 40 basis points sequentially to 14.1%, driving a 3.5% increase in the company's profitability. Does the company continue to hold on to its guidance of industry-leading growth this year, and margin expansion over the next 2 years is something the street is tracking closely.
All right, Rima, thanks a lot for getting us all of those estimates. Mahanagar Gas will also be reporting its Q3 earnings on Tuesday. Sonal, what can we expect from MGL this time?
Okay, so Q2 was really strong for the company, and this time that's the reason why we'll see a sequential decline. They did see record high EBITDA per unit. The stock has recovered from the lows, but taking you through the numbers, it will be a revenue decline of 3.5%. EBITDA is expected to decline 12% to come in at 422 crore rupees. Margins accordingly will see a decline of 300 basis points, again as I said, we're coming in from a very high level. Profits are also expected to go down by 12%. What are we watching out for? Margins will be declining because of lower APM gas allocation, and we did see higher spot LNG prices as well in the quarter gone by, and that is something that could impact their business. But do remember, spot LNG prices have come off from those record highs as well. The other thing is we're expecting a volume growth of 6% on a YY basis, which is an uptick of 1% on a sequential basis, to come in at 3.6 MMSCMD, which will be led by their growth in the CNG volumes, which are expected to go up by 6% on a YY basis. The unit EBITDA is expected to decline quarter on quarter at 13.7 rupees per SCM, and that's where really the weakness will come in. But we've been seeing that volume growth for CGDs generally has been declining. So whether that trend continues or not will be important to watch, because that is one thing that Street has been worried about since quarter 2. So whether that continues in quarter 3 or not, we'll be closely watching.
All right, we will track that. Sonal, thanks a lot for getting us all of those details. With that, we're completely out of time on this edition of Midcap Radar. We leave you with the news that the market is absolutely flat, just around 5 points in the green right now. But the banks are doing well, around 400 points higher on the Nifty Bank. Thanks for tuning in. We have your stocks on the other side.
Health of a particular sector like banking in particular in terms of share prices, movement of share prices, and that too on a single day.
There is a concern or perhaps confusion as far as the credit deposit ratio is concerned and whether the RBI is likely to mandate a number or not. Could you clarify this for us?
You see, we have not mandated any number. I think there was, let's leave that. But what I would like to say very clearly is that we have not mandated any number that this shall be the credit deposit ratio. We have not, and at the moment we don't propose to, because credit deposit ratio is just one of the parameters to assess the health of a bank. There are several other parameters. So you have to look at it all in totality. All that I can say is that there should not be exuberance in lending. Number one. Number two, there should be some correlation between your deposit base and your credit growth. There should be some correlation. But in terms of hard coding it, in terms of a particular number, there is no such proposal in our mind, and we have not prescribed any such number.
Let's address what's happening across industry today. And I want to address the issue of why Wipro's decided to sue Jatin Dalal. I mean, you know, been with the company for decades. Why the decision to do that?
Yeah. So Shireen, I'm not going to get into a specific case, but let me just say the following comments, right? One is we are simply enforcing a standard industry contract that everybody sort of follows. We are not creating any prevention of employment or job opportunity for anybody, right? And we're simply ensuring that, you know,
Hello and welcome to the CNBC-TV18 Mumbai studio. I'm Ekta Batra and you're watching Your Stocks this Saturday afternoon. Well, it's turning out to be a session which is largely quiet. You have the frontline indices which are consolidating, but we have the mid-caps which are trading. We have the bank nifty which is up around 0.8%, and it's really peppered with a lot of earning reactions from the broader market. So it's turning out to be quite a session in terms of specific numbers. We just had Canfin Homes which came out with its numbers, and the stock reaction should come up for you. That particular stock just about released its numbers just a couple of minutes ago. The stock is down around 2% reacting to its Q3 performance. But joining us this afternoon, we have Parthiv Shah, who is the director at Tracom Stock Brokers, Vaishali Parekh, who is the head of tech research at Prabhudas Leeladhar, to answer all of your queries today. Parthiv as well as Vaishali, thanks very much for taking the time out from, you know, what is the working weekend. Vaishali, first over to you. Wanted your thoughts about today's trading session and also in terms of the indices. How are you trading it?
Very good afternoon. Yes, I won't complain about today's working because yes, market is giving us good opportunities for a good trading session. So yes, I'm quite okay with it. And coming back to index levels, I think market continues to be in a range bound. So as long as we are holding on to 21,250, I would say, the support is respected. And we are waiting for Nifty to cross 21,750. So only unless and until we move past this level decisively, I would say that we are back on track. Till then, I would say it's a range-bound move. And likewise for Bank Nifty too, I think 45,500 acts as a support and 46,300 acts as a near-term resistance. So it's a mixed view, just a sideways move for now.
Okay, all right. We have a whole host of numbers to reckon with as well in today's trading session. So we do have ICICI Bank, which will be releasing numbers. We had Kotak, which came out some time ago. So that particular stock is in focus post its numbers and holding with a gain of around 3% odd. But let's get in some queries now. We have Balu, who's on the line from Bangalore, has investments in Coal India. Hi, Balu.
Hello, ma'am. Good afternoon.
Afternoon. Tell us.
Yes, ma'am, I have a query regarding Coal India. I have bought 580 quantities around price 260. So the current price, it's 398 around. So I just want to know, like, should I exit at current price or should I still hold?
Okay, all right. Well, what should you do? You're sitting on a profit, Balu. What's your horizon in terms of holding the stock?
Like plan for a short-term investor, like 8 months. So last October, I've made an investment on this stock.
Okay, all right. Parthiv, well, let's start the show queries with you. What would you recommend to Balu? Because Coal India is at the best levels that we've seen since, in the past few years, I think since 2015, as per some data that Nigel sent. So based on that, what would you recommend? Do you think that it might just be prudent to take some profits off the table and, anyway, the horizon is short term?
Good afternoon, Ekta. See, his horizon is a little short term, but our sense is right now momentum is in his favor. Coal India, we know for the fact it's almost like a monopoly and it's India's largest coal producing company. Not only that, government has very, very aggressive targets for it to up its coal mining. The reason being that, India does not want to be a net importer of coal eventually. So I think we are seeing a lot of thermal power plants which are operating at high plant load and plant availability factors. Not only that, I think a lot of user industries like steel, power and other proxy industries use a lot of coal and they are dependent and have a lot of linkages with Coal India. So there are very high incremental targets for Coal India to mine, if not less, at least 800 million tons per annum. And if that were to happen, if you look at the amount of cash flow that Coal India can generate, even at this price, at this higher price of Coal India, where the share price has run up a lot, it's still sitting at a trail dividend dividend yield of around 6%. So for the gentleman, I think the dividend yield is a lot higher and seeming to go up. So my sense is for the next 6 months, at least hold on to this bet.
Okay, so you're recommending to hold on for the next 6 months. Vaishali, what would your technical call be on Coal India?
So I would say that yes, Coal India has enjoyed a very good rally and it still shows a lot of strength. But having said that, I would say that the near-term support lies at 380. From that is a level where we saw a bit of consolidation and a new round of momentum setting in. So now we have a projected target of 420 to 440 levels. But I think in a market like this, whereby we can witness some choppiness or some corrective move, if that occurs, 380 should be the trading stop loss. So since he's already enjoying so much of profit, he should continue holding this stock, but a trailing stop loss is a must.
Okay, all right. So that's the word coming in on Coal India, doing very well, almost touching that 400 odd level in today's trading session. Well, let's get in another question now. We have KS Rao, who writes to us from Andhra Pradesh. He holds around 100 shares of Jyoti Labs from the FMCG space, which he's bought at around 150 rupees. So he's sitting on a good profit on that one. And he wants to know what to do, whether to hold or to sell at these current levels. Well, he's sitting on a very good profit at this point. What would you recommend on the technicals then? Do you think that Jyoti Labs is good to go, good for more, Vaishali?
I would say on near-term basis, I'm just seeing the daily chart and the weekly chart. Weekly chart also says that we have seen a one-way rally coming right from 200 levels to now. What we are seeing is 520. So I would say partial profit booking is a must because it's already in deep overbought. So do take the opportunity to again re-enter at lower levels, because the way the chartical formation is, it's a very strong stock, but profit booking should be prudent at this level to getting the opportunity to re-enter at lower levels.
Okay, all right. Fair enough. That point is taken. Well, Parthiv, what would you do on the fundamentals of Jyothy Labs? Because they seem quite bullish in terms of, wanting to perform consistently in terms of double-digit growth going forward. Would it be a buy on the fundamentals?
See, very frankly speaking, I think the general plans enjoyed a very good run, and current multiples are quoted at around 48 times FY26, which according to us is not at all reasonable. And owing to the fact that Jyothy Labs, one of the peers being HUL, I think if you see last 2 years in terms of the revenue growth, which includes the volume growth and value growth, it has been merely at 11.5%. So I think a lot of these companies which have very significant rural presence, they have been kind of struggling to grow their volumes. And unless and until the volumes bounce back, I don't see a reason why to kind of stay put with these stocks. He's sitting on very good profits. Rather, I would suggest, if comfortable, switch from Jyothy Labs into a stock like ITC. ITC offers a lot more value, and the way they are expanding different product categories, not only in the cigarette space, but more importantly in the FMCG space, I feel there's a lot more value to be created in ITC over the longer horizon versus sitting on Jyothy Labs.
Okay, all right. Well, let's get in another question now. We have Shweta Khurana, who writes to us from Pune. She holds 10 shares of HDFC Bank, which she's bought at around 1,000 odd rupees. And given the earnings by the bank, she now wants to know whether to stay invested or exit at current levels. She wants to know when she can again buy some of the shares of the bank. Well, multiple questions in this one, Parthiv. So let's take it one by one. One, do you think that it's reason enough? This set of numbers were reason enough to exit? Do you think that she should probably hold on? And do you think that she should probably eventually add? And what time or level is a good level to add? Maybe I can address that with Vaishali. But on the fundamentals, do you think that this set of earnings was good enough for them to exit?
See, Ekta, I think I can feel for the investor, because the investor was an investor at around 1,000 bucks, and post which she witnessed a very good rally going right up to 1,700 levels. And it just took one bad quarterly result to spook the sentiment, and we saw almost a 15% decline from the peak valuations. Our sense is that this is not the time to think of exiting. The reason being that, yes, it was a difficult quarter for them, but difficult not in terms of major asset quality drawdown or any other major problem. It was just the deposit growth, which was lowest as compared to the previous 6 quarters. That is what has really spooked the market. And again, we were knowing of the fact that the names would get contracted because it's a huge merger with HDFC Limited, and probably that pain could be bared for the next 2 to 3 quarters. But after which, I think probably with the synergy benefits, we expect a lot more upside. So rather, I would suggest that if the investor is a little long-term horizon investor for the next 2 to 3 years, one can even add more positions to HDFC Bank at this juncture.
Okay, well, talking about banks, we have Union Bank, which is reacting very handsomely to its numbers. The stock is spiked up around 6 odd %. So net profit is up around 60 odd % and on a year-on-year basis. Extremely strong net profit growth, which has come through for that particular PSB. And that's probably fired up a little bit of sentiment as of now. But as you can see, ICICI Bank is also at the high point of the day ahead of its numbers. So that stock is up around 1.2%. More details will be awaited for Union Bank. But prima facie, I think the stock likes the strong profit growth which has come through. Let's stay with the entire financial space. We have Canfin Homes, which just reported its numbers a couple of minutes ago. Abhishek is here to tell us more about this NBFC.
First let me talk about the negative. The asset quality has deteriorated a bit. Is it a worrisome factor? No. Why? Because the yields are impressive. The interest income growth on a sequential basis is strong. And if you take a look at the provisions, they have declined. So it looks like, this stress or the deterioration in asset quality might have come in from known stress account. Remember that they had some restructured book, which was due, for payment in November. That management has already told us before. So it looks like a part of the rise in gross NPA would be from known devil, that is the restructured book. Taking a look at the P&L, it is in line with what Motilal Oswal was expecting. So we have a 329 crore NII. Motilal Oswal estimate was 327 crore, and 200 crore of profit. Motilal Oswal estimate of 199 crore. So it is in line with respect to what Motilal Oswal was expecting. They were expecting a 13% YOY kind of a loan growth, and if I do back of the envelope calculation, the AUM growth would be around the 13% YOY and about 2% sequentially. What is heartening to see is that the 2% sequential AUM growth and 3.8% NII growth sequentially shows that the net interest margins and spreads would have improved on a sequential basis. Otherwise, for other NBFCs or if you take a look at the other non-financial entities, the net interest margin is compressing, but over here the net interest margin might have improved on a sequential basis. Anywhere between 5 to 10 basis point is the rough guess, given the computation that the numbers have thrown up. Back to you.
Okay, all right, Abhishek, thanks very much for that. Can Fin Homes is a bit sluggish, but I think the big story emerging in today's trading session is the better than expected bank earnings, which have come out and really assuaged concerns. So I just want to point out that Union Bank, their gross NPA is improved all the way to around 4.83 versus 6.38%. They also have an absolute gross NPA, which is reduced sequentially. Profit growth is strong. They have shown NII growth this time round. The street likes the asset quality the most. And another example is IDBI Bank, which reported a net profit growth of around 57% on a year-on-year basis. So IDBI Bank too has surprised the street in terms of a positive reaction on its numbers. It started with Kotak, it went to IDBI Bank, now Union Bank. So it seems as though there is a positive momentum which is being created in terms of a lot of these banks which have reported numbers, and I think that should be, generally a sentiment positive that we have for the markets. But nonetheless, that's all the time that we have on the show. More news will follow on the other side. Stay tuned.
We've signed a contract and we want to ensure that we protect ourselves from an information standpoint along those lines. So I wouldn't read more into this. I find sometimes there's a tendency to sensationalize this.
No, it's not sensationalizing. It's an unusual thing to happen.
We're simply enforcing contracts, which is not an unstandard thing.
For us, India is worth the investment that we're making in India. So when you look at India, it accounts for 10% of our global trip volume. So India is huge for us, and India is growing at about twice the rate that the rest of the world is growing at. So fast forward, if we're talking 5 years from now, India is going to be an even larger portion of our business.
Talking about the growth opportunities that you see in India, what is it going to mean in terms of expansion plans? What is it going to mean in terms of incremental investments? And do you now regret getting out of Uber Eats in India? Look at what's happening with companies like Zomato and Swiggy there. Are you?
I have to tell you, the nice corporate thing to say is I have no regrets. I'm a little jealous. It's a great opportunity, but we made a commitment as a company to invest in businesses where we thought we could be the number one player. Because in order for you to have positive returns on capital, and in the end, we're a business, you got to get to number one. We thought on food delivery, Zomato and Swiggy, they are great companies, and we didn't see a path to number one that was worthwhile. We look at the mobility business, we see huge potential, and the biggest potential we see in actually mobility now are two-wheelers and three-wheelers. So our three-wheeler business, our two-wheeler business, are growing at significant rates. We're looking to electrify those fleets as well. We're looking to partner with local companies in India who are building electric two- and three-wheelers and four-wheelers that are affordable, that are available to the mass market, etc. So we see India really as the crest of the electrification wave for us, in that we don't think electrification should be restricted to rich markets and rich people. We think it should be available for the masses, and India is going to play a very, very big part in it.
Welcome back. Well, ahead of the Pran Pratishta at Ram Mandir in Ayodhya, Mangalam decodes the most popular temple towns in India and the likely size of the tourist economy. Mangalam.
The excitement of the opening of the Ram temple in Ayodhya, the cheers that there are and the footfalls that are expected, it's important to look at some of the most popular temples in India as well. And the one that takes the top honors for the longest time has been the one in the southern part of the country, Tirupati Balaji, which attracts 50,000 to 100,000 devotees per day, and a number that swells to 30 to 40 million visitors per year praying to Lord Venkateshwara. At the second place is a number not too far away from the number of devotees visiting the Tirupati temple are in Amritsar, the Harmandir Sahib, the Golden Temple in Amritsar, attracting 75,000 to 90,000 visitors per day. Again, a number that amounts to 27 million to 33 million devotees per year. Now, coming down to the metros, in the western part we have Mumbai, the mega metropolis, and out there you have the mega Ganapati temple, the Siddhi Vinayak temple, which attracts its fair share of devotees, and a lot of them coming from the resident population of Mumbai itself. That amounts to 75,000 to 90,000 visitors per day. Again, a number which overall swells to 18 to 22 million visitors per year. Now, in a city not too far away from Mumbai, we have Shirdi, and out there too, the temple town of Lord Sai Baba, we have a fair amount of visitors who come in not only from Maharashtra and neighboring states, but from the country, and foreign tourists too. Close to 40 to 50,000 visitors per day visit the Shirdi Sai Baba temple, and a number that amounts to 15 to 20 million visitors per year. Among the top 4 dhams of Vishnu temple, one of them is in Odisha, the Jagannath Puri temple, and that too gets its fair share of devotees, 20,000 to 30,000 visitors per day. This average number increases a lot more on important occasions like the Puri Rath Yatra, 7 to 10 million visitors per year. Come up north in the hilly region, we have the temple of Mata Vaishnav Devi, slightly difficult to get to, but does not stop the determination of 18 to 27,000 devotees who visit the temple every day. Again, a number that amounts to nearly 7 to 10 million visitors per year itself. To estimate the kind of footfalls that the Ayodhya Ram temple would see, it's also important to triangulate the kind of surge that we've seen in temples post-renovation. And the prime example of this is Varanasi's Kashi Vishwanath temple, which earlier would attract around 7 million tourists annually, but post its renovation, it attracted 73 million tourists in 2022, a number that has surged 10 times and is much higher than all the other temples in the country itself. And this is something similar that we saw in Ujjain as well. One of the 12 Jyotirlingas of Lord Shiva, the Ujjain Mahakal temple, would earlier get about 25 to 30,000 visitors per day. But very recently, we saw the Mahakal corridor being developed, the temple being renovated, and as a result of which, a 4 times jump in the number of tourists is what we saw. Close to 100,000 people visiting this temple. What does this mean for the Ayodhya temple then? Estimates suggest anywhere between 100,000 to 300,000 visitors per day once the temple opens. Sustainably, that could mean about 100 million tourists every year. Each of them spend 1,000 rupees. You have a ready temple tourism economy of close to 10,000 crore rupees.
Well, thanks, Mangalam, for that excellent coverage there. And not to mention that this temple economy is only growing and the numbers will just keep rapidly rising. Well, for the market, it seems as though it's definitely much better for the mid-caps as well as the bank nifty. Like I've been pointing out, there's a lot of positive sentiment which has been fueled really by Kotak Mahindra Bank. It's been taken forward by the likes of IDBI as well as Union Bank. So none of these banks have really deterred sentiment. They've not disappointed the street, and now the street is preparing itself for ICICI Bank, which will be out between probably post markets. Just want to point out that we also have the Kotak press conference which will be taking place at 3 p.m. this afternoon, so the street will be watching out for that. Separately, a lot of the PSUs continue to rally. So we have RVNL, which is up around 9% at this point in time. We have NBCC, which is up around 8%. And separately, outside of that, we have a couple of other stocks such as JK Tyre, which is doing very well. So that stock is up around 7.5%. Talking about a couple of other banks which are still to release numbers, Central Bank of India, PNB, UCO Bank, IOB, they all have been fired up after both of these numbers have come through with no disappointments as yet. So that's in focus. We have JK Cement on your screen. Net profit 284 crores versus our poll of 253 crores. There's been a margin expansion which has come through for JK, I think. And revenue is better than expectations as well. So 2,935 odd crores as compared to around 2,839 odd crores. EBITDA much better than our poll. So our poll stood at 561 crores. It's coming at around 625 crores. Stock is up around 2.6%. As you can see, the margins have outperformed. Seems as though there is no disappointment or marginal disappointment from earnings, and that's probably what the street is going to like. It'll be important to see what Tuesday looks like as well, considering that the FIIs will come back on the table. There will be more trading volumes as well. That's all the time that we have on this show. Stay tuned. Closing bell will take you through the last hour of trade.
Our sense is every client is looking at what generative AI can do for them. We've ourselves positioned as an AI first company, so we are using all of these things inside. We have assistants, AI assistants now for each of our functions, whether you look at HR, recruiting, sales, delivery. So that is a transformation inside. The client meetings are just extremely good, very positive thinking from most of the clients. Economies in Europe, US looking like they're coming to maybe not yet in terms of full recovery, but at least they see their work behind them in terms of what the issues were. Of course, the conversations are positive.
People are asking you, global investors are asking you about India and the growth momentum.
Thank you very much, first of all, for having me on your show. Well, as far as the global investors are concerned, they are quite keen. They are actually tracking the India story with a lot of interest. The kind of resilience which has been demonstrated as far as Indian economy is concerned, it is of significant interest for them. Many of them are very keen to look at their supply chain relocation, and they want India to be part of the supply chain. So I think to that extent, India's story is quite promising, and apart from the many other things, the green initiative of India, and more so in terms of solar, renewable, battery, EVs, these are the kind of things which are also attracting a lot of interest from the global investors.
The focus and the attention is on AI, but I know you want the world to focus its attention and its bandwidth on what's happening as far as attaining the healthcare goals are concerned. And you're concerned that we're slipping and that funding is an issue and a big challenge.
That's right. You know, making sure kids survive, making sure they're well nourished. There's been a lot of progress since the turn of the century, but with all of the unrest, you know, the pandemic, we've lost attention to that, so we need to go back and keep reducing these deaths. We went down from 10 million to 5 million, and we can cut it in half again. India's a place that is making progress. We've got a lot of great partners there, but we need to get these new innovative tools out helping the patients.
What's the one big risk that you're most concerned about today as you look at the world?
Well, the instability you know, that includes things like U.S.-China relations, that could slow down all this progress, and so hopefully you get reasonable works on both sides, and you know, India can play a role there.
What role do you believe India can play there?
Well, India's, you know, setting an example. India works both.
On the downside, I mean, I think you know, we'll be well served if this recent low which we saw, which is 21,285, does not come into the picture anytime soon.
I think the economy is going to remain very, very strong.
Now, this time around, there was growth across key operating businesses.
75% of the business has registered mid-single-digit volume growth.
The Nifty has been, steady around the 21,700 mark. And that's where we're at this morning.
The previous bull market was driven by quality. The current one is driven by PSUs.
Our power plants were ideally designed for 23 to 30% of domestic coal only.
As far as the slippage is concerned, it isn't alarming.
But it's green signals everywhere, I guess, for the railway stocks because they're just not showing any signs of stopping whatsoever.
We've got about 1,300 stocks gaining, 850 stocks in the red.
While net NPA has declined by 3.9%.
The Bank Nifty, which is up around 390 points, and it's the mid-cap side of things which are doing really well as well.
Well, it's a quiet Saturday afternoon, and not very much is happening at all as far as the indices are concerned. It's the last hour for the week. Usually we say that on a Friday, but we're saying that on a Saturday. I'm Prashant, and closing bell with me, my colleagues Nigel and Surabhi. Guys, hi afternoon.
Hi Prashant, I just hope this doesn't become the norm, right? That Saturdays become the last hour of the week. There's something about a nice Saturday off that's not quite the same with the Monday off. But anyway, this Monday is different, so we'll take what we have.
There's just the look on Surabhi's face. Saturday afternoon, nice music, reading a book, chilling, taking it easy.
We'll get to it next week, no problem.
Covering the stock markets live on CNBC-TV18. Surabhi, kudos to you.
Oh, well.
We'll let her take it easy over the next 1 hour. Anyway, let's quickly tell you what's going on, which is not very much actually. If you look at the frontline indices, just a few points here. As I said, it's a quiet day, except what's happening with PSUs. There is an absolutely wild ride which continues for the second straight session. Stocks are up to 8% to 15%, depending on what you look at. Otherwise, it's all quiet. Early morning gains, at least in frontline indices, they've all fizzled out. And, we were discussing the possibility of that this morning at 21,700. We got to 21,720, which is the day's high. But as we've not seen that level back once again, you need to close above that first. And then, of course, the second and the final retracement to the 61.8, which is 21,800, as we've been saying. Gains on the Nifty Bank, and the Nifty Bank today, at least on a day-on-day basis, is doing much better than what the Nifty is doing. But it's so weak that we've not even got to the 38% retracement. That stands at 46,530. We're at 46,130 at this point in time. So that's the picture. And of course, as I began by saying, no real problems for the public sector space, not public sector banks, but, the railway pack and capital goods and, all kinds of names there buzzing with activity, really. Nigel.
Well, indeed, but some of these cement numbers that are coming in there, they're looking quite good and quite encouraging. So JK Cement as well, that number looks better, but the street had a bit of a sense on that set of numbers. From Ultratech Cement, we didn't see any disappointment coming in there. So it appears after Ultratech Cement came out with those volume numbers, the street got a little bit skittish. But now with the recent numbers, Sri Digvijay Cement, they're talking about holding around 1,500 rupees per ton. You had Ultratech Cement, the numbers a little bit better, and now JK Cement as well. So the first three numbers that I'm looking at, they're good, Surabhi. But what are you tracking this Saturday afternoon?
Well, surprise, surprise, I am tracking banks. Just thinking about the reaction to Kotak, for instance, look at the way the stock is up right now, and we'll debate this as we go along with our guests, and we'll have Abhishek coming in as well. Kotak, even as we speak, is still maintaining that gain of around 2.5%, just a little off the highest points. But the issue is whether we can take today as the final verdict or not, because remember that foreign investors are not in the market today. And what happened on HDFC Bank, not to compare earnings or the banks at all, but just saying that the real reaction came in with the kind of FII selling that the stock had to digest. So, with the lack of participation, even domestic institutions on the sidelines, foreign institutions on the sideline, whether we've seen the final verdict or not, I'd want to hold my breath on it, because while margins are steady on Kotak, there is a rise in slippages. So is it less than the market's anticipation, more? How will institutions read the picture? Perhaps we'll have to wait till Tuesday to get the final answers. But let's kickstart the session talking about the trading strategies that you could consider in this last hour. We have Mitesh joining in as always. Mitesh, good afternoon. Finally, the last hour of the week. So tell us, what are you doing? Anything on the index? Otherwise, individual stocks?
Good afternoon, Surabhi. Nothing much on the index. I've maintained that it'll chop around. And that's what is happening. We are seeing bouts of selling and buying. One day Bank Nifty was weak. Today Bank Nifty is strong. Nifty is subdued. So it is a market which is consolidating because the uptrend has come to a halt. And some consolidation will possibly add to strength unless until we start breaking down. So as of now, the odds are slightly more towards consolidation happening for the next few days, and then the market can possibly pick up steam. On the stocks side, you were just talking about cement numbers. Shree Cement is something, which has given a good positive crossovers on the hourly, 2-hourly charts. So that could see good traction in the coming few days. So that's a buy with a stop below 27,350. And I would look at a target of around 28,500, 28,600 to begin with. Maybe slightly higher levels can be tested because the pattern is quite strong on the and showing good traction on the upside. And the second stock which I'm watching is Kotak Bank. It's reversed sometime during the afternoon today, then had a pullback candle, but I think overall the chart is improving. So we'll take a very tight stop at about 17.99 and look for a first target of around 18.55.
Okay, all right. Mitesh, we discussed public sector in the morning, right? And you said IRCTC is one of the stocks which you own in your portfolio. You may want to listen into this next sort of piece. My colleague Hormuz is here, and for the last 2 days, because the pack has been doing so well, he's trained his lenses on what's happening in this in this particular pack. So strong gains once again. The interesting thing, Hormuz, is if the government wishes, right, they can solve this, not solve, but reach and hit and exceed the divestment target. Forget about doing everything together. I mean, they just take, look at railway stocks and decide to do OFS, etc. there. I mean, they'll be home. Take us through the data.
It's the flavor of the season, PSUs, and this rally is showing no signs of slowing down, and it is only ensuring that the government laughs all the way to the bank whenever it decides to monetize this stake, that is. Now, as of today, there are 19 government companies where their stake is more than 75%. As of today, that stake is valued at 2.4 lakh crore rupees. Now, out of these 19 companies, there are 9 of them where the government stake is in excess of 90%. Now, most of the names in this list are smaller PSU banks like UCO Bank, Central Bank, Punjab and Sindh, along with India's largest insurance company, and that is LIC. Now, when we first reported about this in July of last year, that excess government stake that I'm talking about was worth 1.5 lakh crore rupees. Now, by the time we did a follow-up 2 months later in September, that stake was worth 1.9 lakh crores. And now 4 months later, a further 26% surge has taken the value of the stake to 2.4 lakh crore rupees. So which are the companies where the value of the government stake is the highest? Unsurprisingly, it's LIC. Now, having sold only 3.5% stake during its IPO, the government still owns 96.5% stake there. That excess stake, as of today, is worth 1.2 lakh crore rupees. However, in this case, the government still has time until 2032 to comply with these minimum public shareholding norms. Now, next on the list is IRFC. Actually, IRFC is everywhere these days. The government still owns an excess 11% stake in the railway financier, which, if it plans to monetize, will fetch them a handsome 22,500 crores. And as I highlighted earlier, the smaller PSU banks where the government owns more than 90% stake, these ones complete this list. Now, barring most of these PSU banks, these smaller names, most of the other PSUs have seen a stellar run over the last 12 months. Now, take a look at this. IRFC is up 4x. Mazgaon Dock has tripled. HUDCO has tripled. Even a company like General Insurance Corporation, which we don't speak about as frequently as the others, has doubled over the last year. But harping back to IRFC, why should this also be in focus is because its lock-in period is ending on the 29th of July, which will mark 3 years of the stock's listing. Now, that will make 261 crore shares or 20% of its outstanding equity becoming eligible to trade. That's according to a Nuvama note. So, 2023 was the year of the PSUs. 2024 has begun on a similar note. The government is very much in the money. Now, the ball is in their court as to when they choose to rake in the moolah.
Thanks a lot for that, Hormuz. Deepan Mehta joins us on the show. Deepan, what's your take? How would you approach these stocks? Hormuz put that together so beautifully. Your view?
Yeah, good afternoon, Nigel, and thank you for having me on your show. Yeah, I think government is laughing all the way to the bank. And I think it's great news, and it gives a good opportunity for them to disinvest some shares in the next fiscal, which is the election year, and that much more can be channelized towards government spending into infrastructure or even rural upliftment schemes, all of which will benefit the economy in the long run. So here you have a direct correlation between stock price movement which will increase government expenditure, which will directly benefit higher GDP growth rates and perhaps even better corporate earnings. So it's great, I think, from a country's perspective. And it's sooner rather than later, I think the government should look at divesting the stakes in these companies. And in any case, I think the need of the hour is to improve the floating stock of these companies, because some amount of froth is also building up because of low floating stock.
Yeah.
Okay. All right, Dipan, stay on. We have more questions for you coming up. Have to look at all the financial numbers that are coming in. So let's bring in Abhishek. We'll start actually with the housing finance company that reported numbers just a while back, Canfin Homes, where there's been a rise in bad loans. The stock had a lot of sort of volatility immediately after those numbers. Abhishek, give us the details.
Well, you are speaking of bad loans, but bad loans has not come in fresh in this quarter. That is what looks like from the preliminary numbers. Now, stress might have come from known stress account. We already had spoken to the management, and their restructured book was due to expire in November. So stress might have come from there, because there is no impact on the yields or provisions that you are seeing in their P&L. Quarter on quarter, the interest income is up more than the calculation on loan growth, and even the provisions have declined on a sequential basis. Talking about asset quality, gross NPA ratio is at 0.91% versus 0.76% in the previous quarter. Back of the envelope calculation shows that AUM growth is about 13% YOY and 2% sequentially. Motilal Oswal was working with an AUM growth of 13%. Now, net interest margin might have expanded anywhere between 5 to 10 basis points based on calculation, and cost to income ratio has also improved to 14.7% when compared to 17.1% in the same quarter last year and about 16.25% in the previous quarter. In terms of the P&L, they have given an NII of 329 crore. Motilal Oswal estimate was 327 crore. PAT has come in at 200 crore, while Motilal Oswal estimate was 198.5 crore. Back to you.
Okay, that's Canfin Homes, but let's revisit Kotak Mahindra Bank numbers as well. Abhishek, how are the numbers?
Well, the numbers are a mixed bag. Take a look at the net interest margin. That has worked really well for them. It has held up at 5.22%, while other lenders or other bankers are seeing a decline in their net interest margin. Now, slippages are below analyst estimate at 1,177 crore. We had one analyst estimating slippages at 1,300 crore. Asset quality is up on a sequential basis, but only 3.5%, and the restructured book has declined to 0.13% when compared to 0.15% in the previous quarter. Subsidiaries' profits in terms of quarterly profits are at all-time high. What has not worked is that the loan growth on a YOY basis is perhaps at a 9-quarter low, and loan growth is also below analyst estimate. Loan growth has come in at 15.7% YOY and about 3.25% sequentially. Motilal Oswal was estimating 16.6% YOY growth in loans and about 4% sequentially. Kotak Bank says deposits is a challenge. Take that note very carefully. 24-quarter low in terms of CASA ratio coming in at 47.7%, and deposits growth has been about 15.5% YOY and just 1.9% sequentially. Motilal Oswal was working with a deposit growth of 20.5% YOY and about 3.5% sequentially. What has also not worked is that for the first time in last 10 to 11 quarters, gross NPA ratio has inched up or shown an increase. ROA is at 6-quarter low of 2.22%. So P&L with respect to our poll, NII is a beat. However, profit is below our poll. Back to you.
Okay, so mixed trends over there. Abhishek, hang on, just stay on. We'll discuss ICICI's expectations in a bit. But let's first get Deepan to weigh in on these two earnings. Deepan, so, how should we read Kotak? Let's start with Kotak there, because there is a rise in slippages. And as Abhishek has mentioned, that bank is saying that deposit mobilization is going to be the key challenge. And that's going to be something that the RBI is anyway keeping a hawk eye on. So how would you read the reaction that the market is giving today? And what's your own advice on the stock?
Yeah, I think on the whole, I think Kotak Bank came with good set of numbers. And the key matrix was the pre-provisioning profit, which was, I think, 17-18% higher. And that's so far best in class, even as compared to some of the other smaller banks. On the whole, of course, there are challenges on the deposit front, but bankers have made a presentation to RBI to ease liquidity over there as well. But the only reason to the real reason to be overweight to Kotak Bank is the valuation. I think at around 20 times trailing 12 months, I haven't seen the stock traded so cheap since for a very long time, perhaps since its listing as well. And if you're generally bullish on the Indian economy and Indian GDP growth rates, then you cannot be bearish on these large companies like HDFC Bank, Kotak, ICICI, Axis. They are the ones who are going to lend the money to the economy so that the wheels of activity can go on and increase and improve the GDP and the overall activity in the market. So I'm very positive on private sector banks, Kotak Bank included.
And Canfin, any thoughts there?
Canfin is a nice, I would say, conservative lender. They focus on salaried incomes. And by and large, even when the ILFS crisis hit NBFCs, this was one of the safer banks. They had some issue with uncertainty in the top level management, but that has been completely resolved. And I think it's got a great future. Valuations are pretty decent. And real estate sector also is picking up very well, which means volume should do well for housing finance companies. So generally positive on Canfin Homes as well.
All right, Deepan, just coming back to you. Abhishek is still with us. Abhishek, I'll ask you to explain what you're expecting from ICICI Bank, but I just want to put up the IDBI sort of chart. 11% surge. It's a massive move. Have you looked at the numbers, Abhishek? Anything which stood out if you have?
I have not been able to look at the numbers, Prashant.
Okay. So maybe a little later then. Why don't you tell us, ICICI Bank, it should be reporting in the next hour and a half or so. What's the expectation?
Street is anticipating lowest NII growth in last 21 quarters. That is what analysts are pegging in, and profits can decline on a sequential basis. So the key things to watch is loan growth will be strong. Kotak Securities estimate loan growth of 18.5% YOY and about 4% sequentially. Net interest margin can come under pressure. Now this is in line with what we are seeing in the industry. Morgan Stanley expects a 17 basis point decline in net interest margin on a sequential basis. Kotak Securities estimates provisions to increase on a quarter-on-quarter basis. Slippages may rise quarter-on-quarter, but watch out from where is it coming. Is it coming from known stress account, or is it fresh slippages coming out of the loan portfolio? Again, Morgan Stanley expects slippages of 5,250 crore versus 4,690 crore in the previous quarter. Asset quality may remain stable. Our gross NPA ratio as per Motilal Oswal is expected at 2.5% versus 2.5% in the previous quarter. Watch out for the commentary from management with respect to business growth, that is deposit and loan growth going ahead. Two key numbers, watch list at 4,789 crores and restructured book of 3,540 odd crore. How they behave will be seen closely. Our polls suggest NII growth of 12.2% YOY and just 0.9% sequentially. We are working with a profit growth of 20.3% YOY and a decline of 2.5% on a sequential basis. Back to you.
Okay, all right. Thank you very much for that. That is Abhishek there with the expectations on ICICI Bank. Let's just go back to Deepan as well for a comment. Deepan, you mentioned HDFC. So I guess, to wrap up the whole chat on financials, the sense that I get is that, this whole episode hasn't kind of unnerved you. You would still be confident and you would remain a buyer in the large cap banking space?
Absolutely. But the problem with us and most investors is that we are already overweight private sector banks and banking sector. And that really is the issue over here. That fresh money, although however good the numbers will be, cannot be deployed into bank because there's only so much of exposure you can take. But these are stocks to remain invested in. Valuation wise, they are not expensive, and there's good earning visibility. So far, at least, no signs of the NPA cycle turning. The RBI is very vigilant and proactive. We got these norms on AIFs as well. So they are taking preventive measures as well. With the economy doing well, industrial activity, service activity picking up, capex doing well, and large industries like real estate, capital goods, automobiles still sustaining the growth rates, the demand for credit will be good. So whatever pressure is there on margins will get compensated by higher loan growth. So very positive on the financials. It's just that the allocations and the weightages in the portfolio remain very high.
Already overweight, as Deepan put it. Deepan, thank you very much. Good speaking with you. Enjoy the rest of the weekend. Actually, enjoy Monday as well, and we'll speak to you next week because Monday, of course, is a market holiday. We'll take a quick commercial break here. You got the market, which I think is slipping a little bit more. I mean, if you can have the Nifty up, I think, yes, we have slipped. So 21,623, 10 minutes back, and
it's Reliance now down almost 1%.
We slipped 40 points in the Nifty in the last, I think, 10-15 minutes or so of trade. and maybe Surabhi says Reliance will put it up. Reliance is one of the culprits. It's come off from about 27.20 about 10-15 minutes back to about to where we are, which is 27.14 or so. Yeah, I mean, there is Reliance has been coming off through the course of the day from the early morning highs that it made, which was closer to about 27.65 or so. We'll take a quick commercial break here. More on markets. Will we see more slippage or will things stabilize? Ajay Vora will also be with us. He's head of equities at Nuvama Asset Management. He joins in on the other side. Stay tuned.
United States, and we saw at the G20 it was very constructive to turn the attention to win-win relationships.
The narrative in a lot of the popular press has been India as a prime beneficiary of supply chain relocation, and you've seen company-specific announcements out of companies like Apple that are continuing to ramp manufacturing capabilities in India. Obviously, the government's Made in India program is supportive of that as well. That is, however, not in fact occurring in the actual world. India has driven FDI of about $40 billion over the course of the last couple of years annually. Trailing 12 months is only at 13 billion, and we're looking at a best case scenario of 20 billion for the current year. So significantly below trend. And so inbound FDI is not coming. We're not seeing global multinationals make the bets that it seems like they're making if you only read the headlines. I think that the critical thing that we're looking at from an investor expectation perspective is this belief that multinationals are keeping their powder dry until we get past the political season in India.
Here in Davos, Geeta, everyone's talking about AI, the transformative impact of that, what it could potentially do to jobs, what it could do in terms of disrupting different sectors. You know, what's your view on what AI could mean for the global economy?
Yeah, so as you've seen, if you talk about AI to anybody, they can pick different facets of it, right, in terms of misinformation, but also the impact on the labor markets and so on. So we've actually done a pretty careful study on potential impact on the labor market. And our assessment is that about 40% of jobs globally, on average, 40% are vulnerable to AI. Right? That's a big number.
Welcome back. You are with us in Closing Bell. Coal India has seen a big surge in today's trading action, and it reached the 400 rupee mark. Nigel is here to tell us about what's the excitement beyond the fact that the market absolutely loves every PSU stock. Nigel?
Well, indeed, Coal India has doubled in the past 9 months and has hit that 400 rupee mark for the first time in 8 years. You must be wondering what has changed, right? Well, investors have moved on from fretting on the ESG concerns. They've come to terms that India's strong economic growth will result in higher power consumption, which means increasing demand for coal, as well as thermal capacity additions. But what is the recent trigger, though? Why is the stock so excited? Well, Coal India's offtake has increased by around 8.5% so far. With dispatches to the power sector, well, it's exceeded expectations. And to the non-regulated sectors, it's hitting record highs out there. And that's a profitable one, right? Well, this has resulted in coal stocks at coal-based power plants hovering around 32 million tons. That's much better than last year, and it's at very, very comfortable levels as well. Well, besides higher offtake, Coal India has reduced the number of employees by close to around 39% in the last 12 years or so. And this is important because employee cost, that's the largest cost component for the company. Higher offtake coupled with focus on improving efficiencies like reducing the employee cost, well, that's resulted in the earnings per share doubling in 3 years. And Jefferies is talking about these earnings compounding by 5% from year on. So though the stock has doubled, well, it may not look very, very expensive on a valuation parameter. It trades at around 7.5 times forward earnings. It also has that cushion of that 7% dividend yield. Put all this together, well, for the first time in the last 8 years, you have Coal India that's hit that 400 rupee mark, guys.
All right, Nigel, thanks very much. Very nicely explained. You know, and of course, you get that fat dividend as well, right? Which is, it's nice. I mean, while you wait for price gains and capital appreciation, it's nice to get paid to wait, which is what Coal India does and so many other sort of, high dividend yield stocks as well. I was just looking at the lows, the COVID lows on Coal India. It was $109 basically. So it's almost gone up 4 times. although unfair to look at the absolute low, but it's done very, very well. Ajay Vora is with us, Head of Equities at Nuvama Asset Management. Ajay, good to have you with us here. Thanks for your time. Let me just sort of kick it off with your thoughts here on Coal India and some of the others who've all come back in a very strong way. Old economy, old economy sectors largely, very high dividend yields. Do you own any of them? What's the view from here?
Yeah, hi Prashant, good afternoon and thanks for having me on your show. In PSUs, as you rightly said, there has been significant transformation in certain pockets, both in terms of, numbers, in terms of outlook, and maybe, that is getting reflected across many stocks. And needless to say that, they were available pretty cheap, I would say a year back or even 6 months back. If you look at the entire PSU basket, and we should not generalize that, but broadly, 6 months back, the entire market cap of all PSU companies put together was somewhere close to $450 billion, which is say closer to 35 lakh crores. And over the last 6 months, as we speak, it stands at $750 billion, closer to 65 lakh crores. So, there are certain pockets where I would say that, some irrational or euphoric movement has taken place. Like if you look at, stocks like say ITI, for example, market cap is 35,000 crore and still, negative operating profit. And on the other hand, you will find certain companies where, EBITDA can be $1 billion and market cap is still $2 billion. So, so in certain pockets, the pricing has played out basis operational, but there are still certain pockets in PSUs where there is euphoria kind of a sentiment.
Okay, all right. Hi, Ajay. Good afternoon and good to see you. Nigel on this side. First of all, I want to tell you, congratulations. I think the last time we joined, you spoke about some OMCs and they have done splendidly well from there. That's the pocket that you liked, I think. And the pharma sector as well. These two, at least I recall that you've spoken about. So what's the view from here on? You've got the call right, but that's a tricky point, right? Now, what do you do? Do you believe there's some more steam left? Would you be a buyer even at these levels?
Yeah, so hi Nigel. So you're right, we were extremely positive on OMC space. And if you go back, a couple of quarters, you'll see that, say suppose a company like HPCL, the market cap was closer to 35,000 crores. And there was a possibility of they delivering close to 20,000 crore of EBITDA. And most importantly, Street was building in a sharp decline in the following year, basis the marketing margins and also the GRMs, which has completely turned around. So if you look at the marketing margins now, they are way higher than what the Street was building in maybe 2-3 quarters back. And going forward also, we don't see those kind of estimates holding true. It will get revised. And on the other hand, if you look at the refining margins as well, Street was building in, pretty conservative numbers over there. So all in all, we thought that, on a steady state, numbers can be pretty high versus what Street was building in. And the EV, if you look at it, stocks were trading at 1x price to book and 1.5, 2 times EV to EBITDA, and that is what has panned out over last, I would say, 3 months. The entire space is up almost, I would say, anywhere between 50 to 70%. And I still believe that from here on, we are getting into a very strong refining cycle going into FY25. And even if we have central election and we had state elections, there has not been a major dip as such on the marketing margin side. So I think if the numbers, what Street is building in, will get upgraded over next couple of quarters, and we'll see stock doing well even from here on.
Okay, got that, Ajay. Hi, good afternoon. I want to talk to you about Hindustan Unilever. Now the stock is down almost 4% because the numbers are obviously they're worse off than even the weakest expectations out there. So the question is really, what is the sense that you get when you talk to clients about FMCG and lever? Do clients see this as a lever-specific issue? And B, could this have a bit of a rub-off effect on the rest of the staples? Or is it a case that, most of the institutions are anyway underweight on staples FMCG, so it shouldn't have a wider market fallout in that sense?
Yeah, hi Survi. So I think at the broader level, what sense we get is, there are two things playing out in a big way. One is over ownership and secondly is the valuation. So, wherever the valuations are pretty high, and if you look at, Unilever, the valuation is somewhere around 55 times, and you are getting growth which is, less than 10%. And I think investors have been holding these names for a fairly long time. There is nothing wrong with the company, nothing wrong with the business. But the point is that the broader market has got so attractive in terms of the valuations and also the growth rates that people will have to move on to different stocks, different sectors where they can end up making outperformance. So my sense is that and this business is more dependent on the rural segment, which, as we all know, is still lagging since quite a while. Till the time that recovers, I think the volume growth will stay subdued. Once you have volume growth picking up and coming back to those 7-8%, I think you can see some sort of bottoming out in these names. But as I said, the over ownership and valuation is the theme which is playing out in many large cap names, and we saw it across banks and even IT to some extent. So that is, I think, the overarching theme over here.
No, fair point, but one just wonders whether this whole rural weakness argument really holds on its own, because we've seen the recovery in two-wheelers, right? I mean, they're reporting better numbers in domestic sales as well, and that's also a rural play. So somehow it's not adding up. Clearly, there's more to it. Also, just the second part of to that question, is this a lever-specific issue, or do you think this could lead to additional selling in some of the peer companies as well?
So it can be a lever-specific issue because there are certain categories of their business which are highly penetrated now. So expecting very high volume growth in those categories may not hold true, and therefore those businesses can stagnate, or I would say grow at a lower pace. Whereas other FMCG companies where the categories are still not that penetrated can continue to see a little higher, or I would say relatively better volume growth. So my sense is that it can be to some extent a lever kind of an issue.
Ajay, sorry, Nigel was asking about OMCs. Did you have a call on standalone refiners as well, or am my memory faltering? CPCL and MRPL.
I think we spoke about this company, Chennai Petro, which has done exceedingly well.
I mean, it's done
as a standalone refinery. And as I said, there are stocks in market where there is a negative operating profit and $4 billion of market cap, whereas this company can end up delivering $1 billion EBITDA, and still the market cap is only $2 billion.
So you still, right? So still bullish on this one, Chennai Petro?
Yeah. So we hold it across all our clients.
Wow. I mean, we're sort of getting through January this year. It's up 20%, 25%, and of course, I mean, 2023 was a phenomenal year. From 200. At the close of 2023, it basically, I think, ended at 700. So it was in 23, it was a three-bagger, more than a three-bagger actually. So that's Chennai Petro for you. Nimesh actually, as part of his editors' roundtable, put out a list of P multiples where they're trading as compared to averages. Just based on that, this looked the most egregious. I mean, I think now it's trading about 8-9 times P from what I remember, on those points. And the historical average, of course, is very low. But Ajay is saying that maybe that's not relevant. Things are looking much better here for oil marketing and maybe even standalone refiners, etc. as well. Anything new, Ajay? Any new sort of addition to the portfolio? Anything you'd like to talk about?
So a couple of themes, we are still pretty positive. I think, the whole housing finance companies are looking pretty cheap. We have seen the kind of action on the real estate side, and there I think a large part of the positives are getting built in. But if you look at most of the housing finance companies and start from say $500 million market cap to say $10 billion market cap, all these names are still looking pretty attractive considering the growth path which they have right now. And my sense is that once the interest rate starts falling, these guys will end up doing pretty well. So overall, housing finance companies is one theme where we are positive. And secondly, this whole tire names, which we have been bullish since quite a while, that has picked up pretty well of late. But we continue to be positive on this entire tire space because, Prashant, if you look at the business, 65-70% is completely consumer business. And if the raw material prices stay where they are, even the B2B business, they'll end up making reasonably good margins. And what Street is building in, they are fearing that the margins will start correcting. But as I said, that if raw material stays here, the margins can actually move higher. And if you look at the valuations, they are still trading at I would say anywhere between 12 to 15 times PE or maybe 4 to 5 times EV to EBITDA. So my sense is that, even this space can continue to do well from here on.
Okay, got that. Well, Ajay, it's been a pleasure speaking with you. Thank you so much for joining in and taking us through this trading Saturday. You enjoy the rest of your weekend and the Monday off as well. Time now to get to our special segment, D Street Chatter. Nimesh joins in and he's managed to pick up chatter even on a Saturday, even when volumes are thin. Nimesh, what do you have for us?
Well, Sirbi, I'm doing a dealing room when there are hardly any dealers in the respective offices as well, right? So, but again, the momentum in PSUs continues, so no point talking too much about that. Again, now it looks like there is a clear divide of camp in the PSUs as well. One who have a bit of a disbelief now after the big rally, and the one camp who still believes that there is a lot of momentum to catch up in the PSUs. So one need to understand which camp they want to be. But apart from that, as rightly pointed out, the volumes are on the thinner side, lack of participation from both FIs as well as the DIs as well. The other couple of sectors which are doing good today are the tire names. So a lot of tire stocks are buzzing in trade, and so is the case with select cement stocks as well. So again, thin day in terms of volumes, but it's the PSUs which keeps outperforming and surprising the street.
Okay, all right, Nimesh, what about individual stocks? You've given us a couple of sectors. Let's drill it down to stocks. Yeah.
Manage few individual names as well. So, Nigel, the first stock on my list today is RBI, Restaurant Brands Asia. That stock is buzzing on good volumes as well. I understand the volumes that HNI Dex has picked up in the last many days, and the street is now anticipating some sort of a global tie-up on the coffee side. So, that's the reason why off late RBI has been buzzing in trade. The second stock is Expro India, a small stock, thinly traded as well. But again, if you look at the shareholding pattern, some large investors own a big chunk, and I understand the company is likely to raise funds via QIP very soon. So that's a trigger in Expro India. The third name is Gujarat Fluoro. Flat in trade today, but off late you've seen a bit of surge in that stock as well. The volumes are on the higher side, and the street is anticipating a foray into the electric battery manufacturing very soon. So that's something to track in Gujarat Fluoro going forward. And the last is LIC. Every day you have at least one stock in my charter list which is part of the PSU basket. LIC is buzzing in trade today on a day when there is not much participation. Though I understand some domestic mutual funds are active buyers in LIC of late, and hence a big surge in that stock as well in the last many days as well as in today's trade.
Nimesh, thanks very much. Interesting list there. So Expro is new on your list, Nimesh.
Yes, Prashant. Small stock, close to 2,500 crore market cap, but if I was just looking at the shareholding pattern, there is hardly any mutual fund participation, but the FI is on a large chunk. Malabar owns close to 11% stake. There are a couple of large individual investors, including Sundar Iyer. He owns close to 1.5–2%, and Ashish Kochole owns close to 3.5%. So good mix of both HNI, smart HNIs and large funds own it, but it's a small stock in terms of market cap, and the volumes are relatively on the lower side.
All right. Thanks very much for that. So interesting list as always, and we'll track it as we go forward. Thank you for joining in, Nimesh. Well, ahead of the Pran Pratishta at Ram Mandir in Ayodhya, my colleague Mangalam decoded the most popular temple towns in India and the likely size of the tourist economy. Mangalam, over to you.
The excitement of the opening of the Ram temple in Ayodhya, the cheers that there are and the footfalls that are expected, it's important to look at some of the most popular temples in India as well. And the one that takes the top honors for the longest time has been the one in the southern part of the country, Tirupati Balaji, which attracts 50,000 to 100,000 devotees per day, and a number that swells to 30 to 40 million visitors per year praying to Lord Venkateshwara. At the second place is a number not too far away from the number of devotees visiting the Tirupati temple are in Amritsar, the Harmandir Sahib, the Golden Temple in Amritsar, attracting 75,000 to 90,000 visitors per day. Again, a number that amounts to 27 million to 33 million devotees per year. Now, coming down to the metros, in the western part we have Mumbai, the mega metropolis, and out there you have the mega Ganapati temple, the Siddhi Vinayak temple, which attracts its fair share of devotees, and a lot of them coming from the resident population of Mumbai itself. That amounts to 75,000 to 90,000 visitors per day. Again, a number which overall swells to 18 to 22 million visitors per year. Now in a city not too far away from Mumbai, we have Shirdi, and out there too, the temple town of Lord Sai Baba, we have a fair amount of visitors who come in not only from Maharashtra and neighbouring states but from the country, and foreign tourists too. Close to 40 to 50,000 visitors per day visit the Shirdi Sai Baba temple, and a number that amounts to 15 to 20 million visitors per year. Among the top 4 dhams of Vishnu temple, one of them is in Odisha, the Jagannath Puri temple, and that too gets its fair share of devotees, 20,000 to 30,000 visitors per day. This average number increases a lot more on important occasions like the Puri Rath Yatra, 7 to 10 million visitors per year. Come up north in the hilly region, we have the temple of Mata Vaishnav Devi, slightly difficult to get to, but does not stop the determination of 18 to 27,000 devotees who visit the temple every day. Again, a number that amounts to nearly 7 to 10 million visitors per year itself. To estimate the kind of footfalls that the Ayodhya Ram temple would see, it's also important to triangulate the kind of surge that we've seen in temples post-renovation. And the prime example of this is Varanasi's Kashi Vishwanath temple, which earlier would attract around 7 million tourists annually, but post its renovation, it attracted 73 million tourists in 2022, a number that has surged 10 times and is much higher than all the other temples in the country itself. And this is something similar that we saw in Ujjain as well. One of the 12 Jyotirlingas of Lord Shiva, the Ujjain Mahakal temple, would earlier get about 25 to 30,000 visitors per day. But very recently, we saw the Mahakal corridor being developed, the temple being renovated, and as a result of which, a 4 times jump in the number of tourists is what we saw. Close to 100,000 people visiting this temple. What does this mean for the Ayodhya temple then? Estimates suggest anywhere between 100,000 to 300,000 visitors per day once the temple opens. Sustainably, that could mean about 100 million tourists every year. Each of them spend 1,000 rupees. You have a ready temple tourism economy of close to 10,000 crore rupees.
There you go, the growing temple economy of India, and temple tourism, or spiritual tourism as it's being called, is very serious business. Mangalam there with a fantastic wrap. We'll take a break on that note. Come back, as always, get you some trading calls with Mitesh for the final few minutes of trade.
That varies. So if you look at the US, the 60%, that number would be 60%. If you look at India, that number is 30%, because you have a large share of workers that are in the agricultural sector, which is not affected by, by AI, especially not the generative AI. Now, then there is a question of this, if I take the US, and of the 60%, what fraction benefit from, get complementary, benefits from the AI, right? Become more productive because they have AI, versus how many of them are actually going to get substituted out, which means more likely to lose a job. And that then gets to it's about half of that 60% number, right? So we're talking about very large fractions of the population who are at risk of, at least if not losing their job, but in a sense being devalued a bit by the presence of AI, but also an important share that can benefit from it. The risks on inequality growing, especially wealth inequality, is something also that we flagged in this new research that we've put out.
The reality is that markets are pricing in an extremely aggressive view right now. You're looking at about a 70% odds of a rate cut in March. JP Morgan view is that it will be June at the earliest. Markets are pricing in over 140 basis points of rate cuts by the end of the year. JP Morgan's thinking somewhere around 120. And so you have very aggressive forecasts already built into rate markets at this stage, which we think are likely to be disappointed.
The union budget, though, is less than 30 days away. What's your wish list for the finance minister presenting the CNBC-TV18 budget ballot box coming to a hotspot near you? We'll be placing these ballot boxes at popular public spots, malls, colleges, theatres and others across major cities. We'll also be asking the newsmakers who drop into our studios for their budget wish list. So come join us and tell us what's your top budget wish list from the finance minister. Drop your wish list at a CNBC TV18 budget ballot box near you. We'll compile them and present it to the Finance Minister before she presents.
Well, volume's questionable, but for the time being, the markets are at the low point of the day. So we're down close to 150 points from the day's high. And that's the way it's panning out. And that's despite the Nifty Bank actually putting its hand up and being counted. Mitesh Thakkar joins us to give us his view on the markets first and also what to buy or sell today for a reverse trade when we come back next week. Mitesh?
Nigel, on the index, nothing has changed. As I said, I think, we might see this choppy movement continue. The important thing is that last 2 days have bounced back. We saw some.
I'll only take the lead.
21,700, 21,750 was the level which the markets found difficult to get past. So I think that remains an important level. But that apart, I think, till something big happens, I think you might see the market just chop around. And on the stock side, Torrent Pharma is something, which I would take a BTST call with a stop below 25.20 for targets of around 25.80. And Polycap, it had a big fall post that news and then some kind of a pullback. I think that pullback is coming to an end. So we'll take a STBT there with a stop just above levels of 43.80 and a target of 42.75 can be looked at.
Okay, all right. Mitesh, thank you very much for giving us all of those trades. You have a great rest of this evening, the weekend and the Monday break. I'll see you back on Tuesday. Well, let's look at Tejas Networks now. Pull up that stock. It's down about 5.5% in trade today. And that's because something interesting is happening. And there's a lot of divergence between the top line and the bottom line of the company. The top line has grown at a whole 100%. That's because Tejas is now executing very large contracts for a lot of government entities like BSNL as well. But the bottom line has deteriorated and losses are mounting because the company is investing a lot in R&D and in improving its systems to execute these large contracts. So interesting dichotomy playing out. Now, speaking of Tejas Networks, we thought of playing out a small snippet of a conversation that I was having with Vijay Kedia earlier, veteran investor, because he took a big bet on Tejas Network back in COVID. He bought the stock at 40 rupees, and here he explains why he picked it out as a multi-bagger. Take a look. How does Vijay Kedia pick multi-baggers?
No, it's very simple for me, since I have been practicing this since ages, for more than 2-3 decades. So that is why I can say that it's easy, but of course investing is not easy, although it is simple. So as you know that I'm applying that SMILE formula that everybody knows. So SMILE stands for small in size, medium in experience, large in aspiration, and extra large market potential. So this is what I am following. So I am trying to catch a fish in the ocean, not a crocodile in the pond. But my other philosophy is very simple, that I am just tracking, you can say that an athlete, which has set a record in the past. And if that athlete falls sick, I just keep it on my radar. I keep that athlete on my radar.
Okay.
Like a company which has created some milestone in the past.
Okay.
Whenever the last economy was,
the boom cycle was
there, that time they had done some things, they have created some milestone.
Okay.
And now they have fallen sick. So I am waiting for that athlete to recover.
And then start running again.
It's a past glory.
So give us some examples from the portfolio if you can.
I had bought, for example, Tejas Network during the COVID. Okay, so it's a company. It was once before COVID, the stock price was 400 rupees, and it was termed at the only company in India in telecom equipment,
networking
equipment, not in services, in equipment. So it was termed as the maybe Huawei of China,
potential Huawei of India.
But ultimately, stock price did not do well, and company did not do well, and the stock price fell from 400 or 500 rupees to 40 rupees during COVID, and company had a loss of 100 crore rupees in a year or so. So it was an athlete who has created a track record, but fallen sick and came down to 40 rupees during COVID. Of course, COVID also helped it to come down to this level.
Absolutely, it compounded the crash.
So that is all right. But the company was available at a throwaway price. And that time I found that all these telecom services company, because they are giant, like Jio was there, and of course Airtel and Vodafone, so 2.5 companies as they call it. Call them. So those companies were still surviving, and other all 10 or 15 companies had vanished.
Yes,
you know.
yes.
So now these companies, the telecom company, had started doing capex and all, and for otherwise they had a very bad patch between 2012 and 2019 or so, or 18 and 19 or so. They did not expand and did not do any capex and all. So I realized that this is the only company in India which into those this network equipment, and the future of telecom services company, which are the customers, has started reviving. So to me it was a no-brainer at that point of time. And the kind of the money the company was losing, actually they had cash in the books. So I bought that Tejas, and luckily it helped me.
I am just checking the stock market price of Tejas Networks right now as we have these conversations. 862.
Yeah.
You bought close to 40.
Yeah.
862.
Yeah.
Now that is the way a multi-bagger.
All right, well, that's Vijay Keria talking about his big bet Tejas Networks. We'll cut across to the Kotak Mahindra Bank press conference on the third quarter earnings. Listen in.
In 2008, 2009. All of this, as if all of this was not enough to create enough volatility, we also have very, very difficult geopolitical circumstances going on as we speak. Within this backdrop, India actually has been relatively protected and resilient, with strong economic growth, improved business optimism, continued rise in public expenditure, and a pickup in private sector capex. Now, all of this is not new news to you, but I think the one thing which really stands out for me is the way India has built out its digital stack. That has transformed the country in more ways than one, and frankly is more than meets the common eye. This continues to be a very significant opportunity and change agent for everyone, including us at Kotak. In this kind of context and backdrop, Kotak occupies a very special place. Kotak is a very strong brand, has a very strong reputation. It is very well capitalized and an incredible platform offering the full array of financial services, products, and services. As I see it, the challenge and the story from here on is how we scale. Scale not just for the size of sake, but scale for relevance. Anyway, that is just 3 weeks into the role. Today, we are all here together to look at the third quarter numbers. And with that, may I request Jaimin to take us through the numbers. I look forward to interacting with all of you on a far more regular basis going forward.
Thank you, Ashok, for your remarks. Jaimin, may I request you to take us through the numbers?
Thanks, Rohit, and thanks, Ashok.
Okay, well, that is Kotak Mahindra Bank. We'll go back to the earnings in a bit from now. But N. Jaykumar is Group CEO and Managing Director at Prime Securities. He's joining us now to sort of take some questions. Jake, it's great to have you with us here. And it's good to see you working on a Saturday. So, good to have you here on the channel. I want to start with public sector banks, Jakes. Heated debate, and old veterans, some of the view that maybe this is getting into dangerous territory now. PSUs, not PSU banks. Others saying, well, there's still value here and profits have also expanded in line with valuations, etc. Where do you stand in this one?
Well, as far as PSUs are concerned, I think, difficult to sort of put all of them under one, one fell swoop, as it were, one basket. But if you were to look at what's happening right now, I think the impact of retail is getting seriously unfactored in. What I mean by that is, we all know that retail is coming through SIPs, through mutual funds, maybe some through AIFs, and family offices are coming in. I think the impact of this is that they're getting into spaces and territories with a ferocity that's not being factored in. Otherwise, just a simple statement that the minister makes in Davos that we'll have Swiss technology running our trains or something equivalent to that and you have stocks on on a tear for 3 successive days. Not that they've not already moved. So I think the fact is there is a huge desire that retail has to have an exposure in the markets, and I think what that's creating is it's moving from one sector to the other. But the moment the theme catches on, everything sort of moves. I mean, the ridiculousness was almost seen a few days ago when a bank announced the opening of a branch in Ayodhya, and suddenly the entire sort of focus was on that particular bank and on that particular day. I mean, now maybe this is folklore, maybe this is too simplistic, but the reality is retail is having a much bigger say in the markets than any of us have actually felt. We all felt that the money would come in, but come in through mutual funds or come in through more organized spaces. But the way it's coming through in terms of direct exposure, it is frightening. Some of these gains will not sustain. Some of these moves in some of these PSU sectoral themes have just gone to ridiculous levels in the short run. But then who's to say that they don't have holding power? And maybe it is my age coming to the against me in a sense. That's the bane rather than the boom, that we aren't able to see what some of the youngsters are able to see. And some of the younger folks haven't seen a bear market. And good luck to them, but inevitably corrections will happen. They'll be short and swift. But for the moment, because the tailwinds are so strongly India focused, and to the extent that foreigners, FPIs continue to have a trading in and out in India, and look at India in the context of reallocating money to other markets, etc. From that perspective, I think we still have a long way to go because FPIs aren't fully committed to the markets. There is a lot more India allocated money that could come in. And as we enter other indices, etc., this I think will only intensify. So from that perspective, retail has been the smarter trader, if you will, or the smarter investor. And as a, just like what happened to the Robin Hood phenomena in the US, much the same is happening here. And of course, it's got certain other issues as we hear war stories about individuals losing their money in options trading and getting out of the market. But leaving that aside, because that's a story for another day. But on the investment side, I think there's a lot of new money walking in, which has been not factored in by most folks.
No, absolutely. Jakes, good afternoon, and take your point. And I think a lot of the mutual fund manager bosses, they're sitting up and taking note of this. I was speaking to one such CEO just last evening, a CEO of a very large asset manager, and they admitted off the record that it's great to talk about that 17,000 crore rupees of SIP inflow, but that's gross. If you look at net of the redemptions and the net numbers at the money at the hands of disposable of funds, it's not as large as the headlines perhaps convey. So take that point completely. But coming back to PSUs, aside of the money surge, do you feel there's a bubble when you look at stocks like now, RVNL, IRFC, particularly this railways pocket? Is this becoming a bubble?
Sometimes we tend to take view in, I would say almost intellectual arrogance by saying we wouldn't invest. Now, the fact of the matter is you talk to a young investor and he says, beyond a point, I don't really care what you think. I'm making money, I'm doing what it takes. And to the extent people have invested in these stocks, they've made money. Maybe it's my intellectual baggage that I bring along, if intellectual at all at that, because I'm not invested in these and I haven't made these triple baggers in the market. But one doesn't know what thesis to invest on, and I think that's where some of us have been sort of grown to understand the way this investing theme is all about, which is that you need a thesis, you need events, you need triggers, etc. Maybe at the end of the day, it's only themes and nothing else that in the short run are calling the shots. So no, I wouldn't be investing in any of these sort of stocks that have doubled and tripled, only because I'm not able to understand a thesis or a theme. But having said that, there are spaces and pockets in the PSUs which merit attention. For instance, whether it's PSU banks, which are still trading at close to one-time book, or it's PSU mining and the commodities mining and steel companies, I think there is value there. There are value in individual pockets. There's value in the engineering plays, which are there in the PSU theme, in the PSU basket, because most of these now are taking care of, the big issues around PSUs used to be large labor force, inefficient, etc. There's a retirement that's taking care of X percentage of the workforce every year. More younger people are joining the workforce in some of these. So I suspect with the top management completely geared towards productivity, because that's what's been given as a a goal by whether it's the ministry or the government itself. I feel PSUs are coming into efficiency mode, and ultimately when you make investments, one of the things that we see is, have you eliminated all efficiencies in the system? And from a PSU perspective, because they were so inefficient in the past, anything that they do now is improving efficiencies. And that efficiency kicking in, productivity kicking in, etc., along with the thematic aspect of the government pushing capex and nominating capex to some of these PSUs, I think the spaces that I talked about, whether it's mining, material, capex related, which capital goods, and those in the capex mode, and some of the PSU banks definitely are well worth looking at. I think all of these have done well, but can do a lot better. I think where the gains have been magnified have been in cases where the government holding is at absurdly high levels like 95-97%, and the government is only diluted 2 or 3%. So the 2-3% free float acts as the trigger for the balance stock, in a sense, or for the pricing to be set. So leaving that imperfection aside, I think the PSU space still has a lot of value, but we need to be clear, we can't be chasing momentum in this. We need to be chasing value.
Okay, very quickly, Jake, so I can squeeze in one. You like PSU banks and select themes out there, you know, some of those PSU themes from across sectors. But what about the private sector banks? How are you placed out there? Very quickly.
Those trading at close to book, and where changes have been happening, whether changes in terms of management, changes in terms of business mix, and changes in terms of board composition, etc., which indicates a new management coming in. My personal feeling is private sector banks close to book will get re-rated much the same way like PSU banks have.
All right, Jake's a little short conversation today, but thank you very much for perspective on two very important themes playing out in the market, and you have a good rest of the weekend. Well, let's start closing out this Saturday trading session. The news is that the Nifty is, heading into the weekend with a cut of about 30 to 40 points. The Bank Nifty has done better. And PSUs, they've, of course, had once again a huge surge. So let's look at the Nifty losers. Why the negativity? Why the red? HUL down 4%. A lot of the large cap IT has seen profit taking today. So TCS, HCL Tech, Wipro, all these stocks are down between 2 and 3%. Hindustan Bank, some selling today continuing, 1.5% down on Hindustan Bank. But if you look at Kotak, which is where the numbers came out in the large cap space, Kotak has done well, 2.5% on the upside on Kotak Mahindra Bank, which brings me to the winners. It is PSUs, even on the Nifty. So look at Coal India making headlines there at the 400 mark, 4% higher. ICICI Bank approaching its numbers very smartly, 1% up. And even HDFC Bank is ending the day with a bit of a positive sort of flip. So Bank Nifty in the green, Midcap's having a good session, up about 0.5%. But the Nifty is kind of struggling with some of these heavyweights under some stress. I think the bell will go off in the next couple of minutes, Nigel, but some more names to add?
No more names, we're done. Done, and we're ready to go home. No, not really. We have a couple of big numbers that are going to be coming out. But the Nifty is going to end with a cut of around 30 points odd. You know, it's totally different from the first tick. In the first hour of trade, we were up close to around 50, 60 points odd. We go home with a cut of roughly around 50 points or thereabouts. Well, we'll wrap up on this session of Closing Bell. Thanks so much for watching. Coming up, we'll have a lot more information on the stock markets. You stay with us.
Have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC-TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI/ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high. We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC-TV18, embarking on a quarter century of excellence.
Well, the Sensex and the Nifty posted cuts of 1% each. It was the biggest weekly fall that we saw in the last 3 months. The Nifty Bank, in fact, recorded its biggest weekly fall in a year. So things have been quite tricky this week all over the place. Hello and welcome to Editors Roundtable. I'm Sonia and today we have a full house, all the editors in the house today. It's a pleasant surprise and a good one at that, but it's been a really tricky time for the market, right?
I think I've been the culprit, Sonia, in terms of this not being the full house. But glad to be back with all of you. And yes, absolutely. I mean, I think very tough week. Yeah. And in a week, actually, given the way HDFC Bank fell, and given the way it saw the kind of delivery-based selling, in 2 days, it was quite eerie. I mean, 2 days, 16,000 crores of selling and a stock like HDFC Bank. And the second day when I came and I saw the HDFC Bank ADR second day down 9%, I was quite scared. But in that sense, the market's not been that bad actually. Even if X of HDFC Bank, I think it's still been quite okay.
What I like the headline is we fell 1% this week, and that was the biggest in 3 months. That shows the kind of momentum we are in the market, right? Yeah. 1% fall in a week and we got scared. So, I mean, that's the market is. I mean, you've seen such a big rally in the last so many weeks now that 1% fall leads to a biggest in three months, so to speak. So, yeah, but again, as Anuj pointed out, the biggest culprit was HDFC Bank. I spoke about Ritik Wood dance, and the first H has started to fall. So yeah. I don't know what's going to happen with the break dance. The Ritik Bank. So
has the party ended and Ritik has left the party?
So it was really bad for that gang to start on a wrong footing. So let's see what happens.
But X of that, it's been quite okay. I mean,
yeah, Infosys TCS was also okay. We'll see what ICICI Bank does. So let's see, but at least the first H will itself.
And of course, the Reliance would come out.
Yeah,
Reliance would come out. If you had a P there, PSUs. Because that is dancing.
And Midcap. There's absolutely nothing, stopping the Midcap rally. I mean, even yesterday also from intraday there was sharp recovery. Today, I mean, the Midcap.
But again, in the Midcap, it's all the PSUs. That's not like there is a lot of momentum in the broader market, so to speak. Even in the broader market, it's the PSU Midcaps which are doing so well.
Actually, today I counted some 7 railway stocks which are up 10% and more.
Absolutely.
And some 8-9 other PSU stocks, not banks. Banks is another complete list. which were up 15%, 20%. So absolutely.
So will come. All the data will come.
All the data will come.
Exactly. You know, but just one last point. I think what's happening right now is that there's just too much domestic money. I think in the near term, you just can't counter the money. I know Sonia has done some work on Midcap, so I won't sort of preempt that. But in the near term, clearly all of that is being negated by the kind of money, domestic money, which is chasing Midcap.
Absolutely. But I think the verdict is not out on whether this is a reversal in the trend, right? I mean, it's overall still been a bullish trend for the market, just that this week has been slightly tricky.
You know, I'll just take 1 minute and I'll start with, because it's not just local, right? It's global as well. That first day when the market fell here, I was very surprised to see that on that same day, FIs had sold $5 billion in one single day, ex of India. So including India, that day, which is Wednesday, when the market fell, out of Asia, out of 4 markets, FI sold some $6.5 billion or so. So that's large. But I'll just quickly run you through a few points. So I'm calling this an everything rally, right? I mean, everything went up. And this week we saw a little bit of pullback of that everything rally. So the global, right? The top down. Slightly hawkish stars are starting to align once again. We're not used to that, right? The momentum has been that rate cuts are coming. Rate cuts are just around the corner. There's been some pullback to those expectations. So first you had those comments from Fed's Christopher Waller, who basically said methodically and rate cuts will come in quote unquote methodically and carefully. That's one. US consumer demand absolutely strong, raging. Jobless claims in the US lowest in 15 months. Job market is still strong. The inflation numbers in UK accelerated month on month after almost a year of falling. So that's another data point.
Well, the ICICI Bank numbers are out, and as you can see, it seems to be a better than expected profit, at least for ICICI Bank. So it's around a 24% growth that they have reported in terms of the bottom line. 10,272 crores is where the bottom line for ICICI Bank has come in. This is versus 8,312 odd crores. And better than our expectation of around 9,997 odd crores. Now, in terms of the NII, that too has come in marginally above estimates. So the street was anticipating around a 12.2% growth. It's come in at around a 13.4% growth. 18,679 is where the NII has come in. This compares to around 16,465. The gross NPA has come in lower on a year-on-year basis, on a Q-on-Q basis. So it's coming at around 2.3%. We have the net NPA, which is absolutely flat on a Q-on-Q basis. So the gross NPA, as you can see on your screen, is 28,775. This compares to 29,868 odd crores. So that is a lesser, there's a reduction of around 3.6% in terms of the absolute figure when it comes to the gross NPA. In terms of the net NPA also, I think there was a little bit of a flattish figure. So that should come up for you, and the provisions should come up for you again as well in terms of what ICICI Bank has reported. Provision coverage ratio stands at around 80%. Net interest margins, this is what the street is going to be looking at quite closely, and there is a reduction in the net interest margins. It has come in at around 4.43%, which compares to around 4.5% in the previous quarter. And I think the street is going to factor that in come Tuesday's trading session. Overall, it seems as though the profit is better than expectations. The gross NPA ratios are largely stable and lower, in fact, in terms of the gross NPA, but the net interest margin has come off on a Q-on-Q basis. We have a couple of reactions, but before we get to that, Abhishek, just wanted your first thoughts on it.
Strong set of numbers are coming in from ICICI Bank. Take a look at the deposit growth, 18.75% YOY and about 2.9% sequentially. Loan growth pretty robust at about 18.5% YOY and about 3.9% sequentially. So they have seen improvement in the CD ratio as well on a sequential basis to 86.6% when compared to 85.8% in the previous quarter. Now, asset quality has improved. Motilal Oswal was working with a flat gross NPA ratio of 2.5% versus 2.5%. It's come down to 2.3% when compared to 2.48% in the previous quarter, which means the asset quality of ICICI Bank on a gross NPA ratio basis is perhaps one of the best that you are seeing in last 8-9 years or even more. Actually 36 quarters or even more is the number to be precise. Take a look at their performance. they have beaten our poll with respect to NII by 1.1%. However, profit beat is at 2.75% versus our poll. Provisions have risen sequentially by 80.1%. We need to wait for the details with respect to what is the provision for, given the fact that, AIF related provisions banks have been making, but no taking away from the fact that X of provision operationally, it looks like a strong quarter that has come in from ICICI Bank. We do have Ashutosh Mishra with us, Head of Research Institutional Equity at Ashika Stockbroking. Ashutosh, what do you make of the first numbers that have come in?
The numbers looks quite impressive. And the best part is that they are balancing between their credit and deposit growth, which is one of the important talking point at this point of time. And even if you look at the provision numbers, which is relatively higher, roughly approx 625 crores has been done mainly towards the AIF related things. So, which is, we are seeing across the private banks are doing at this point of time. So, on all count, it is good. Only thing is the NIMs. On the NIMs front, we all were knowing that substantial pressure banks are facing, and especially banks with a higher home loan portfolio is seeing some reduction because a lot of repricing pressure is there on the bank at this point of time, and it was an expected line on the NIMs front, taking that into the account.
Okay, so that's exactly what I wanted to ask you a little more about, Ashutosh, is the net interest margins, because I think, have a Morgan Stanley estimate, which was estimating that the margins would probably come in at around 4.37% this quarter. And we all were expecting maybe some amount of net interest margin pressure, but it's come in better than at least what was anticipated. 4.43 as compared to, say, 4.37%. Yes, marginally here and there, but nonetheless, on a larger scale, how would you read the net interest margin pressure?
So in the case of, ICICI Bank, we will see some pressure on the margins continue even on the fourth quarter. And bank has also guided for the same. Like they have seen, when the margin has peaked out the few quarters back, they have clearly indicated that the margin is not sustainable at that level. So what we need to focus is the NI growth. They are delivering very healthy NI growth, and that's a very positive.
So that wouldn't concern you, correct? The margins which have come in at 4.43, you're okay with it. You don't expect it to probably weigh down on the stock.
So we just have to understand that part of the portfolio where the loan gets repriced early and liabilities is now catching up. So it is a normal business cycle where we are going to see some margin compression. Margin will be more stable around the 4% level for the 4 to 4.25% level for the ICICI Bank in the medium to long term, and that will be very healthy for the bank, which is growing at roughly 18%, 19% year on year.
Okay, just to add more details from the press release, the slippages are slightly on the high side. Morgan Stanley was working with a slippage of 5,250 crores. It has come in at 5,714 crore, which is a jump of around 21.9% quarter on quarter. Annualized slippage ratio is at 1.98% for the quarter versus 1.69% in the previous quarter. Take a note. Recoveries and upgrades are pretty strong. So the asset quality improvement is not due to write-off, but recoveries and upgrades are at 5,351 crore when compared to 4,571 crore in the previous quarter, which is a jump of about 17.06% sequentially. If I do a back of the envelope calculation, write-off is at 1,425 crore, which compares to 1,922 crore in the previous quarter. A decline in write-off, better recovery and upgrades have actually aided, the asset quality to improve in this quarter. Ashutosh, what do you make of the numbers with respect to movement of gross NPA that I just highlighted?
Yes, it's you have highlighted very important thing out there, but we just need to see that is there anything unusual into that? I don't find any major part of it. We are going to, especially on the asset quality front, we have no concern, at least at this point of time with ICICI Bank. AIF provisions is there at this point of time across the banks, and that is more of a regulatory side of it. So we just need to little bit get more clarity on that front.
Okay, all right. Well, we have Rahul Malani also joining in to discuss the numbers. Rahul, hi, welcome to the show. ICICI Bank, your broad takeaway in terms of the numbers. In fact, I actually wanted to start with the slippage figure. It's come in at around 5,714 odd crores. They did 4,687 odd crores. The street was anticipating a little lower figure in terms of the slippages. How would you read that?
So overall results is in line with our estimates in terms of NII growth also. We were expecting around NIMs to compress by 15 basis points, but it has reduced by 10 basis points. So overall, in terms of at operating profit as well as PAT growth, it is in line with our estimates. However, when you are talking about the slippages, you need to keep in mind that in first quarter and third quarter for the ICICI Bank, the slippages are higher in the agri portfolios. So that has been trade in the past also. So I believe that incremental slippages would have come from the agri Kisan credit card portfolio this quarter.
Credit card portfolio, what is the kind of stress you are reading into unsecured loans that ICICI has given?
So basically, we in the overall unsecured portfolio, we do not envisage any incremental risk. But this incremental slippages have come from the agri portfolio. I believe that.
Okay. We do have Kaitav Shah, lead BFSI analyst at Anand Rathi Institutional. Welcome, Kaitav. Your first take on ICICI Bank numbers that have come out with respect to especially the business growth and the asset quality movement?
And I was doing slightly better.
Okay, well, Kaitav, I think we've got you a little bit on a scratchy line, so we'll reconnect with you. But nonetheless, Ashutosh, what would you want to hear from the management when it comes to their portfolio of unsecured lending?
So basically on unsecured part, the two important point is that going forward, the type of action which RBI is taking, what is their strategy? Because they are growing both on the unsecured credit card as well as consumer lending at a very aggressive rate. So how management really see it, what type of impact they see on their capital currently because of this change in the RBI action, and also going forward, is the capital requirement for that segment is going to increase, and how they are going to plan to raise that capital, or whether they will be funding more internally. So we need to understand a little bit more on management view on this part of the secured lending. Yes, in my view, unsecured business is very profitable for the ICICI Bank. A little bit increase in the capital will not make a major difference to it. But yes, more clarity from the management front will be required on this.
Ashutosh, one of the trend that ICICI's press release has given is that their BB and below book, which includes both the funded part as well as the non-funded part, that's increased on a sequential basis, while this is on a declining trend for other lenders. In absolute value, it's at 5,853 crore, which compares to 4,789 in the crore in the previous quarter. Jump of more than 22%. Although, as a percentage of loans, it doesn't make a material difference, coming in at 0.5% versus 0.43% in the previous quarter. What's your take with respect to this, the BB and below book, or, the loans funded and non-funded, which is under stress, increasing 22%?
So we all are asking so many questions on the bank on the NIMs front. To defend the NIMs partially, surely banks are trying to also go into relatively some higher yielding segment out there. What we need to understand is that is the risk which they are taking is within the parameters they are defining it or not. And yes, this needs to be a little bit more query on this front. But yes, the pressure on the names which we are seeing, bank across the line is trying to grow business in a little bit more higher yielding segment out there. And probably that may be one of the reasons why the ICICI Bank is trying to grow that portfolio.
Well, Kaitav, you're back online. What do you make of the numbers, especially business momentum strong? The slight hiccup that's seen in slippages and, a part of the BB and below book that we call it, that's increased by 22% sequentially. So your prima facie reading on the numbers?
Abhishek, the prima facie is that this seems to be a pretty good set of numbers. Especially given the context that post-HDFC Bank's results were kind of building in. And there was low positioning in the banking stock in the large cap space. Overall, our view is that large cap banks should do much better than the other segments within the BFSI space at this point in time. And from the P&L numbers that have come out, prima facie it looks that ICICI is doing better than what our estimates were.
Okay, well,
What I look out for is in the liquidity in the balance sheet that is there in terms of LCR and the CD ratio. I mean, we'll probably wash that out, which will give us more of a trend on the coming quarter NIM than this quarter NIM itself.
What will be the, that's a good point in terms of what you'd look out for. Well, in terms of commentary, what are the key points that one should keep in mind, Ketav?
So one is, as I said, liquidity on the balance sheet, commentary around what's happening to the cost of deposit. In their own opinion, is this largely the repricing has happened, and are you going to see now cost of deposit, the delta coming off or not? I think these would be the two key parameters.
We have Axis, which is coming out, next week as well on Monday or Tuesday. I think Tuesday. What would you recommend? What would your read-through be from ICICI Bank, which you could probably extrapolate to Axis?
I'll just have to do a little more digging into the numbers and then perhaps come back to you. It's too early.
Yeah, just one number that I stand to get corrected. The write-off is lower than my earlier calculation. It's at 1,389 crore. I thought the number was around 1,425 crores. So just one small correction over there. They have given in the press release 1,389 crore is the write-off. That compares to 1,922 crore in the previous quarter. Ashutosh, with respect to valuations of these large banks, how do you see ICICI Bank versus the other peers in the segment?
Across the large private sector banks, we are seeing that valuation is reasonable from their historical averages out there. And type of growth which they are delivering it, market is going to recognize the potential which they have. What I'm more positive at this point of time is the business growth which they are delivering. Yes, market is a little bit negative on the NIMs front and liquidity front, whether they will able to fund the future loan growth at the same profitability level or not. The concern is genuine, but the way overall things are spanning up, especially on the growth front, the opportunity which they are getting in. Pricing NIMs can slightly come under the pressure, but on the ROA and ROE level, these banks will continue to deliver very good numbers till the time we see any major change in the asset quality trend. And that is not still we are seeing any major trend on asset quality. So we remain very positive on these banks. Valuations are very reasonable. Growth is very strong for these banks. So you can choose across the line, but yes.
Yes, Ashutosh, just to when you were talking about return ratio, I just got to know that they have reported a 2.32% ROA. I mean, above 2% ROA was unheard few years back for the banking sector, especially below 2019-18. Prior to that, 2% ROA was a dream to be achieved, and now you are seeing 2+ kind of an ROA for the banking sector, despite the fact that net interest margin is declining. Over to you, Ekta.
Okay, well, yes, absolutely. Well, maybe we can just get some last thoughts in from our, panel of experts. So, Ashutosh, let's start with you. What is it that one should probably take away from the ICICI Bank numbers, the pros, the cons, and the likely stock reaction just based on this data? Ketav. Ashutosh, you go first.
Yeah, in my view, it will be positive reactions. Like just now, we were discussing about NIMs versus ROA. So on ROA, they are continuing to deliver good numbers, and investors should focus more towards the return, the final return, rather than just on the one part of NIMs. Yes, we need to focus on the NIMs too, but the way overall they are managing the things and the opportunities they have, I think in this calendar year, we are going to see a good return coming from the large private sector banks.
Okay, and Rahul, what about you? Just a quick wrap on it.
We continue to remain positive on bank, and we believe that over the next 2 years, despite the headwinds emerging, it will sustain ROA about 2%.
All right, Ashutosh as well as Ketav, we're going to wrap up on that note. Thanks very much for joining in and giving us your perspective with regards to the ICICI Bank numbers. So overall, it seems as though it was a good set of numbers based on what they've reported. The slippages, yes, are higher than estimates. So maybe that, along with the net interest margin pressure, would be something that would go down as negatives for ICICI Bank. So let's see. I think the commentary from the management would be critical to assess what the stock performance would be like on Tuesday, and it'll probably set the tone for Axis Bank, which is also a corporate lender in the same space, which will be releasing numbers.
Well, rightly said.
Okay, well, on that note, we also had the persistent numbers which flashed by. So do watch out for that. They have announced a stock split. And those are the numbers which the street will be reacting to on Tuesday. But with that, we're going to wrap up on this coverage for ICICI Bank. Thanks very much for watching, and more news and updates ahead.
CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18. Now streaming live 24/7 on YouTube. A show that is unmatched.
We tell you stocks to watch out for and which sectors are impacted.
Thought-provoking.
In India, the allocation to equity is about 5 to 10%, which is not beating inflation. So investing aggressively can actually look at even beating inflation.
And will give you maximum value for your money.
It is a good time to look at debt funds as a category. There's no better time than this in that sense to lock in rates for the long term.
A masterclass with India's biggest market experts. Smart money at these times. The last hour. Anything can happen between the bells. But what happens during the last hour is what matters the most. The biggest market swings. A close-up look at what's driving them and how the investors are reacting. Watch the most seasoned market mavens guide you through the most important hour of the trading. Focus, ideate, innovate, enable. Quest presents New Dynamics of India's Workforce in association with CNBC TV18.
Hello and a very warm welcome to our special series, Quest Corp presents New Dynamics of India's Workforce in association with CNBC TV18. I'm your host, Paramita Chatterjee. Today we stand at the precipice of a new industrial age marked by innovation, sustainability, and the relentless pursuit of excellence in manufacturing. The dynamics of India's manufacturing workforce has been undergoing a profound change. The traditional assembly lines are now transformed with automation, artificial intelligence, and a need for fresh skills that extend well beyond traditional labor boundaries. Now, in the midst of this transformative shift, how are our manufacturing industries reassessing their strategies for talent acquisition, skill development, and workplace dynamics? In the landscape of New India's manufacturing sector, the workforce is not merely a collection of skilled individuals, it is the driving force behind economic progress, technological innovation, and societal evolution. Our discussion today is not